Good morning. Morning, Ace. See, all right, let me get it up here. It's March 7th. We're streaming options, futures, stocks, watching some charts, some technical analysis, and GME, BBBY. Simias. Morning, Justin. Good morning, Ace. Can only be none. Get things turned on here. I don't know if data came out or what, but we got a little sell-off in the market to open. Five likes. You guys are legends. How do we get 5 likes? Only 2 of you. Oh, you came in, liked it, and bailed. Bunch of bailers. Just kidding. It's getting close to MACD. Yesterday with it coming down is not a great sign. Kind of broke a level I didn't want it to break, so I'm wondering if we're gonna get a retest. I might go pretty heavy in covered calls, just because I have some shares on margin, quite a few shares on margin. I would like to protect it a bit. I don't think I want to close shares to try and get them lower at this point. So cover calls, maybe $1.50, maybe $2, and then just be content to have to roll it. Yeah, this is bumping this morning. Here, delete some of those drawings. I'm less certain of a GME run now either. The rejection on 1940 was legitimate. Thought it was maybe just gonna consolidate below it and then pop, but I don't know. We better see some action today, or I'm gonna cut those calls. Little pre-market yesterday. Give us some levels coming into open. BBY just bar coded, did get a pump. Sugar's still going. Everything looks good on it other than it's hot. Jeez, 24%. Yeah, it's just kind of playing with fire buying it this high. Especially since it's filled that gap. 94, jeez. Okay. 10-year yield slumps 5.5 basis points at 3.93%. 2-year yield drops 3.7% for basis points to 4.86%. Volatility index rises half a percent. We've got Powell at 10 o'clock, so there'll be some excitement around there. The average monthly payment for a new car has increased to a record $777. nearly doubling from late 2019. Next bull market, stocks won't kick off until the Fed is forced to bail out the U.S. government, says Bank of America. First-time buyers make up the smallest share of sales on record last year at 26%. Wow. The equity market showing signs of exhaustion after the last Fed meeting. S&P 500 has a critical technical support. Given our view on earnings, March is a high-risk month for the bear market to resume. Morgan Stanley strategist Mike Wilson said. Russia's revenue from oil and gas exports almost halved in February of this year. UK uses new backup coal reserves for first time. Billionaire investor Mark Mobius says China is restricting flows of capital out of the country, saying, "I can't get my money out." Zero-date options could turn a 5% intraday market decline into a 25% rout, says JP Morgan. We haven't seen a crash in the market since we've had zero-day SPY options. Thanks for your likes, guys. So on the BBBY subreddit, they're trying to do share count, figure out how many shares we own, and I put my shares in the comments on the one post. I actually put it on Discord too, if you guys want to put in how many shares you own, so we can get a list. Let's see. Jeez. Here you go. So from 1,380 people, they own 11.7 million shares. BBBY's outstanding shares right now are 117 million. So from only 1,380 people on a subreddit, they own 10% of the float. Yeah, you can add your shares to the list. So, actually, on this, I think you add them on this post too, maybe. Yeah, so you can add them on this post. This is on our Discord, but I'll just share it here if you guys haven't. Yeah, if you're a shareholder on BBY, follow the instructions here and comment. So if you haven't commented already with your shares, you type new amount of shares in the comments. If you've already commented how many shares, but you've added more, you update. So, can I search on this page? Can I do that? No, it won't do that. You'd have to use some other formula. So I guess the green ones are verified. In alphabetical order. I think. So there you go. About 4. I hate Bank of America. About 4 minutes to open. I don't know if there's as bad as Wells Fargo. I've banked with both, and I prefer Bank of America over Wells Fargo. Why are we talking about them? Because what they said about the economy? Or the zero-date options? Okay. So we'll probably listen to Powell at 10. I want to start averaging back into that gas. Literally wick down to my stop. Oh man. Yeah, this was like my stop right here. Sounds pretty good on these moving averages. That's with the extended hours though. Kind of deflated on that. I played that. God. So in the morning, if we get a kind of pump on BBY, I need to consider closing some cash secured puts and open cover calls, or at the very least opening cover calls, because that's only Tuesday. Okay, I've got about 1 minute to open. Is my thumbnail really the yacht? It shouldn't be. Oh. Novus. 20% pump. Not bad. BBBY back to the low 139. It's hitting again. Okay, market's open. Whoa. Okay, when the VWAP does stuff like that. Box D's up 6%. Party City's up 11. Average cost to borrow? I'm not shorting it. I mean, average cost basis. Buy's coming down here. Cost basis. I've lost money on it because I've closed and I've reopened, so it's hard to really know at this point. I bought a lot in this 150 range though. So since I've closed, I've rebought under, most of it's been under 150. Morning, Christopher. And then I've done cash good puts too that have been assigned. So yeah, cost basis is a tricky one. And then some have wash sales, they're showing a higher cost basis. But as far as purchasing shares, they've mostly been under 150 as of late. Osm's up 5%. Are you still in? Oh, that's right, you got back into Turka. Turka. Buys coming down here. BBBY just flushed through yesterday's low. 138 is the low there. I'm putting some orders out for some actually 1.5 cover calls on BBBY. Just gonna slowly scale into either 1.5s or 2s, depending on how bullish we are today. Morning, Donro. So we hit 138 there. And seems like we'll probably retest this 136. The other guy that follows it? I don't know what other guy you're talking about. Bed Bath at the top of that barcode now, 140.10. Not a whole lot of stuff that's very up on my watch list here. Snaps up 3.5. Wheels. Box D's up a bit. That other guy. I bounced right off the level there. Should have ignored my exit strategy. Nah, you're good. Let's see. Calls on this account. Bill should be today. That's already happening today. That's pretty quick. Thanks for your likes, guys. Well done. We've got 10 of them. Early morning 10. I think we had 6 before we even started. Thank you, guys. There's a little bounce in the market. GME also. Nothing on Bed Bath yet. Did actually wick above that barcode level there. So the high on there is 141.5. Very low volume in that first 5 minutes. Yeah. This morning had 2.8. I had 3.3. I had 1.8. TikTok thoughts? Snap is continuing. Up 5.5. 6. Broke yesterday's high. All the green dots. $12.44 is kind of a resistance up here. Starbucks. He's kind of breaking out also. That IPO. At $46 on IPO day. This is one of those Chinese ones, I think. Oh no, maybe it's not. I'm gonna put some orders for some 2-strike covered calls. Not much premium on the weeklies that far out of the money. Even at $1.50, it's just not much. Maybe we should be doing next week's. Snap 7%. AS. Yeah, this thing's running. You gotta do what you gotta do, Jim. I don't know. The limit by 137. Do you filled? No, I didn't hit it. 138 was a low there. But that doesn't mean you'll get filled. I didn't order for one. What was it? Can't remember. But it was at the bottom of one of these barcodes and it took forever to get filled. End up only partially filling me. Yeah, Powell speaks in 19 minutes. Testifies in front of the Senate, I think. Okay. BBBY coming down again here. $138 now, back to the low there on Bed Bath. I got a partial fill on some of the covered calls. Buys coming down here. The whole market's probably kind of waiting on Powell for till 10. Bounced off of yesterday's low, more or less. See if it flushes through this time. Snap still going, 7.25. Up is up 7. Actually did all right on this one during this rally. This might be a nice buy. Tesla's down 1.5. Foxd is down 3%. Spot gold falls 1%. Quotient exploring a sale. Pause due to volatility. Quotient Technology, parent of coupons.com, is exploring a sale. Buys bouncing on that low from yesterday. Eyes bouncing here. QOT resumed. BBBY barcoding down here now. Breaking that pre-market low. Just a wick. GME is pretty flat. No volume on it. $2 calls for next Friday. Yep. High IV and we've come down most likely since you bought them. Wheels up 6.25. Snap 8.5. Kind of broke that high from over here. Rallying more. Snap on TikTok ban. Yeah, that could be a catalyst. Because it did start a few days ago. Eyes ripping. Getting that pre-Powell pump. Bubo's even up a bit, 3.5% there. BBY made a new low there. Yeah, it's coming down to retest. We'll see if it retests there, if it fills that gap. Yeah, here we go. Coming back to test that already. And I was able to get a few cover calls. How many got filled? A few. Same sort of deals yesterday. For trading, I don't think I like Fidelity. They're so laggy. Jeez. Yeah, those covered calls already halved in value. Or no? Wanted to get more time. The weeklies are just a premium. There's a flush, 135. So it broke the low from over here, the 136 on BBBY. Now we're in gap fill territory again. So we could be setting up an RSI divergence, which hard as it is to stomach, would be bullish. There would be a new low off of this 127. But the RSI would be higher once it bounced. $135. Yeah, so we're filling that gap right now. 131 is the gap fill. $127 is the low. Thought I locked you. Yeah, there's the gap fill. SPY settling down. Here are targets. This is gap fill. This is the low. After that, we just, yeah, 88 is a low, all-time low. Get to this when it's zero. I mean, so once it's below $1, they have to get it up above $1.
Look at this. Here.
125 to continue funding. I haven't heard that number. The only number I've heard about down here was the 76 cents or whatever. I'm in the 70 cents. Oh, the 70, I remember 70 something cents is below that the warrants. That's like the below that the warrants start losing value or something along those lines. So I think that's kind of the threshold has to stay above. $0.75. Yeah, we might be talking about the same thing. Was it to continue funding? Or I don't know. Okay, Powell's in 4 minutes. Yeah, the warrant doesn't have any value. Yeah, that's kind of how I understood it. 78 cents. That was the floor that I thought they had to keep it above. Okay, get these cover calls some more. Gonna add to them. Bring my price down a little bit. Okay. Okay. Added to the comment or the cover calls. Lowered my price a bit. Come with any company using warrants or convertible securities as collateral. Makes sense. Osm's up 11%. Morning, Jason. Durka. Kind of sold off. All right, we're gonna listen stock market live. He's playing Powell. See if he has any comments. If he has too many comments, we'll just listen to it ourselves. Whoa, SPY just flushed. Not excited to see Powell. Oh, data just came out. Whoa, that's quite the flush. Oh. His statement came out. Yeah. Says inflation is hotter than expected. All his statement just came out. I'm gonna close out these GME calls. I put an order in. I'll probably get some kind of pump when he's talking. Yeah, he basically said inflation was higher than expected, and they're gonna have to continue to prepare to increase pace of rate hikes if needed. Yeah. Prepare to speed up rate hikes if warranted by data. Economy's okay, I'll put the audio on.
Is going nuts.
Here it is. This is Stock Market Live.
Still too
Gotta
high
show 'em
across
love.
many parts of the economy. We know that who feels it the most when the cost of rent and groceries go up? It's not the economic pundits and politicians who lecture us about discipline and stability. It's not the corporate executives who pretend they're making tough choices about prices.
Again, Powell says
while
ultimate
reporting
rate peak
record
likely to be
profit
higher than
increases
expected.
quarter
Bro,
after
that statement
quarter
was
and
hawkish.
doing more and more stock buybacks.
So you need
people
Powell to
working
come in
hourly
sounding like a
jobs to make
dove.
ends
Otherwise,
meet.
it
It's seniors
seems
on
pretty
fixed
negative so
income
far.
and Social Security. It's everyone who gets their income from a paycheck each month, not an investment portfolio. It's those same Americans who stand to lose the most at the Fed's actions.
And then
to
currencies
curb
have made some of the
inflation go too
biggest moves
far.
reacting
No
to
matter
Powell.
what goes wrong in our economy, a global pandemic, a war in Eastern Europe, weather disasters, profits somehow always manage to go up.
So
Workers are left
4017
paying
is the next
price.
level
As
if you
noted,
fail this.
Chair Powell, the Fed's tools are only one element in our fight against inflation. It's a complex problem. Interest rates are a single, we know, blunt tool. Raising interest rates can't rebuild our supply chains and fix demand imbalances from the pandemic. Raising interest rates won't end Russia's brutal invasion of Ukraine. Raising interest rates won't prevent avian flu from devastating 1/3 of our egg supply or weather disasters from destroying key crops. And raising interest rates certainly won't stop big corporations from exploiting all of these crises to jack up prices far beyond the increase in their costs. Last year, corporate profits hit a record high. Corporate PR chiefs assure us that these companies just have to raise prices. Their costs are going up. The workers just want to be paid too much. They have no other choice, they tell us. Yet when you look at their profits and their executive salaries and their stock buyback plans, it sure doesn't look like corporations have exhausted every available alternative. It's so brazen. Even
BBBY has
global
almost filled
bankers
that
called
gap.
on the Fed to identify this profiteering is one of the
131.
biggest drivers
And the low
of
from
inflation.
that
Paul
day is
Donovan,
127,
chief economist
so
of Global Wealth Management at UBS,
see if we
wrote,
find support on one of
the Fed
those.
should make clear that raising profit margins are spurring inflation. Companies have passed higher costs on to consumers, but they've also taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures. Think about that. From a chief economist at UBS, I'll say it again, they've taken advantage. These companies have taken advantage of circumstances to expand profit margins.
Fed funds futures
The
pricing
broadening of
half
inflation
a point
beyond
rate hike for
commodity
March now.
prices is more profit margin expansion than wage cost pressures, unquote. The Fed, understandably, the Fed can't force corporations to change their ways or rewrite the Wall Street business model on its own, but the Fed can talk about it. High interest rates, falling wages, increasing unemployment are all hallmarks of failed policies that end up
There it is,
helping
gaps
Wall
fill and
Street, the
BBY.
largest
No more
corporations
gaps to
in
the
country,
downside.
the wealthiest people in the country. Because let's be clear what we're talking about.
Peak rate has
when
went above
people use the
5.6
economic
right
speak
now.
that can cloud this conversation.
So
Cooling
very
the
initial
economy
hawkish
means
read.
laying
He
off
hasn't
workers.
spoke yet.
Lowering demand means workers get fewer raises. Of course, there are times when the Fed must act. We can't allow inflation to become entrenched. We've seen encouraging trends. That isn't happening. And there are other ways we can bring prices down instead of lowering demand. Again, making people poor, laying people off, denying worker raises. We can speed up and strengthen our supply chains. We can bring critical manufacturing back to the U.S. We can rebuild our infrastructure. It's what we're doing with the CHIPS Act, with the Inflation Reduction Act, with the bipartisan infrastructure bill. For the first time in decades, we're finally recognizing the damage that I and many of my colleagues warned the corporate offshoring would do to our economy.
Okay, get ready for
Look at East
417.
Palestine, Ohio,
This is
a
back to the
community
gulag of
that
last
Senator
week.
Vance and I have visited a number of times recently. America learned about this small town last month when a Norfolk Southern train derailed and spewed
Oh, he's bringing
hazardous
up
material into
Ohio.
this community. East Palestine is more than just a disaster headline. Columbiana County was once the center of
Yeah, I mean, I'm waiting for my bounce to get out of that ES, but that's if we break below 417 and flush, it's going to be ugly. You're already breaking below it. Very, very hawkish read.
When I was there last week, I was talking to the sheriff at the 1820 Candle Company.
Where is
he
the
was
Fed
talking about how the
futures?
last one closed just a few years back. Like so many industries, these jobs moved overseas, and we know why. The same reason Norfolk Southern cuts cost at the expense of safety, eliminating one-third of its workforce in the last 10 years. Then you're surprised.
We wait for Powell.
It's the same
We'll get a
reason
bounce on Powell.
corporations now keep
484
prices high,
is
even as
dumping.
supply
The trend might
chains
stay
stabilize.
down,
I think
though.
it's
It's
gone.
the Wall Street business model. Chair Powell knows
I need that bounce,
I know
though.
that. My Republican colleagues and Democratic colleagues know that. It's a Wall Street business model. Quarter after quarter, corporations are expected to cut costs at any cost. They skimp on safety. They move production overseas to countries where they can pay workers less because of trade deals that they lobbied for. And Wall Street demands they post profit increases, even in the middle of a global pandemic. That's the problem with our economy. And not only will higher interest rates not solve it, if they're overdone, they'll make it worse. We can't risk undermining one of the successes of our current economy.
Apple,
For the first
Microsoft,
time in decades,
all on the lows.
workers are finally starting to get a
My
little
Tesla
power
short
in
likes
these
it.
Powell to talk.
Unemployment's at a historic low, 3.4%. That's not just a number. That means Americans have more opportunities.
Oh, you've gone
more
through
options,
7
even in
levels right
places
now.
that have seen a lot in recent years. It means people have the power to demand raises and retirement security and paid sick days and some control over their schedules. It means more Americans have the dignity that comes with a good job that provides for your family. We must here ensure that all Americans have the opportunity for that dignity of work. It's a critical time. The consequences of missteps could be severe. Mr. Chairman, 2 more things that affect your job. It's not just monetary policy that threatens American pocketbooks.
It's a
Some
weird
of my
first
colleagues
question.
have threatened the
124
nation's
not
maybe.
really-
credit by holding the debt ceiling hostage.
He's talking
to
about a lot
partisan
of stuff.
politics.
This
127.
is all
Paying our
from the
bills on
pre-written
time.
statement of
They're
Powell.
threatening essentially.
That's it.
127 's a
Nothing has
low
to
from
do with
back
this
here.
question.
The Fifth Circuit's Consumer Financial Protection
As
Bureau
I'm entered
ruling
into a business
could
agreement.
also cause unimaginable instability and chaos for families,
Yeah,
for
the thing
consumers,
kept going.
but also, as the chair knows, for a financial system. The Fifth Circuit
Turn
is
halted
Wall
down,
Street's,
jeez.
no doubt about it, the Fifth Circuit is Wall Street's favorite courthouse. It recently ruled the CFPB's independent funding is
Oh, wow.
unconstitutional. If the Supreme
Oh,
Court
jeez.
upholds the Fifth Circuit's ruling, it will not only devastate CFPB,
Again, another new
it
low.
will
You're below
threaten the independent
4017.
funding
Bro, you're going to
of many
test
other
4,000
federal
here
agencies,
next.
including
That's it. The
Federal
next level,
Reserve.
407
I
to
look forward
4,000.
Today's hearing how the Fed will balance its dual mandate and continue to promote an
Thanks for your
economy
thumbs up,
where
guys. I appreciate
everyone
it.
who wants a good job can find one, an economy that works for everyone. Senator Scott.
Nice down
That was
row.
a crazy opening statement. Again, opening statement of Powell brought us down. These guys are just making
Sitting
their
here,
intro.
Looking at my
But Fed futures are moving a ton off of it. The odds are still the same, but
or Vice Chairman Brainer's
this
moving
is
on.
all based
I
on
think it's
Powell
really
saying
important for
higher
us to make
terminal
sure that
rate.
all the information that
Even
we
though
need
that's kind of
order to
already priced in,
make
it's
a good
pricing in
decision
more
on
now.
The next time that we have in a timely fashion. So I would really implore the chair to make sure that happens, that every question.
40-10,
flush.
409,
Almost
bro. There's
1%
no
in the
respect
last-
at any
From
level.
the person,
Almost
we
1%
get
in the last.
every member of this committee
5 minutes,
has
6
their questions
minutes.
answered in a timely fashion, and that the staff has their answers in a timely fashion.
Yeah.
Listening to Chairman Brown,
Play with fire, you're gonna get burned.
I thought to myself,
It can only can go up so
Fascinating.
much so fast.
it's really
Kind of
fascinating.
bounce.
I
Fascinating.
concluded that, well, I know Chairman
Bro,
Brown
VWAP fell a
pretty
point
well.
and a half.
I am
That's crazy.
sure he is sincere in his rant. But let me just say this.
Little bounce here.
Spending and printing trillions of dollars, caving to the radical left in this country, seeing policies posited and then implemented that led to the worst inflation in 40 years, seeing our inflation at 9.1%, seeing American families struggle because of the weight of the government on their shoulders, seeing the devastation from South Carolina to Ohio. It's unbelievable that the progressives in this country who caused a 9.1% inflation would then turn somewhere besides in the mirror to see the absolute devastation caused by their out-of-control spending is remarkable.
Bro, they're
Remarkable.
They're not even bringing up policy.
To stop the out-of-control inflation caused by the out-of-control spending,
Okay,
the
that's
Fed
your
steps
first
in
bounce. Good luck. Let's see what happens.
to cool the economy. Well, the definition of cooling the economy is necessary because we've seen
This is back to
the
40-17.
most families struggle because of the
Very
weight
big
of the
level here.
government on their shoulders. Seeing the devastation from South Carolina to Ohio.
I'll just listen to those.
It's unbelievable that the progressives in this country who caused a 9.1% inflation would then turn somewhere besides in the mirror to see the absolute
It's a
devastation
little behind, but
caused by their out-of-control spending is remarkable. Remarkable. To stop the out-of-control inflation caused by the out-of-control spending, the Fed steps in to cool the economy. Well, the definition of cooling the economy is necessary because we've seen the most radical approach to a problem that was in our rearview mirror being used as a Trojan horse to bring in a level of socialism and spending that our nation has not seen in my lifetime. The facts are very simple. When you get to 9.1% inflation in this nation, as a kid who grew up in a single-parent household, mired in poverty, a 40% today, 100% just a year ago increase in the gas prices devastates single mothers around this country. For seniors on fixed income whose savings are being depleted with an average cost just last month of a $433 increase because of inflation. For my friends on the other side of the aisle to look any place besides a mirror, I find stunning. The truth is that when your food prices go up over 20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch? Because progressives used the pandemic as a way to usher in a form of spending that takes the money out of the pockets of everyday Americans and puts it in the coffers.
If you are just joining us here on Live Now from Fox, you are listening in as Fed Chairman Jerome Powell is expected to any minute now testify before Congress. We will bring you there live, raw, and unfiltered as it does happen. For now, though, I do want to go back to another story that we have been following.
that guy talking about They don't want him to talk. Yeah, that's funny. They just let everything play through and then just cut it off when he's going.
Around the country,
Oh,
looking at the inflationary effect and the absolute devastation of a snarling supply chain that we haven't seen in my lifetime, run by my friends.
we did fill the gap on BBY. Yep.
Unbelievable. But to get to you, Chairman Powell, one of the comments that you've made that I think is really important in one of the speeches you gave in January, and I apologize for my rant. I just wanted to make sure my rant was consistent with my friend here. It is essential, you said, that we stick to our statutory goals
Sure,
and
right.
authorities,
My friend here.
and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case of our independence. You further noted that, and I quote, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policy.
I did see the upgrade on the credit rating.
Do you still stand by those comments?
I do.
Thank you. Finally, I know we're not in the question. I know, I get it. Finally,
You now have 4 minutes and 12 seconds.
yes, I knew the chairman would
12
dock that
seconds.
for my time, and I appreciate you doing so
With a sense of humor.
with a great humor. Great humor. Finally, several of my Republican colleagues and I sent a letter to you discussing Vice Chair of Supervision Michael Barr's plan to conduct a holistic review of capital standards. I look forward to discussing those capital standards during my Q&A, and I will thank you for our recent conversation that we had that helped illuminate some of the necessary challenges that we face as a nation and your answers to it. Thank you, Mr. Chairman.
Thank you. Speaking of illuminating, thank you, Senator Scott.
Yes, sir.
We can stay ahead just to
Today
50
we'll-
basis
yeah.
points.
Today we'll hear from
Thanks for your likes, guys. I appreciate it. Oh,
Chair Powell to weigh in.
what
The
does that?
mini debate we just had, but I all know that the debt increase was much larger under President Trump and a Republican Senate than it has been since. Chair Powell, thank you for your service and your testimony today.
I just had to get that last word in.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago. Some of this reversal likely reflects the unseasonably
set up a
warm
bear
weather
flag down
in
here.
January in much of the country. Still, the breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer-run objective of 2%. The 12-month change in total PCE inflation has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half
I'm trying to get out of these GME calls
consumer
now.
expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remained very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time
sold out of those
peak
calls I
recorded
bought yesterday. I
last
took a loss
March,
on them.
while unemployment insurance claims have remained near historical lows. Turning to monetary policy. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity.
All right, yeah, aside.
Although inflation has been moderating in
let's try
recent
to exit
months,
some
the
positions.
process of getting inflation back down to 2%
Hopefully
has a
head and
long way to
shoulders.
go and is likely to be bumpy.
I haven't liked this though
As I
at all.
mentioned, the latest economic data have come in stronger than expected,
Looks like a bear flag.
which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly
maybe go
against
short up here.
prematurely loosening policy.
I don't
We
know
will stay
how
the course
hawkish
until
or
the
how
job is
dovish he
done.
can talk after he gave a written statement
To
that was
conclude,
quite
we
hawkish.
understand that our
But
actions
there's questions and
affect
answers, so
communities, families,
we'll
and
see how he
businesses across the
responds.
country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything
Thanks
we
for your
can
likes,
to
guys.
achieve our maximum employment and price stability goals.
Got 28
Thank
of
you.
them, not
Look forward to
bad,
your
not bad.
Thank you, Mr. Chair. There are 23 of us on this committee. Almost everyone will be here today. I ask each of us to stay as close to the 5-minute mark as we can because we have votes at 11:30. So thank you all for your cooperation. Chair Powell, thank you. Job growth is strong as unemployment remains historically low. You might not know that from the opening statements. Many drivers of inflation, corporate greed, rising inequality, supply chain disruptions, Russia's bestiality, if you will, in Ukraine, won't get better because of interest rate increases. Every indication is that this pandemic economy is different. Should we be worried, Mr. Chair, that the Fed is treating this economic period as it has in the past instead of reacting differently?
Thank you, Mr. Chairman. So we've been aware since the very beginning and have discussed this publicly on many occasions that there are some differences this time. We, in particular, have not seen the kind of supply side collapse that we saw at the very beginning of the inflation outbreak. Also, the outbreak of a war, which had significant.
You did say bestiality, it sounded like. I don't know what he was saying.
There are also, though, some similarities. There is a mismatch between supply and demand. You can see that in the goods sector still. You saw it in housing prices going up over 40% since before the pandemic, and you see it in the labor market where we have 1.9 job openings for every opening, for every unemployed person. So we're well aware that this particular situation involves a mix of cycles of forces, not all of which our tools can affect. But there is a job here for us to do in better aligning demand with supply.
Okay, understanding you have limited tools to address inflation, in our conversations in the past show my concern about continued rate
BBBY is testing the
increases
lows.
that may not actually address the root cause of inflation. They hurt workers, and many of us contend we can't follow the same old playbook. Next question. Last year, 3 banking regulators issued proposed updates on the Community Reinvestment Act to account for changes in our banking
Yeah, we've got,
system.
yep, there's a flush.
My question is, does the
130
Fed remain committed to work with
on
FDIC
BBY, so
and
127 is
OCC
the next.
to finalize
That's
the
the,
CRA rule,
that's
and when
the
will that
support
rule
from over
likely
here.
be finalized?
Yes, we do.
And after
remain
that, you're looking at
committed, and
all-time low support of
I
88.
believe we are in broad agreement with the other 2 agencies on the revisions to the rule. So now we're in the process of writing all that down, and that'll take some time. And then after that, of course, it will come to the Board of Governors for a vote, and that'll involve briefings and discussions. And I can't give
Hard to
you an
get covered
exact
calls
date,
to
but
fill
as
when
quickly
the
as possible.
chart just goes down.
yes, but it will be some months.
Thank you. Banks weathered the shock of the COVID-19 shutdowns mostly because of the fiscal response provided by Congress. We now see a spike in loan delinquencies, an increase in overall risk. Banks are again plowing billions, as many other corporate leaders, always defended by people on that side of the aisle, into stock buybacks, which makes me concerned that if there's a downturn in the economy, banks could end up with too little capital. That's why I'm worried about any potential rollbacks of safeguards or regulations. Can you assure me that the Fed will keep capital requirements strong and exercise more long-term forward thinking than corporate CEOs that seem to be focused on the short term?
I can assure you as to the first part that we'll keep capital requirements strong.
I didn't expect you to comment on give me an opinion about you're looking more forward than companies that look at the short-term benefits of stock buybacks. Mr. Chair, when you last testified, I asked you about the risk posed by crypto assets, stablecoin, the Fed, and other regulated possibilities. How's the Fed evaluating the risks of crypto-related activities by your supervised institutions?
So this is something we've been quite active in this area, and I'll say that we believe that innovation is very important over time to the economy. We don't want to stifle innovation. We don't want regulation to stifle innovation in a way that just favors incumbents and that kind of thing. But like everyone else, we're watching what's been happening in the crypto space.
Yeah,
And
we've got
what we
127
see
here is the low
quite
from
a
over
lot of
here, so we
turmoil.
haven't hit
We
that
see
yet.
fraud, we see a lack of transparency, we see run risk, lots and lots of things like that. And so what we've been doing is making sure that the regulated
So even if it
financial
breaks that,
institutions that we supervise and
if
regulate
it bounces
are
in, we're going to have an
careful,
RSI
taking great
divergence, which
care
is bullish.
in the ways that they engage with the with the whole crypto space, and that
don't
they
get
give us
that
prior
divergence,
notice.
though, then
And
we'll just look for
we've
the next
issued,
support.
along with the FDIC and the OCC, a number of issuances
88 cents down here.
of notices to that effect.
Thank you, and I will close with this. I've long pushed for the Fed to prioritize workers and for the leaders of the Fed to reflect the diversity of our country. We've made progress, but our work is not done. We have a new opening. Understand, it's not your job to appoint the new Fed member. We have a number of upcoming vacancies at the reserve banks. I support Senator Reid from Rhode Island, Senator Menendez from New Jersey, and other colleagues who are pushing for more diverse voices at the Fed. Senator Scott.
Thank you, Chairman. Obviously, the chairman and I both have strong passions about the challenges that we face as a country, the one thing that I do believe that we agree on is the importance of having a strong capital markets as it relates to making sure that Americans have the ability to continue to grow
Any
their
calls?
businesses and
Good for
solve their
earnings.
challenges.
I sold
And
mine.
frankly, I hope that we get there. Building on the same comment that
I'll keep
Chairman
buying
had
leaps
on
as it keeps
capital
dropping.
standards is where I'm going to go with my thoughts today. When I think back on these last few years, it's hard not to recognize the extraordinary efforts our financial institutions of all sizes, frankly, undertook to administer a program like the PPP, all while weathering a shutdown of our global economy. I welcome your thoughts, but from my viewpoint, our banking system was resilient. Our financial institutions stepped up and delivered aid to support families and businesses every single day. That's why Vice Chair Barr's broad comments around holistic review of our capital trouble me so much. We should be laser focused on our economy and addressing the needs of everyday Americans trying to forge a new future and helping them open the door to opportunity. As you and I both know, capital and its quality must be continually scrutinized, but increased capital does not necessarily provide an increased benefit, and requiring banks to hold capital that is not risk-based and appropriately tailored to a bank's size, scope, and activities can cause more harm than good. At a time of record inflation, where everyday needs are more expensive, we should not be pursuing actions that are harmful. Rather, we should be supporting the engine of our economy, small businesses. While I remain greatly concerned by the Vice Chair's comments, I am hopeful that you will ensure this review is appropriate, keeping the impacts on our banking system front and center. We must promote and further the growth of our economy and thereby our people. Anything less should be unacceptable. To that end, will you commit that any ongoing capital review by the Federal Reserve will follow the law and that any follow-on regulatory proposals will be risk-based and tailored to an institution's activity, size, and complexity, and not a one-size-fits-all?
I broke up your VWAP
Yes,
there.
I can easily commit to that. You know, we're very strongly committed to tailoring, and that'll be, I can say that anything we do will reflect tailoring, which is a long-held principle for us and also now a requirement in the law.
Yes, sir. Thank you very much. 2 weeks ago, I sent a letter with Chairman McHenry to Chair Gensler regarding the SEC's climate disclosure rule, urging him to rescind his proposal and reminding him that the SEC is a market regulator, not a climate forecaster. Much like Congress designed the SEC to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation, and not to advance progressive climate change policies, Congress designed the Federal Reserve to promote price stability and maximum employment, not to play politics. To that end, I find worrying the Fed's announcement of recent actions to consider climate-related scenarios, coupled with remarks by the Vice Chair of Supervision, as attempts to incorporate broader ESG policies into the financial services system. Banks have and continue to account for weather-related risks in their risk management, but efforts that attempt to predict climate change far into the future fall outside the scope of their authority. Importantly, the level of speculation required in these models should highlight their arbitrary and capricious nature. At a time when our economy is suffering from historically high inflation, I expect our central bank to focus its time and resources on bringing inflation down, not on policy outside of its mandate. I noted in my opening statement a recent speech that you've given about the state of the Fed and how you should resist the temptation to broaden its scope and to address social issues. Do you agree that the Federal Reserve does not have the authority or statutory direction to use its monetary policy or supervisory tools to wade into the ESG or other climate policies?
I do. As you know, there's a tightly focused role that we do have that I believe that we have, but I would agree with your statement.
Yeah. Mr. Chairman, I have 20 seconds left, but I'm going to defer because of my earlier question to my opening statement.
Thank you, Senator Scott. Senator Menendez is close, but not here yet. So Senator Rounds. Oh, okay. So, but nice try.
Yes, sir. Just want to make sure whatever you say.
Thank you, Mr. Chairman. Mr. Chairman, first of all, welcome It's always good to have you in front of our committee. And as you know, both core and headline inflation have remained persistently elevated. And over the past 12 months, real average hourly earnings fell by 1.8%, about 4% since President Biden took office. To make ends meet as prices increase, more Americans are leaning on credit cards. At the end of 2022, credit card debt hit a record of $930.6 billion, an 18.5% spike from a year earlier, and an average credit card balance rose to $5,805. Over the past year, the Fed has acted aggressively to tame inflation, and yet we are still seeing price increases. And as we've discussed this several times, but I recognize that it's been an ongoing discussion, but I believe that this further proves that we have long been feeling the effects of a policy-induced inflation resulting from decisions by the Biden administration, primarily cutting off the resources necessary to improve and increase domestic energy production. I continue to be concerned that if you attempt to use the tools that are available at this time for the Fed, then I believe that we're going to have a challenge of not being able to address specifically the challenges brought out when you have a policy is promoting higher prices with regard to energy, as opposed to what you're trying to do, which is to bring down the total overall cost. And I just wanted to ask, I guess, and you're going to think this is something that we've heard before, but do you believe that you currently have the monetary policy tools to actually reduce inflation? And I just put it in this perspective. In January of 2021, the CPI was 1.4% when the Biden administration began. In January of 2022, and this is before the Russian invasion of Ukraine, CPI was at 7.5%, 7.5%. Today, March of 2022, CPI is 8.5%. Wouldn't it be fair to assess that a lot of the policy or the inflation that we've seen here may very well be due to policy decisions by this administration?
Senator, not for us to point fingers. Our job is to use our tools. You asked whether we have the tools to get this job done, and we do over time. There are some things that we can't affect, but over time we can achieve 2% inflation, and we will.
In other words, you've got a limited number of tools available to you, and the limited number of tools that you have are designed to impact simply the reduction in prices and so forth, and yet if there are competing interests out there that are pushing prices higher, you don't have the wherewithal to decide one tool versus another based on whether it's policy-induced or whether it is a matter of a shortage in supplies from outside or whether it's war-related.
Yeah.
That's right. Our
Might take
our
us short
tools
on the
essentially
MES
work
here.
on demand, moderating demand, and so that's what we can do.
So if there were policies in place that actually help to reduce inflation, in other words,
just a little
and
one,
by
so
that, I'm just going to
look
look
at a few of
energy
them. I'll
alone,
start
just as a
averaging in
good
here.
example. If policies were in place that were actually allowing energy prices to come down in the United States, then you would have less of a need to use the very blunt tools that you do have right now with regard to increasing rate increases. Is that a fair statement, sir?
In a sense, it is, but I would just say on energy,
I'm not trying to get you to a policy discussion with what the president's doing.
Buying
on
more
his
BBY?
energy
No,
policy. I just want to
I'm
make
pretty
it
well
clear
tapped out.
you have to respond to what's in front of you, and it doesn't matter where the inflation is coming from or what's
But yeah, I
driving
mean,
it up.
this is a
You're
nice,
simply trying
nice
to bring
buy.
it back down to that
127 again
2%
is that
number
low.
with the only tools that you've
It
really
could
got.
break it and then like
yes,
false
but
break.
I will say on energy,
might be the real bottom,
Energy
but,
has tended over time to fluctuate up and down.
could
and
bounce off
it's
of
not-
that. Could
it's
just
not
start
mainly
bouncing right
affected
here.
by
Now
our
we fill the
tools.
gap.
So, the things we look at are are really things that
Finding
are
a floor. I mean, I still see
linked
that
to
engulfing
demand
candle
in the
still
US
holds
economy.
weight to
Those
me.
we
Like
can affect.
And I think
doesn't
just
mean
the
that's
fact
the
that
all-time
you've been
low, but
increasing you've been increasing interest rates.
yeah, I mean, this
and
can
yet
happen
inflation continues
after
to
that.
ride
Still,
up.
it's not
Would suggest, just as you've
not
just
uncommon.
indicated,
This
that
after
when you have
golfing,
high
it would also
energy
just
prices,
rally.
it's
So
tough to impact that
that's why I
part of
didn't
it
wait
with
and
the
expect
the
a
monetary policy
new
that you've
low
got available to you.
necessarily.
So we focus on everything, but we also focus on core in particular, which doesn't include energy prices. And what's happened is core inflation has come down, but nowhere near as fast as we might have hoped, and it has a long way to go.
Thank you. One last question. Last June, Vice Chairman of Supervision Michael Barr testified before this committee that he would defend the use of the aggregation method as an alternative approach to the insurance capital standards, the ICS, proposed by the IAIS. As the final compatibility criteria set to come out later this year, can you confirm that you share Vice Chair Barr's views on this AM?
I will confirm that, but I'll have to get back to you on the status of that.
Okay, thank you. Thank you, Mr. Chairman.
Thanks, Senator Round. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Mr. Chairman, I want to take this moment to remind my colleagues that there are more than 62 million Latinos that call the United States home. We are the largest minority group in the country. We account for nearly 20% of the United States population. We contribute almost $3 trillion in GDP. Yet Latinos have no representation in the Federal Reserve's leadership. In the 109-year history of the Federal Reserve, there has never been a single member of the Board of Governors or regional bank president who has the lived experience of being Latino in the United States. And in practice, that means that the voices of nearly 1/5 of our country's people are repeatedly drowned out when the Fed is making critical decisions on economic policy. Decisions that affect whether a Latino family can afford their first home, find a job that pays a living wage, send their children to college, save for a comfortable retirement, or get a loan to expand their business. Right now, the Biden administration has a clear opportunity to make history with its next nomination to the Board of Governors. It has identified a number of highly qualified Latino candidates who have dedicated their careers to the fields of economics, who are committed to the Fed's dual mandate, who will preserve the independence of the central bank. The administration has rightly nominated and advocated for a number of diverse candidates with similar qualifications, both at the Fed and elsewhere. But despite having 5 opportunities over the past 2 years to nominate a qualified Latino economist to serve at the Federal Reserve, this administration has repeatedly chosen not to. Representation, or lack thereof, does not happen by accident. It is a choice, and I hope the administration makes the right choice with this nomination. Mr. Chairman, would you say that it is
I'm sorry.
a truism that the United States dollar is the reserve of choice in the world?
Yes, I would.
And that brings us enormous benefits, does it not?
Yes, it does.
Now, 12 years ago, a Republican House brought us to the brink of defaulting on the debt for the first time in history of this country, jeopardizing our credit and the world economy. I'm getting a sense of deja vu because, once again, Republicans are recklessly demanding draconian spending cuts to programs that hardworking U.S. families rely on in exchange for allowing the Treasury Department to pay for spending that Congress, including most of them, have already voted to authorize. If you want to talk about spending cuts, it seems to me that the budget is the time to do that, but not to put the full faith and credit of the United States at risk. Chairman Powell, can you talk about the catastrophic damage a debt default would inflict on the economy?
So I guess I will start, if I can, by saying that these are really matters between the executive branch and Congress. We do not seek to play a role in these policy issues. But at the end of the day, there's only one solution to this problem, and that is Congress. Whatever else may happen will happen, but Congress really needs to raise the debt ceiling. That's the only way out, in a timely way that allows us to pay all of our bills when and as due. And if we fail to do so, I think that the consequences are hard to estimate, but they could be extraordinarily adverse, and could do longstanding harm.
Well, I think that's a mild statement of what would happen. I understand. I didn't ask you to engage in the congressional executive branch roles. I asked you about the abstract question of what happens if you have a debt default. Isn't even this constant fight putting into question the possibility that the United States will not honor its full faith and credit have consequences within the economy?
In principle, it could. I think markets tend and observers tend to watch this and tend to think that it will work out, and it has in the past worked out. So it needs to work out this time too.
Now, seeing your testimony before the committee, Is it fair to say that you'll do whatever is necessary to tame inflation?
We serve a dual mandate, and we will do what we can, everything we can to restore price stability while also serving maximum employment.
And primarily that means additional rate increases, would it not? What other tool do you have?
That's what we have. The balance sheet, the shrinkage of the balance sheet will continue too, but it's principally rate hikes.
So the question is, when does that part of doing anything necessary to tame to tame inflation, come into conflict with your other mandate of maximum employment?
Not now, when we have the lowest unemployment in 54 years, and where we have a labor market that is extremely tight, extremely. So, but that time could come, but it really isn't now, where we're very far from our price stability mandate, and in effect, the economy is past most estimates of maximum employment.
Thank you, Mr. Chairman.
Thanks, Senator Menendez. Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Thank you to you and your team for helping to save the economy during the pandemic meltdown. For what it's worth, I'm generally supportive of the actions of the Fed right now, and I'm not going to ask you today to blame anybody. When Congress spends money, it stimulates the economy, does it not?
Well, it would depend on whether that's funded by tax increases or not. But so, if there's a spending that's not accompanied by taxes, would have a net at the margin stimulative effect.
Well, and when Congress borrows money to spend even more, that stimulates the economy even more, does it not?
At the margin, yeah.
Okay. If Congress reduced the rate of growth in its spending and reduced the rate of growth in its debt accumulation, it would make your job easier in reducing inflation, would it not?
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly for the areas of the budget.
All right, let's try to unpack this then. I'm not trying to trick you. You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay. So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate.
There are a lot of.
I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
All right, let me put it another way, okay? The economists did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate
You guys are
of
making me
inflation.
laugh. I'm eating some food.
Am I right?
Yes.
This guy's on
In other words,
0.75.
prices don't go down. They just don't go up as fast.
I had to check my speed there.
Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to reduce inflation.
Now, right now, the current inflation rate is 6.4%, and the current unemployment rate is 3.4%. Now, if history is right, I'm not asking you to again, blame anybody. But if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute. But I think it's undeniable. It's undeniable that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation. Now, I get that you don't want to get in the middle of that fight. But the more we help on the fiscal side, the fewer people you're going to have to put out of work. Isn't that a fact?
Please answer.
It could work out that way.
Sir?
It could work out that way.
Yes, sir. Thank you.
Thank you, Senator Kennedy. Senator Reid of Rhode Island is recognized.
Thank you very much, Mr. Chairman. Thank you, Chairman Powell, for being here today. We saw in the wake of COVID the globalized supply chain disrupted significantly, and we're in the process, in some respects, of rebuilding a supply chain with emphasis on sourcing in the United States. To what extent did that disruptive supply chain contribute to inflation, and to what extent will the new, if you envision it, the new supply chain that is located in the United States and other friendly countries affect inflation?
So the initial outbreak of inflation was all about spending on goods where people couldn't spend on services. So goods spending went way up, and the global supply chain, many goods are imported. The global supply chain just collapsed, and that was the source of the original inflation. It has now spread over the last 2 years to housing and also to the rest of the service sector. So to your question, we are seeing goods inflation has been coming down for some time now. It's still too high, but it's coming down. Housing services there's in the pipeline. You see the new leases that are being signed, and what that tells you is that in the next 6 to 12 months, we will see that come down. But this big service sector that's everything else, which is financial services, medical services, travel and leisure, all of those things, that's really where that's the source of the inflation we have now, which had nothing to do with the supply, or not much to do with the supply chains. That's where the challenge is now.
And is there anything that you can do that would target that service area without affecting the other areas?
There's not really. You know, our monetary policy tools are famously powerful but blunt.
A different topic, and that is, as you're probably aware, the Fifth Circuit delivered a ruling in the Community Financial Services Association versus CFPB that the CFPB's funding mechanism is unconstitutional. Just like the Board of Governors, the CFPB is a bureau of the Federal Reserve. Both the Board of Governors and the CFPB rely on the same source of funds and draw on those funds in virtually identical ways.
0.5 speed
Board
now.
of Governors funding structure would be found unconstitutional, what would the implications be for the country and monetary policy?
Well, it would be very significant, but I have to say we have significant responsibilities, but I would be reluctant to comment on a case that's before the Supreme Court.
But it is certainly something that you've had people examine for possible ramifications.
Yes, and the central banks tend to be self-funding because of the way they work, and that's a key factor of our independence.
We've gone back and forth on the impact of raises on workers, and you've indicated previously that wages have not been spiraling upwards necessarily, and that inflation expectations are currently stable. But the impact on increased interest rates are usually felt more by low to moderate income people. Is there any way you can work yourself out of that dilemma?
So where we are right now, of course, is very low unemployment. Wages have been moderating, and they've been doing so without a softening in the labor market, without rising unemployment, really, and that's a good thing. So we really don't know. The current situation is a combination of more typical supply and demand issues, but also just things that we haven't seen before, like the war in Ukraine, like the supply chains that you mentioned. So we have many unusual factors, and I don't think anybody knows with confidence how this is going to play out.
Thank you very much, Mr. Chairman. Thank you, Chairman.
Thanks, Senator Reid. Senator Brett, Alabama is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's great to have you here today. Over the past 2 years, we've seen the highest inflation of my lifetime, driving up costs for American families across the board. According to the U.S. Department of Labor, the annual inflation rate in 2021 was 7%, and in 2022, it was 6.5%. According to the U.S. Department of Agriculture, the cost of food went up 10% in 2022. And the real effects of that is moms and dads across this nation that are working to put food on the table for their kids, for their babies, had a harder time doing that. This has devastated hardworking Americans, causing a kitchen table crisis in every corner of our country, as the price of food, energy, and housing have all skyrocketed. In response, the Federal Reserve has raised the Federal Reserve Fund rate more than 4 percentage points. Being far from transient, inflation has remained persistent, high, and well above the Fed's long-run goal of remaining under 2%. In the coming year, what factors and indicators are you paying attention to as you and the Federal Open Market Committee decide on whether to increase rates?
So I'd say a couple things to that. First, we're going to be looking at inflation in the 3 sectors that I mentioned: the goods sector, the housing sector, and then the broader service sector. And we need the inflation that's already underway in the goods sector to continue, and that's really important. In the housing sector, we just need the time to pass so that reported inflation comes down, and it's effectively in the pipeline as long as new leases are being signed at relatively small increases. So we'll be watching very, very carefully, though, at the larger service sector, which is 56% of the consumer spending, and more than that of what
you guys are cracking me up, actually.
Inflation.
I had a hard time
so
eating.
That's one thing we'll be watching that very carefully. Also, we raised rates very quickly last year, and we know that if monetary policy, tightening policy, has delayed effects. It takes a while for the full effects to be seen in economic activity and inflation. So we're watching carefully to see those effects come into play. So we're aware of that we haven't seen the full effects yet, and we're taking that into account as we think about rate hikes.
So when you're looking at this, obviously not to get into a policy discussion, but if there were an increase of energy production in this country, do you feel like that would help drive down inflation?
Well, I think over time, more energy would mean lower energy prices. But we are very focused on what we call core inflation, because that is what is driven by, really by demand, and our tools are really aimed at demand.
Right, understood. But I feel like the cost of energy is not just what you pay at the pump. It ends up affecting every good across this great nation. Additionally, I'd like to ask you about labor participation. So when you look at the unemployment rate, and we've heard my colleagues discuss people having to be displaced in order for us to maybe get to the inflation rate that we would like as a nation, I'd like to focus on the labor participation rate. So right now it's 62.4%. If there were an increase in people coming back into the workforce, would that be a positive factor with regards to driving us down to the 2% rate that you would want to achieve?
I think that it would. I mean, remember those people coming into jobs. Yes. That would be great, because the economy clearly wants more people than are currently working. Of course, those people would then spend more, so it wouldn't be a zero-sum game. But it would be great for the country and great for them if they were to come into the labor force.
Amen. I believe that increasing in capital requirements on financial institutions would have a chilling effect on the economy and the availability of financial services. And last week, I joined many of my colleagues in sending you a letter that expressed concerns that if the Federal Reserve decides to conduct a, quote, holistic review of capital standards, as we heard Senator Scott talk about earlier. So is the Federal Reserve concerned that the impact to the economy of increasing capital requirements on financial institutions at a time when inflation remains persistently high would cause an issue?
So I think it's always a balance. We know that higher capital makes banks safer and sounder. We also know that you will at the margin provide less credit the more capital you have to have. But I think it's never exactly clear that you're at the perfect equilibrium, and it's a fair question, I think, to look at that.
And I know out of respect for the chairman and trying to stay in my time, I will just end by saying I heard what you said. Obviously, as you have said, the Federal Reserve is not and will not be a climate policymaker. I just want to thank you for your public statement on that. I agree with you that there's a difference between policymakers and financial regulators, and certainly look forward to working with you in the future.
Thanks, Senator Britt. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again. Let me start by saying, depending on who's asking questions, we're either pounding you for how quickly we're going to drive that inflation back to 2%, or pounding you on making sure that we don't push the economy into a recession and drive up unemployment. I got to tell you, and it's these are maybe not the cheap seats, but I actually think you've done a pretty good job in terms of both ratcheting up rates and then starting to tail off a little bit. I think we all were concerned by the January numbers where it popped up a little bit more. I wish, Mr. Chairman, we were actually having this hearing 2 weeks from now, because we're going to have a lot more data later in this week and next week. But I want to net. We've still got ways to go, and the January numbers were concerning. But I do think your tailored approach. We can all second guess, but I think it has been the right approach. I'm going to commend you on that. I want to get two questions in. One of the areas that I am very worried about is commercial debt. I mean, we've got a Bloomberg story here showing,
That's
we're going
true,
to hit
Justin.
a $6 trillion wall this year on refinancing. Where I'm particularly concerned is the issue around commercial real estate. As we recover from COVID, a lot of things are getting back to normal, but clearly the transformation of where people work is going through a fundamental transition, and I hope people do return more to the office, but lots of folks prefer working elsewhere. That's going to fundamentally change the real estate market on the commercial side, and I do believe we're going to hit potentially a cliff here of a totally unexpected problem in terms of commercial real estate. How are you looking at that issue and recognizing there's lots of bumps coming out of COVID? This one seems to be more unique in
They don't
nature,
have to, but they
and how are you
oftentimes
thinking about
do.
that issue?
So the first one on commercial debt, business debt generally, it's kind of been moving sideways as a percent of GDP. So you don't see a big spike going on or anything like that. However, of course, there are pockets of concern, and particularly you pointed to the refinancing spike that has to happen, and I've seen those come and go before. Generally, markets can absorb them, maybe at a much higher rate this time, but it's something that we're well aware of and watching carefully. In terms of CRE, I would agree with you. The occupancy of office space in many major cities is just remarkably low, and you wonder how that can be. Now, over time, some of that's going to be made into condominiums and things like that, since we don't seem to have quite enough housing in some places. But the question is, what's the financial stability risk? It's not
He's the
great
secret
for the
Warner
largest
brother.
institutions. Don't tend to have a lot of direct exposure to that. Some smaller banks actually do. Medium and small sized banks do.
And we didn't know that gap
Carefully
bill was gonna
monitor
come.
it. We agree that
Oh,
that's
you know that. It's all
an
hindsight
area that
trading.
requires a lot of monitoring, and I'd say we're on the case. So,
Well, that will morph me into my last question, something we've talked about and a lot of my colleagues have talked about with the large institutions. I mean, I do think even some of the biggest critics of Dodd-Frank, I think, would acknowledge our banking system is a heck of a lot stronger and was able to withstand COVID in a very healthy way. But what we've also seen evolve is a vast amount of financial institutions move beyond the regulatory perimeter. The fact that we now have way over half of the mortgage origination coming from non-financing institutions, because a lot of the large entities, hedge funds, other funds that may be doing some of this commercial debt or some of the CRE debt. I'd like you to talk generally in the last 40 seconds or so of how you think about this regulatory perimeter. I'm a big believer, and I know some of my colleagues are, that that we ought to look less at charter and look at
Didn't seem like
same
you had
risk,
much to
same
say today.
regulation, maybe as a guiding principle. And
Was this the guy that was late?
Senator Warren's been working on some work. I've been working on some work around crypto around that area. But there's a
sitting there to
vast
chat with him.
amount of activity that's taking place outside the regulatory perimeter. How should we be thinking about that, and how do we make sure that doesn't create the kind of crisis sneak up that happened in 2008 on the non-regulated side of the house?
I think you articulated the principle very well. It's same activity, same regulation. And that covers crypto and all kinds of other activities. People are going to assume when they deal with something that looks like a money market fund that it has the same regulation as a money market fund or a bank deposit. And so stable coins need some attention in that respect. I just think that's the basic principle. And you're right, so much of intermediation has moved away from the regulated banks really for a long period of time. We got to keep an eye on that.
Thank you, Chair Powell. We can keep looking at it. I hope it's.
Thank you, Senator Vance. I'm sorry, Senator Hagerty of Tennessee.
Thank you, Chairman Brown, and thank you very much, Ranking Member Scott, for holding this hearing. Chairman, it's great to see you again here. I appreciate your presence, and I appreciate the opportunity to talk with you about an item that I'm particularly concerned about, and that's the holistic review that Senator Britt just brought up that Vice Chair Bauer is conducting right now. It's generating a sense that higher capital requirements are on the horizon for us. And as I think about that in the context of what we've weathered, you think about the situation in 2020. It was an acute, real-life stress test, if you will. And I think that our financial system navigated that admirably. In the past, Chair Powell, you've told this committee that our financial system has proven resilient through 2020, and that the capital levels at that point in time, and I would note that those capital levels are at multi-decade highs, are in aggregate adequate.
I was just thinking of
wanted
that.
to follow up on those prior statements and see if you still feel that way.
They lift up their shirt, BBBY to the moon.
I guess I would say it to you this way. In our system, we have a vice chair for supervision who has statutory responsibilities. And when a new vice chair for supervision comes in, generally they're going to want to take a fresh look. And that's what the former one, Vice Chair Quarles did, and that's Dan Chiarullo kind of had the job on an informal basis, and that's what he did. So it's only natural that someone would come in and take a fresh look, and I think that's part of the process. The role of that person is to make recommendations on regulation and supervision to the full board. The role of the board is to consider those when made, and to me, this just comes under that heading.
Well, as the review is underway, and I appreciate that context, one aspect of it seems to us as an apparent willingness to undo the tailoring requirements that were enacted as part of S-2155. And I understand that nothing has been finalized regarding the regulations. It's a concerning prospect if that's the case. The Fed's General Counsel just yesterday
quit today
undoing 2155 by, quote, pushing down the Basel requirements on banks that were intentionally given relief in that bill. So I want to be perfectly clear that the banking regulators themselves can't just simply ignore or selectively enforce the laws. And again, I realize that the details of the study haven't been finalized and made public, but if the proposal put forth by Vice Chair Barr is either unduly aggressive or appears to contradict the spirit of S-2155, will you vote for it?
I can't answer that. I would say we're, as an institution, very strongly committed to tailoring. And anything we do is going to reflect, tailoring of institutions according to their risk. And I mean, that's a principle that we'll stick with.
I think it's quite important, again, given the legislative intent here and the concerns that we maintain that in the face of what General Counsel said just yesterday. I appreciate your perspective in terms of keeping that in place. I'd like to come with my next question, Chairman Powell, with starting the question by underscoring the importance of the independence of the Fed's monetary policy. Right now, the economic picture is about as uncertain as I can remember. We've had large companies in the private sector who are in the midst of planning layoffs and forecasting serious economic weakness in the quarters to come. Yet, on the other hand, the current economic data seems to be robust. Inflation showed some signs of softening in the past several releases. So I just hope, Chair Powell, that you could briefly tell us how you synthesize these seemingly contradictory data.
So just quickly, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. In addition, we had a very strong reading on inflation in January, also a very strong jobs reading, also very strong retail sales. And so, as I pointed out in my testimony, we're looking at a reversal, really, of what we thought we were seeing to some extent, a partial reversal. It's still true. It's still the case that we're seeing progress on inflation. We're seeing goods inflation has come down significantly. There's improvement in housing inflation in the pipeline. There's not a lot of improvement yet to be seen in the largest sector, which is non-housing services. So inflation's running at, core inflation's running at 4.7% on a 12-month basis. I think nothing about the data suggests to me that we've tightened too much. Indeed, it suggests that we still have work to do.
In that context,
hawkish.
thinking about where the tightening goes and when it might, where and when it might happen, where do you see the terminal Fed funds rate landing in this cycle?
So we last wrote down our assessments, individual assessments of that in December, and I think the median range was, basically people were clustered between 5 and 5.5. We're going to write down those again as part of them. We do it 4 times a year. We'll do it around the March meeting, which is on the 21st and 22nd of March. And as I indicated in my testimony, I think the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
Got it. Thank you, Mr. Chairman.
Thank you.
Thank you.
Looks like Bed Bath wants to move back up to
Thank you,
VWAP at
Mr.
least.
Chairman. So the Fed has raised interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but you haven't brought inflation entirely under control either. And maybe the reason for that is that other things are also keeping prices high, things you can't fix with high interest rates, things like price gouging and supply chain kinks and a war in Ukraine. But you are determined to continue to raise interest rates, so I want to take a look at where you're headed. In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan,
more shorts.
Unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
We're in a recession, Warren.
You know, it's not as black and white as very,
Just
very
looking at
infrequent.
the numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this. And,
There have been 12 times that we've seen a 1-point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that. But I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families, and if you're not going to lead that charge, we need someone at the Fed who will.
Senator Vance of Ohio.
Thank you, Mr. Chairman. Chairman Powell, thanks so much for being here. I have a question that's slightly far afield, but how often do you get to talk to the Federal Reserve Chairman, so I might as well ask it. So to give some context here, my family comes from Appalachia. Particularly, my grandparents grew up in southeastern Kentucky, coal country, and then moved to southern Ohio, where I now have the honor of representing all of Ohio. And one of the things that you hear a lot when you study the regional history of Appalachia is it's often described as possessing a resource curse, right? So there's a lot of coal in central Appalachia that enables a certain amount of consumption. Obviously, consumption is good. People need food and medicine and other things. But there's also a pretty good argument that for a host of reasons, it causes malinvestment in the region, and consequently, you have lower productivity growth, lower innovation, and an economy that's much less diversified and much less dynamic. I'm wondering, when I hear about the history, when I think about and read about the history of Appalachia and the resource curse, I'm struck by some of the by the idea that you could make a similar argument about the reserve currency status of the United States dollar. Americans have enjoyed one of the greatest privileges of the international economy for the last nearly 8 decades, a strong dollar that acts, of course, as the world's reserve currency. You know that better than I do. Now, this has obviously been great for American purchasing power. We enjoy cheaper imports. Americans, when they travel abroad, benefit from lower costs. But it does come at a cost to American producers. I think in some ways you can argue that the reserve currency status is a massive subsidy to American consumers, but a massive tax on American producers. Now, I know the strong dollar is sort of a sacred cow of the Washington consensus, but when I survey the American economy and I see our mass consumption of mostly useless imports on the one hand and our hollowed out industrial base on the other hand, I wonder if the reserve currency status also has some downsides and not just some upsides as well. And let me just put a final point on this, and I'd love to get your thoughts on that, Chairman Powell. We're, of course, now the main supporter of a massive land war in Europe between the Russians and the Ukrainians. I read recently, and I'm not going to comment on how perfect or precise these estimates are, but I read recently that the United States is trying to ramp up production from 14,000 artillery shells to 20,000 artillery shells. That's per month, while the Russians are firing 20,000 artillery shells in Ukraine per day. And when I look at the American economy, we have a lot of financial engineers and a lot of diversity consultants. We don't have a lot of people making things. And I worry that the reserve currency status and the lack of control we have over our currency is perhaps driving that. I'd love to get your feedback on that. What are the upsides and downsides of the reserve currency?
That's a big question to try to answer.
You have 2 minutes, today. Chairman Powell, so plenty of time.
I can't even get started on that. So we are the world's reserve currency, of course, and that's because of our democratic institutions. It's because of our control over inflation over many, many, many years. The world trusts the rule of law in the United States, and those are the things. So once you're the world's reserve currency, it's used all over the world in transactions, and it's the place where people want to be in times of stress, is in dollar-denominated assets. Now, so of course we benefit by being able to pay for our goods all over the world, pay for everything anywhere in the world mostly with dollars. That's an advantage. There are some economic theory around that it also has burdens of various kind, but I can't call it all back to mind. But the other thing is, it's a very stable equilibrium, but it's not a perfect one. It's not a permanent one, rather. So there isn't any obvious candidate to replace the United States right now where you can have free flow of capital in and out of the country, where you can really trust the rule of law and democratic institutions, and keeping price stability, which you can here.
Do you think it gives us less control over our own currency, the fact that it's become the world's reserve currency?
Control over our currency. I'm not sure. So essentially what we try to control is price stability. And no, it doesn't make it harder for us to keep inflation under control. The United States has a smaller external sector than most large economies, where it's only about 15%. So mainly what affects inflation in the United States is domestic supply and demand.
Do you think it makes it harder for us to and to fight back against currency manipulation, to control the export and import flows in a way that stabilizes our own manufacturing sector?
Well, I mean, what's important there is really the level of the dollar, and when the dollar is stronger, obviously our wares are more expensive abroad and that kind of thing. But we don't have an opinion on. Matters of the level of the dollar really matters for the Treasury Department and the elected government, not for the Fed.
Thank you, Chairman Powell.
Thank you, Senator Vance. Senator Van Hollen of Maryland's recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here and for your service. I know the Fed is experiencing lots of challenges these days. I've got a couple questions that are just, I think, basic yes or no's, and then some longer questions. Would you agree that changes in the size of corporate profits can be one of the factors that affects the inflation rate?
Yes.
Right. Now, recently we saw that the Employment Cost Index, which, as you know, measures the growth of wages and benefit costs, grew at roughly 4% on an annualized basis in the fourth quarter of 2022. Is that right?
That's my recollection, yes.
So if corporate profits were to decline from the extremely high levels that we saw recently, would it be possible to sustain the 4% growth rate in the Employment Cost Index for an extended period of time, even as we get inflation down to the target of 2%?
Depends on what you mean by extended period of time. So you would not, without a very, very large increase in productivity, which would be great, but that we don't expect, you wouldn't be able to sustain 4% wage inflation over the longer term. Over the shorter term, though, yes.
So over the shorter term, that would not be a justification in and of itself for raising rates. Is that right, in the short term?
Well, I think wages affect prices and prices affect wages. I think we do think that some softening in labor market conditions will be will happen as we try to get inflation under control, and will need to happen.
Right, but that's more a prediction about your efforts to fight inflation. Are you saying that simply looking at the current 4% growth rate in the short term is an excuse for jacking up interest rates?
I think what I would say is that the overall, all the data we look at in the labor market, including not just that measure of wages, but others, also unemployment, also participation, also job openings and quits and things like that. All of that, you put that into the picture, and I think you see a labor market that is extremely tight and is probably contributing to inflation. I've never said it was the main cause.
Right. I think the larger point here, based on your response to that first question about growth in profits, is corporations have a decision as to whether or not they're going to pocket more for profit, which they can, or provide higher wages to their employees. And if you actually lowered your profit margins, you could sustain a higher wage increase without violating the 2% inflation. Isn't that right?
Yes. I mean, when I hear profit margins, what we're seeing in the economy is pretty much about shortages and supply chain blockages. And when there's not enough of a product, what happens, and there's a lot of demand, what you see is prices going up. As the supply chains get fixed and shortages are alleviated, you will see inflation coming down. You'll see margins coming down, and that will certainly help with inflation.
Right, but profits are the margin, right? They're going up beyond what they were before. That means that even with the increase of costs because of supply chains, they're making more profits. Which again, that they can do that. But my point is that as a contributor to inflation, as you indicated in response to the first question, let me ask you about the tight labor market because one of the issues in a tight labor market is parents with kids, including a lot of moms who would like to go back into the market, but are not able to do so because of lack of affordable child care. The other issue is immigration, and I know that you've gotten some recent data on how some immigration figures
the dude in the middle is like, "Can I go to
have
sleep?"
softened a little bit the tightness in the labor market. Can you just talk broadly about those two factors, affordable child care and immigration, more legal immigration, and how they could affect labor force participation and therefore also reduce inflation?
So on the first, we don't make recommendations or evaluate fiscal policy, but I will say there's research that shows that it helps keep women in the workforce when there's child care available, which is, I think, kind of self-evident. The second was
impact of immigration.
Immigration, yeah. So what I talked about with you is actually as part of the January Bureau of Labor Statistics report, which comes the employment report for January, which comes out in early February. There is a section in there about more people. The Census Department has increased its estimate of the workforce by something like 870,000. And a significant part of that has been immigration. So, and that has moved up participation by a little bit, but it may be part of why we're hearing. It may be part of why we're hearing from in the labor market that the really intense labor shortage pressures that we were hearing about in 2021 and 22 may be alleviating. So that would contribute to that. Clearly, more people. Clearly, the economy is calling for more people with essentially two job openings for every unemployed person, and this can be a source of those people.
Right, and that would reduce the tightness of the labor market and reduce pressures on inflation, right?
May already be doing so.
Thank you.
Senator Kramer of North Dakota is recognized.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I can't resist responding to a few things that my friends on the left have said. For example, in his opening statement, Chairman Brown had a long list of things that raising interest rates won't do. Raising interest rates won't fill in the blank. I'm going to fill in the blank with a couple things. How about raising interest rates won't stop Senate Democrats and President Biden from overtaxing, overspending, overborrowing, overregulating? Chairman Brown said we should rebuild our supply chain by curbing offshoring, corporate offshoring. I agree. He talked a lot about corporate greed contributing to inflation. Okay. But how about regulatory greed contributing to corporate greed? How do you expect corporations to reinvest money if you overregulate their ability to invest that money right here in the United States of America? You want to onshore some things? How about energy policy? How about instead of looking to Venezuela or Iran for oil supply or Russia, or rather than looking to China for electric vehicles and chips and solar panels, how about we have a strategy that onshores those things by reducing regulation, reducing taxes, and letting those corporations reinvest their profits rather than stock buybacks or dividends. This idea that somehow the Federal Reserve is supposed to keep inflation in check while half of the government works against it is mind-boggling. Now, I know, Mr. Chairman, you don't like to comment on policy. You and I have been around and around about this. You were anxious to advise us to spend lots of money during the pandemic. I don't think a lot of people blame you for that. You wouldn't respond to efforts by the Biden administration after we were in a robust recovery from not spending so much money. Okay, I can appreciate the change. But now we're in this debate between Republicans and Democrats, between particularly the House Speaker and the President, on how to raise the debt ceiling. And you've made some pretty strong comments about raising the debt ceiling, absent from structural reforms that would actually help us get back to a reasonable growth. So I warn you again, if you're going to make political comments, if you're going to advise us on policy, be consistent with it. Now, I want to get back to the greening of the Federal Reserve. And these, I call them stress tests, you can call them whatever we call them. But I'm concerned that now the Federal Reserve is starting down this path. Maybe it's slightly at first about climate stress testing. I just want to ask you this. If we're going to go down that path, if the Federal Reserve is now going to become part of the Federal Climate Police Force, are we going to consider the ramifications of having entire communities and economies, factories and manufacturers, whatever, energy entities, large server farms, leaving them susceptible to a very unreliable, very expensive energy source? Is that part of the stress test?
No, those are considerations for elected people, not for us. We have a narrow role to play here, but it's a real role, and I can talk about that if you'd like.
Well, yeah, I would like you to, because again, if we're gonna start doing stress tests for the 6 largest financial institutions related to climate, which really is more weather than climate, then are we going to consider the effects of an unreliable energy source at several locations throughout our country?
So our only focus is on the safety and soundness of these institutions, and do they understand and can they manage all of the risks that they run in their business model. That's our only goal. We're not looking to be climate policymakers. Climate policy is clearly going to have effects on regions, on companies, on individuals, on countries, disparate effects, and that is not for unelected people like us who have a narrow mandate. But I think it does touch climate, and you're right to be concerned that we find ourselves on a slippery slope. But honestly, I think the climate scenarios are something that the banks are already doing and themselves, and the climate guidance is something that they're looking for. They want to know how we're thinking about this, but we will try really hard not to get on a slippery slope and find ourselves becoming climate policymakers. It's just not appropriate for an independent agency.
Okay, and I completely agree, and I hope you stick to that. And I think you ought to, ask the banks to consider what the overreaction might, what kind of vulnerabilities that might expose. With that, with regard to what Senator Warren was saying on her monologue, one thing about ideologues, they have the luxury of binary choices. You have a really big job, and you have a single, in my mind, one and a half, maybe two missions. I think the first one handles the second one okay, but it's got to be tough when the White House is working against you and you don't have to comment. Thank you. Thank you, Mr. Chairman.
Senator Tester of Montana is recognized.
Chair Powell, thank you for being here today, and thank you for serving in this critical role at this critical time. I have talked many times in this committee, and I, especially right now, cannot overstate the importance of the Fed's independence. I said it in the previous administration, I say it now, we cannot be playing politics with our economy, and that is a fact. From a climate standpoint, I would just tell you it's entirely artificial right now anyway, because if you look at the hundreds of billions of dollars this country puts out every year in disasters due to climate instability, we ought to be asking our question, is that sustainable? Because quite frankly, it has to be done, and I don't think it's sustainable. So we've got to start looking for some solutions on the climate side sooner rather than later. The Reserve has a tough job, and I really appreciate
Did fill that gap.
How you've done it.
It's real close to that low.
Reasonable,
127.
working together, making hard decisions for the good of the economy. We have to get this right. So the question is, how much has inflation
Maybe a little more
decreased since its peak?
Or rip.
It depends on the measure, but it's
Kind of bear flying down here.
at least a couple
Below the
percentage
low,
points.
so
Okay, and has unemployment
Seems like it might come
gone
more.
down as inflation has gone down?
Unemployment has gone down. Yes, it has, to now a 54-year low.
Yes. So the question becomes, and I always think back to in 1998, I bought some property, and the interest on that property was 10% in 1998, and I thought I got a hell of a deal, by the way. I thought it was just great. But the truth is interest rates have been artificially low for the last, 20 years, probably? And the question becomes, as you look at the economy and as you try to make the determination whether the inflation is caused by demand or supply, where does all that fall in to you, your decision-making moving forward?
Well, you mean the level of interest rates. So in theory, there's this thing called the neutral level of interest, and we know it only by its works. And neutral is the level that
profit taking.
either pushes the economy
Wait
up
for
or
consolidation
holds it
and
down. And it changes over time. This is the thing about these
momentum back
these
to the upside.
important
So we
variables
find
in
support.
economics.
Has a couple
So
gaps
what's
down here.
happened
I don't think
until
it's
now
done.
was that the
Probably
neutral
selling
level of
off
interest went
for
down
now.
and down and down to the point where, many countries had zero interest rates and very low inflation. Now we have this shock, a series of shocks associated with the pandemic, and we have rates at 4.5%, our policy rate, and we have the labor market very strong and inflation reacting somewhat, and it does raise the question of where's the neutral rate. Honestly, we don't know. I think we look at the current situation and we see that there's not a lot of evidence that, hard to make a case that we've over-tightened. It means we need to continue to tighten. I think we're very mindful of the lags with which our policy works. We don't think we need a significant increase in unemployment, and we're certainly not aiming for one. But we do think there'll be some softening in labor market conditions to get to 2% inflation.
When you're looking at interest rates, I know we talk about energy prices here and the price of gasoline, and then if you go over and Europe is much, much higher. Are we comparable? I'm just curious. Are we comparable with our interest rates here as with, say, Europe?
We're very close to where Canada is. We're a little bit higher than where Europe is. Europe's traditionally had much lower inflation. They now have very high inflation, and they're still increasing rates, but they're a bit lower in terms of rates.
So if we do not get the inflation under control, and like I said, I think the steps you've taken have been reasonable and measured. If we don't get it under control, what is that really? What are the impacts of that?
Well, the social costs of failure is one way to think about it, are very, very high. So if inflation were to continue, at some point that will become the psychology. People will come and businesses will come to expect high inflation, and that will make it more self-perpetuating. That will mean an up and down economy. It'll mean it'll mean something that looks more like what we've seen in periods of high inflation. Capital allocation is difficult in a world like that. It's not a good time for the economy. What we want to do is restore price stability firmly back at 2% so that we can have the kind of strong labor market for a sustained period that we had before.
Once again, thank you for your work. Thank you for your independence. Senator Daines.
Thank you.
Thank you, Senator Tester. I'll be handing off to Senator Cortez Masto when I'm finished up as well. So, Mr. Chairman, good to have you here today. When I
I think
Back
it'll
in
go
Montana,
up
the
and down
number
from this
one
price.
issue I hear, certainly
This is
across the
absolute
state,
bottom?
is the
I
high
don't know.
cost of gas,
Maybe.
the high cost of groceries, and overall how their
I don't think so.
paychecks are shrinking because of
Breaking that
inflation.
head and shoulder, inverted head and shoulders.
It's a
was
crushing blow.
not good from
It has
yesterday.
real life
Kind of what I was saying, but
impacts. It's top of mind issue.
not to say that
for
we're not close to the low.
It's also
This looks like a
important to
bear
note the
flag here
devastating
below this
impact it's
support.
gonna have on our nation's
127's that
economic
last
In
level
fact,
there,
in
and then after
October
that,
last year, I sent a letter
there's
to
just levels
Congressional
from like when I
Budget Office
IPO'd.
Director Swagel
88 cents
regarding
is like
the
all-time
impact
low,
that
so that's
high
why I put that in there.
inflation and the elevated interest rates would have on the cost of servicing the federal debt. His response painted a less than rosy picture.
I'm not trying to time it really
Then we
anymore,
got the
unless
CBO's
maybe it breaks
updated 10-year
that
baseline
127.
forecast in
It doesn't
February.
bounce
And it confirmed the truly dire situation that we find ourselves
because
in.
it's. I feel like it's
Driven by
pretty much
interest
near the
payments
lows.
on the debt.
I'm just sitting
The
tight. Probably
CBO
cover
now
calls close to the
projects
money.
cumulative deficits during the 10-year window, and I recognize where deficits come from. It's irresponsible spending here in Washington.
Put a level right here on the
But
IPO high.
cumulative deficits during the 10-year window will exceed $20 trillion.
Not sure these levels will
Deficit.
mean
I'm
much
talking the
this
debt because it's going to grow
this long
the
ago,
total
but
federal debt to more
1992.
than $51 trillion by 2033. Now,
Spy's new
2033
low.
used to sound like a long ways away. We're 10 years away. 10 years goes by very, very quickly. Within 5 years, we're going to spend more on annual interest on the national debt than we spend on national defense. You think about that for a moment. And these are coming out of the CBO. These absolutely shocking, but quite frankly, predictable projections go back to a debate we vigorously had here in the banking committee. I remember when Lawrence Summers, of course, former Secretary of Treasury under President Clinton, economic advisor to President Obama, he warned us. He said, he was practically warning my colleagues across the aisle, says you can't move forward with these purely partisan, at that time a $1.9 trillion spending extravaganza. We had $1 trillion of unspent COVID money in December of 2020. And that passed on a purely partisan vote. We said it's going to start to ignite the inflation fires. So I certainly hope the president's budget, which we expect to see later this week, will propose pro-growth
I mean, an uptrend
policies that can get us out
for
of
me. The
this
TA looks like
mess. And I would
bullish
argue,
MACD on the daily, green over the 9.
almost an existential crisis.
So yeah,
of
if
what's
you
gonna come at us here, of course,
try to wait for
next 10
momentum,
years
then
of
that's
debt
what you
and
wait for.
service on that debt.
And that might not happen
Unfortunately,
until
as the
the
president
price
said
is
in
at
the State of the Union address, the
175
president said
or
he's going to raise taxes. That's a recipe for
yeah.
disaster. It's going to crush
So
productivity.
the buy on the engulfing candle is
stifle economic growth
somewhat
even
of a
further.
trying to time close to a bottom.
I want to turn to my questions now.
Yeah, they
Chairman
can sting
Powell.
at times because you don't get the
You're
bottom,
raising
which
interest
why
rates
typically I'd wait for
combat
momentum. But
the inflation
I've been scaling
we've
in.
seen the economy over the past
That was
few
my
years.
first
Is
sign
that
of a
correct?
bottom forming.
Yes.
And although
But yeah,
this is the domain of
MACD to flip
Treasury,
bullish,
a
green over the
higher
9 moving average.
Fed
So
fund rate
not there yet.
will mean higher borrowing costs. Is that correct?
Yes, all else equal.
So I just want to connect the dots here around inflation was sparked. One of the big reasons was massive spending here in Washington.
Crazy, yeah. You could, scale in,
Now
just get an
we're
average.
Bearing the challenges with higher.
We filled the
debt
gap, so
service
no more
over the
gap to the
course of next
downside.
Several years where we're going to see debt service exceeding defense spending, which is we see the threats of China, threats around the world. I think it's very, very concerning. Now, as a grandfather of 4, soon to be 5 grandchildren, this is things you think about more and more as you look forward. I want to change here and talk about American energy. When the war in Ukraine broke out, many feared that Russia would cut off natural gas exports and cause energy inflation to spike. Prices didn't spike as much as anticipated, due in large part to the fact that American companies stepped up to the plate. As of late last year, the European Union now receives more liquefied natural gas from the United States producers than it does from Russian producers. And that's a good thing for the world to see more U.S.-produced energy. Chairman Powell, do you believe that European
gap. Time
and
to wrap.
American inflation would be manageable if not for American energy producers?
I certainly think that particularly our natural gas assets have helped Europe make the transition.
any sense of how much worse the global energy picture would be if you would imagine a world where we're not producing and shipping energy to other countries?
It'd be hard to estimate.
Probably worse.
Yeah, I mean, I think it's been clearly
Hey,
Europe
Jan.
has managed better than expected, and a part of that story is just U.S. energy experts. Also, the winter wasn't as bad, and the Germans made some good decisions.
Yeah, we made some prayers that says we need to pray for a warm winter for Europe, and I think they got one, which was something that's been helpful. I'm out of time here. I'm going to send this back over to Senator Cortez Masto.
Thank you. Chairman Powell, it's great to see you. Thank you so much. I know it's been a long morning. Always appreciate you coming to talk with us here on the committee. I want to first align myself with the remarks from Chairman Menendez supporting a Latino nominee to the open seat on the Federal Reserve. It's been more than 100 years, and a Latino has never served on the Federal Reserve Board. And I know there are many strong Latino economists and economic experts who would capably serve. So I want to put that out there. Chairman Powell, I also sit on Senate Finance. Right across the way, we are talking about affordable housing. I think for purposes of so many of us across the country, including in Nevada, when we talk about affordable housing, it's also about workforce housing. It's about making sure families that are working so hard have an opportunity
Self-cover
to keep
calls
a roof
on it.
over their
Pay
head.
the bills
Right
with the
now
data
in Nevada, if you're
farm.
making minimum wage, you have to work 75 hours a week just to be able to afford housing. And so I want to talk to you about this. I was distressed to see in the report that that activity in the housing sector has contracted
Hit
as
the
a
like.
result of the elevated mortgage
Oh,
rates.
thanks for your likes,
We've been
guys.
talking
39 of them.
about
Well
that.
done.
I often hear from
It's been
Nevadans
fun
who say,
listening
I don't
this
know if
morning.
I'm ever going to own a home, and many feel resigned being stuck in a cycle of renting. So, Chairman, how do the Federal Reserve economists and leaders think about the balance between keeping interest rates low to spur that affordable home building and home buying while addressing inflation?
We have a dual mandate from Congress, as you well know, which is maximum employment and price stability, and that's really what we take into account. We don't, and of course, interest-sensitive spending is the thing that gets the most support when we cut rates, and the thing that is most affected when we raise rates, and that means housing to a significant extent. That's not a choice that we make. That's just the way it works, and we only have really one tool, which is monetary policy. So, you know, we don't really try to use our tools to affect broader housing policy, but really just to achieve our statutory goals.
It happens to just unfortunately be in effect as you try to achieve your statutory goal. Is that?
Yes.
Yeah.
Yes.
And so I want to have you have the opportunity to address Senator Warren's conversation with you earlier about the tools that you have and the impact it has on causing potentially more people to be unemployed, and this obviously has an impact on their ability to afford homes as well. Can you address that?
I'd be glad to. I want to be clear that we do not seek, and we don't believe we need to have a very significant downturn in the labor market. And it's not just
I'm
hope.
not seeing
I think if you
divergences.
look at the
Based
situation
on
in the
the
labor
4-hour,
market, you've got
the daily, yeah.
all these job openings, and in principle, you could reduce the job openings without
Or the
seeing
1 hour.
a really significant increase in unemployment. Also, you're starting from such a strong labor market. It seems as though you're a long way away from anything that looks like a recession, just looking at the labor market by itself. So
Diverges from
honestly,
back here, I
we
guess.
don't
Here.
know
But
that
not
we
with this
need
low.
that there will need to be a really significant downturn. Other business cycles had quite different backstories than this one, and we're going to have to find out whether that matters or not. But I do think that, and I've said all along, and my colleagues and I have too, that we believe that we can. There's a path to restoring 2% inflation with less significant effects on the labor market than have typically been seen in downturns.
And for purposes of the general public, the people, Nevadans that I know that are struggling, we have one of the highest, we've talked about this, and thank you for always being willing to talk with me. We have one of the highest unemployment rates in the country. Our service sector was hit so hard. We're still at over 5% just in southern Nevada. We have high gas prices. We have grocery prices. We have housing prices that are high. So one of the things that you have commented on, and you just did again, but I know it was in your opening remarks, that, and it's quoted right here, and let me just say, you say our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. For the general public, for those working families and people, why 2%? Why is getting it to 2% so important?
So that has become the globally agreed, essentially all major central banks target 2% inflation in one form or another.
How does that help my Nevada families? How does that help people in Nevada?
I'll tell you how it does. And it's I guess it's obviously not, it's not obvious how that is, but 2% inflation, to have people believe that inflation is going to go back to 2% really anchors inflation there, because the evidence is and the modern belief is that people's expectations about inflation actually have an effect on inflation. If you expect inflation to go up 5%, then it will. If everyone kind of expects that, because that's what businesses and households will be expecting, and it'll kind of happen because they expect it. So having a 2% inflation goal, which we had for many years, de facto we had it, then we formally adopted it in 2012. But for years before that, we were effectively targeting 2% inflation. And what that meant was that inflation, it's one of the reasons why inflation was low and predictable, is having a real target and sticking to it, not changing it, at convenient moments. So we think it's really important that we do stick to a 2% inflation target and not consider changing it. We're not going to do that. It just is, people will be better off if the whole question of high inflation is just not part of their lives. That's kind of the definition of price stability. It's if people live their lives without having to think about inflation all the time.
Thank you. I notice my time is up. Thank you so much, Senator. Senator Lummis.
Thank you very much, Madam Chairman, and welcome, Chairman Powell. When you're setting these rates and making these decisions and seeking that 2% magic number, are you considering the cost of borrowing for the United States, knowing that Congress has over-borrowed and that we have overspent and that the national debt is at now at least 97% of GDP, and that we're going to face challenges of our own making? This is not about what the Fed has done. This is what about the Congress has done that you have to factor in to your decisions. Do you think about the costs of borrowing for the United States itself?
No, we do not, and we're not going to. In other words, that would be fiscal dominance. If we were, constrained in our monetary policy by the budgetary situation of the United States, and we're not. We're clearly not. The path we're on is not sustainable, but the level of debt that we have is not unsustainable. Is sustainable. Put it that way. So we don't think about interest costs when we make monetary policy. We think about maximum employment and price stability.
It's your opinion that the level of debt we have is sustainable?
Yes, I mean we have the the largest economy in the world. We can service this debt. That's not the problem. The problem is that we're on a path where the debt is growing substantially faster than the economy, and that's kind of by definition in the long run unsustainable. And the way countries have gotten fixed that is with longer term programs that have bipartisan support and that address the actual problem in the budget. That's really the formula.
Thank you. I'm going to switch to stable coins. You're a member of the President's Working Group on Financial Markets. The working group called for bank-like regulation of stable coins in late 2021. Then on January 3rd of this year, in a joint staff statement, the federal banking agencies stated that even after the bank's capital, BSA, AML, and risk management, a bank issuing a stable coin on a, quote, open, public, or decentralized network is highly likely to be inconsistent with safe and sound banking practices. I'm going to say that again. Even after a bank's capital, BSA, AML, and risk management, a bank issuing a stablecoin on an open, public, or decentralized network is highly likely to be inconsistent with safe and sound banking practices. So I'm a little confused about where we're heading on stablecoins.
I wanted to bounce
Does
the VWAP to go
the
short again,
January
but
3rd statement mean that the
I didn't
Fed
get
has decided that stablecoins on a permissionless distributed ledger have no place in banks?
So I think that there are real concerns about permissionless public blockchains, and the reason is that they've been so susceptible to fraud, to money laundering, and all of those things. So I think what you heard from the federal banking agencies in one of their reports was that they would tend to look at those as not consistent with safety and soundness.
And what about properly regulated stablecoins? Do you think they could have a place in our banking system?
I certainly think that in a world of appropriate regulation, where the same activity, where stablecoin activity gets the same regulation as comparable products in different places, then there certainly could be a place for stablecoins in our financial services sector.
Thank you. The European Union, UK, Australia, Switzerland, Singapore, and others have all moved over the last few years to create a legislative framework for digital assets. The European Union in particular is attempting to be a standard setter again, like it was with its data protection rule. Is the United States in danger of being a rule taker, not a rule maker, when it comes to digital assets?
I do think it would be important for us to have a workable legal framework around digital activities. I think that is important and something Congress, in principle, needs to do, because we can't really do that.
Yeah, thank you. Senator Gillibrand and I agree with you. One area we've already seen is in the Basel Committee on Bank Supervision. They propose prudential treatment for crypto assets framework, setting forth banks' capital standards for digital assets. The Basel Committee's framework does not impose a capital charge for digital asset custody, whereas the SEC's Staff Accounting Bulletin 121 imposes a prohibitive capital charge through the back door and places consumers at risk in bankruptcy. Similarly, the Basel Committee framework allows banks to issue or hold digital assets on their balance sheet if the requisite capital is set aside. So back to January 3rd, 23, the Fed and other bank regulators have said that it is forbidden for a U.S. bank to conduct these activities no matter the capital. So my question is, what does the rest of the world know about digital asset regulation that we do not, that the Fed does not?
So as we discussed, this is an SEC staff accounting bulletin, and it's not something that the Fed issued, and I'd be loath to comment directly on it.
The issue is, and what concerns me, is that the Fed and other federal banking agencies are not following international norms on digital asset regulation. That's just my comment. Thank you, Chairman Powell, for being here. I now recognize Senator Smith.
Well, thank you. And Chair Powell, it looks as if Senator Britt and I are the last people standing at this committee hearing. Thank you for passing on the gavel to Senator Lummis. And I want to thank you for your service and for our recent conversation. And before I get into my questions, I would just like to note there's been a good back and forth amongst our committee around some of the big economic challenges and opportunities that we face in this country. And I would just like to note that the programs and the spending that the ranking member and some of our colleagues have blamed for inflation provided critical relief that kept working families and small businesses afloat during a global pandemic. And in fact, many of these policies were passed on a bipartisan basis and signed into law by both Republican and Democratic presidents. And I also just want to add that the laws that the Democrats passed to lower prescription drug costs and healthcare costs and to lower energy costs for Americans are helping to lower basic costs for families, all of which, by the way, was fully paid for. So I return, Mr. Chair, to what you have said to me privately and to all of us publicly, which is what we ought to be looking for is striving for bipartisan solutions to find a path forward. And in fact, Senator Lummis and I were just talking about this yesterday when it came to housing policy. So Just want to put that out there. When you and I spoke yesterday briefly, we talked about the Community Reinvestment Act, and I know that
Instead of
I
BBY
appreciated
going
the
up to
chair,
VWAP,
raising this
VWAP will
point
just come to
earlier
down,
in the
come down to
hearing.
BBBY.
And so, but I want to just return to that briefly. I am very
This is
glad
the
to
way.
see it's been about a year since the Fed and the OCC and the FDIC issued their proposed rule to modernize implementation of the Community Reinvestment Act. I don't think that the proposal was perfect by any means, but it does make really important improvements to how, through the CRA, financial services organizations can serve and meet the needs of communities that are full of assets but lack the resources to make it happen like wealthy communities can. So I think, Chair Powell, you indicated that you expect this new CRA rule to be finalized in the coming months. Is that what you indicated?
Yes, that's right.
And can you just tell us, with the departure of Dr. Brainerd, who will be spearheading the CRA efforts?
So I've asked Vice Chair Barr to be responsible for moving the project forward. Of course, it has to go to the whole board,
right?
And everyone gets a vote on that. But he'll be pushing it forward.
That's great. Thank you. I was glad to see that disaster preparedness and climate resiliency were added to the definition of community development activities that would be eligible for the CRA credit. And this is important, of course, because low and moderate income folks and the communities that they live in often face some of the worst impacts of climate change and extreme weather events. This isn't social engineering. This is dealing with the actual costs and challenges that people experience because of climate change. So, Chair Powell, can you talk to us a little bit about how you see that change and how it fits with the CRA's overarching objectives?
So I think it fits for the reasons that you said. Honestly, I'm a week or so away from getting a briefing on where the proposal lies, so I'm reluctant to touch on. I mean, I'd rather wait till after I'm fully briefed on where that agreement came out, after the FOMC meeting. So.
Thank you. That's fine. I'll look forward to continuing this conversation with you and with Mr. Barr, and just appreciate this. I think, my view of this is that climate change and the economy are inextricably linked, and the reality is that climate-related action or inaction has a direct financial impact on people and our economy. I was wondering if you would just be willing to update us briefly on some of the next steps that the Fed is going to be looking at as you evaluate the resilience of financial institutions with respect to climate risk. There's this pilot project that just was started in January, I think it was, of this year, and I'm curious to know how you see next steps there.
So we're doing really two things. One is
Greta Thunberg.
Doing a climate stress scenario, which the banks are already doing, the large banks, the 6 that we're working with, and that's really just to begin the process of understanding the risks that are associated with this over the longer term. They're already doing it, and it's something that there's a lot of learning going on around the world, actually. The other thing we're doing is providing guidance. The banks want clear guidance. They actually want one set of rules globally. The big banks that do business around the world, they're hoping that they aren't in a world where there's just different regulatory regimes everywhere they go. So we're kind of working on that as well.
Great. Thank you very much, Mr. Chair.
Thank you.
Thank you, Senator Smith. Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, thank you for being here. In your opening statement, I was here for that. I think you touched on some of the interest rate sensitive components of GDP and non-interest rate sensitive components of GDP. I think you said that we do have a concern in the latter group, inflation expectations, labor market tightening, et cetera. Can you tell me a little bit about how you're looking at the interest rate sensitive and non-interest rate sensitive readings, and whether the Fed, what sort of Fed actions can take place to avoid a zero landing?
Sure. So on the housing sector, of course, is interest-sensitive spending is the thing that they're very directly affected by our policies almost right away. And the poster child for that is housing. And so you've seen mortgage rates now go back up over 6%. You've seen housing starts come down. Activity in housing has declined as people are reluctant to get out of their the low rate mortgages they had before. So housing activity is slowing down.
No, it's not permanent.
On the other hand,
Biden,
housing prices went up in the
recommend-
aggregate more than
he's
40%
elected.
since the beginning of the pandemic. So we may be seeing some price correction on that too. So that's coming along. And housing inflation, which is a big part of the CPI, a little bit smaller part of the PCE, the inflation measures we follow, or we rely on, that will be coming down because of the slowdown in the housing market. I guess I would say the service sector is probably less interest sensitive than that, and that's restaurants, it's travel services, travel and leisure, it's healthcare, it's financial services, healthcare services, all those services, and that's a big part of our economy. This sector is 54%, I guess, 56% of consumer spending on non-energy and food. So it's very important, and it's about having a little bit softer demand and about having some softening in labor market conditions, we think. Our tools will work on that, but we do expect that will take time.
Thank you. I know the chairman in his opening comments mentioned a belief, I don't want to misquote him, but a belief that we have too little capital in the banking sector. May be true of a couple of banking institutions, but how do you feel about the current capital that our broader banking sector, irrespective of where they are in size? What concerns, if any, do you have about the capital that we see out there already?
So I supported all of the capital raising that we did. I joined the Fed in 2012, and we were in the middle of implementing all those Dodd-Frank increases, and I supported all of them. After careful thought and discussion with my colleagues, I think the new vice chair is doing what new vice chairs do, which is to take a fresh look and ask the question, even though I think we all agree capital is strong, certainly the vice chair does, the question is it at the right level? And I think that's what happens with a new vice chair for supervision. We don't have any proposals yet, but at some point we will.
Yeah, I'm going to be meeting with the vice chair, and we'll drill down on that topic. But I do know, I was over in Finance Committee, so I wasn't here, but I do know that several members, well, first off, we know that Vice Chair Barr is looking at a holistic review of capital requirements. I think that's a good idea. But I have to ask a question. Do you think, does the Fed consider the bipartisan passed Senate Bill 2155?
You mean the barcoding? I don't know. I think it's just penny stock, algo barcoding.
The superior to any of
It's
the
how penny
Basel
stocks look.
requirements or any holistic review process? In other words, it is the law of the land.
For whatever
How does
reason.
that weigh into how these reviews go?
So 2155 was, I think you're talking about tailoring. So Dodd-Frank actually called for tailoring, and what 2155 did is it said change may tailor to shall tailor, and it also changed the thresholds.
Yep.
But tailoring is an absolutely bedrock aspect of our bank regulatory system, and anything that we do is going to reflect what we think is appropriate tailoring between the different sizes and risks of the financial institutions that we supervise and regulate.
What we were trying to accomplish as a part of that, I don't expect you to respond, I know that we're coming to the end of the hearing, is that a holistic review of a financial services institution is going to reveal the fact that many of these financial institutions are very different based on the activities that they're most involved in. And those sort of holistic reviews may actually result in increasing capital requirements for two banks that look like peers, but not for another because of the inherent risk associated with their business focus. Does that make sense?
To your earlier point, though, the law, the Dodd-Frank language, and as amended, actually requires that we take those things into consideration. So we certainly will. We will.
Thank you.
Thanks, Senator. Senator Warnock is recognized from Georgia.
Thank you so very much, Mr. Chairman. Before I begin my questions, I know that this committee will soon consider a new nominee to serve on the Federal Reserve Board of Governors. And while it has not historically been the case, it seems to me that the board should reflect the diversity of our nation, that those things are connected, policy and representation are connected. And I hope that we will see sitting before this committee a nominee that pushes us closer towards our ideals of e pluribus unum out of many one. And I support Senator Menendez and others who have called for a diverse nominee, specifically the fact that we've never had a Latino person serve on the Federal Reserve Board. I think it's a huge oversight, and I hope we can move quickly in that direction. That said, my state of Georgia is in a housing crisis. Like much of the country, the Federal Reserve Bank of Atlanta has designated owning a home in Atlanta as unaffordable to the average home buyer. But this is not just a city problem. Harris County, Georgia, with a population of less than 35,000 sitting on the border of Alabama, is also rated as unaffordable. In the midst of this housing crisis, the Federal Reserve continues to raise interest rates. This makes mortgages a lot more expensive for families, especially young families looking to buy a house. According to the National Association of Realtors, the share of first-time home buyers is at an all-time low, while the average age of a purchaser is at an all-time high. Chair Powell, you have said that there has been, quote, an imbalance in the housing market. But if you're a Georgia family, parents in the mid-30s, young children, and all you want is to be able to afford your first home and place and build equity to one day pass that equity on to your kids, how are the Fed's actions helping that family afford a home?
Our mandate is to provide maximum employment, use our tools to foster maximum employment and price stability. And we're using those tools really now to restore price stability at a time of the highest inflation in 40 years. I think that the same people who are having high mortgage costs, if they have a floating rate mortgage, are also experiencing high costs for all the basic necessities of life. And one of our most fundamental roles at the central bank is to keep price stability. So we have to prioritize that in what we do.
Yeah, I understand the tools and the mandate, but my concern is that we could have a cure that's worse than the disease. It doesn't do families any good if we stabilize housing prices while mortgage rates continue to skyrocket. It doesn't matter to me why a house is unaffordable. Maybe the house is unaffordable. Maybe the mortgage is unaffordable. Unaffordable is unaffordable. How does the Federal Reserve consider the total price of home ownership, including costs of mortgages, in executing that mandate to keep prices stable?
Housing inflation is a very important component of various inflation indexes, and the way that's calculated is the economists look at rents, and then for people who own a home, they impute a rent depending on the value of the home. So it actually does factor in, and I would say the measures of new leases that are being signed and new housing prices show significant declines in inflation, not in price, but in inflation. And that will play through so that overall inflation over the course of the next 6 months or a year will decline.
If we're seeing mortgage rates go up, yes or no, does this discourage folks who may have a low interest mortgage rate from putting their home on the market and then possibly paying double the cost on a mortgage for their new house?
It certainly could. People who are in a low mortgage, a fixed rate, low rate mortgage, I would assume many of them are not moving.
Yeah, does raising the federal interest rate change the cost of borrowing for a company hoping to develop new housing?
Yes.
Does it make it more expensive for suppliers to finance expanding production and meet supply needs?
It does.
Does it give businesses less wiggle room to offer higher wages and attract qualified workers?
Indeed.
Yeah. So all of these actions have to be taken into account. Federal Reserve does not control housing supply, but its actions do have a massive effect on housing supply. And some of these supply effects, it seems to me, will be felt for many years, well beyond when interest rate hikes have slowed or rates have even gone down. And I know you've got a difficult job and a tough situation, but I just hope that the Fed will think more about his actions and how they affect housing supply, even as it attempts to control housing demand? Thank you.
Thanks, Senator Warnock. The last question, I believe, questioner is Senator Sinema is remote from Arizona.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here today. In raising interest rates last month by 25 basis points, the FOMC cited Russia's war against Ukraine as a key contributor to elevated global uncertainty. The war has serious implications for global energy and agricultural markets. And as you know, energy inflation in particular can appear in the form of higher prices of other goods and services. This feels like a substantial driver of inflation overall. And in my mind, you can't understand the global economy fully without assessing the range of possible outcomes in Ukraine. As we've also seen, the war created new supply chain problems overnight and has caused abrupt price swings in select committees. How is the FOMC assessing the economic impact of the war and the range of potential outcomes in order to inform how it sets monetary policy?
So the principal, I guess there are two things to say. One is that the principal way that the war has affected our economy is really through commodity prices, grain and particularly energy prices. That's the main thing. I think really, and those have both flattened out. Energy prices globally have settled down and they're at a higher level, and and food prices as well to some extent. So the second thing I would say is that it represents a significant risk. So the war in Ukraine, the outcome is uncertain, developments there are uncertain, and you have to think of it as a source of potential risk to the global economy and to our economy. We don't, and we look at alternative scenarios and things like that. We don't really do it from a geopolitical standpoint, but we do, of course, model scenarios where commodity prices are higher and things that would look like what could happen from Ukraine.
Thank you. At home, Arizona families are struggling to navigate this economy. Higher prices are making it more difficult to afford groceries, gas, rent, and airfare. But on the other hand, rising interest rates are crowding out investment and making it more difficult for first-time homebuyers to buy a home. Inflation has also slowed housing development to a halt in Arizona. And as you know, Chairman, housing is a major economic contributor in my state. It's also clear that more spending comes with trade-offs. And it's why tackling inflation has historically been so difficult. And yet it's more important than ever that we get it under control. There's been much debate about a soft landing, where we get inflation under control without triggering recession, versus a hard landing, where inflation comes down but triggers a painful recession. Some economists are currently saying they see no landing right now, that growth is actually accelerating, and that more aggressive actions will be needed to get inflation under control. If true, that would be problematic. What do you think about that assessment?
Well, as I mentioned earlier, I think if you look at the data that's been coming in since earlier this year, you have seen stronger labor market conditions, higher inflation, stronger consumer spending, and also we saw some of the low inflation readings from the fourth quarter of last year revised away. If you take all of those, they kind of they may be to some extent related to things like seasonal adjustments or a warm January, but nonetheless, they all point in the same direction, and they do suggest that the possibility that that ultimately would need to raise rates higher than had been expected. Of course, we have 2 or 3 more very important data releases to analyze before the time of the FOMC meeting. Those are going to be very important in the assessment we have of this relatively recent data. We'll be looking carefully at that, and all of that will go into making the decision, which we have not made, but making the decision that we'll make about what to do at the March meeting.
Well, thank you. On February 23rd, the Fed, the FDIC, and the OCC released another joint statement on crypto assets and liquidity risks posed to banking organizations. It's clear that regulators see undue risks for banks in the current environment and are taking a more conservative approach. Do you believe these risks are inherent to crypto assets and how they behave, or is some of the risks a product of the current regulatory and policy landscape for crypto assets in the U.S.?
So we're seeing, really, in the last close to a year now, we've seen just a remarkable set of events in the crypto space. Lots of companies collapsing. We've seen massive fraud. We've seen all kinds of things. I think, we have to be open to the idea that somewhere in there is technology that can be featured in productive innovation that that makes people's lives better. However, in the near term, we see in crypto activity lots of things that suggest that regulated financial institutions should be quite cautious, and that's in doing things in the crypto space. And that's what we've issued 3 or 4 releases to the banks, along with the OCC and the FDIC, the Fed has. And they essentially say, you really need to be careful here. You need to be careful. It's early days with crypto. There isn't the appropriate regulation. We're learning lots about the risks, and they are many of the same risks that run in other parts of the financial system, but without appropriate regulation.
Thank you, Senator Powell.
Thank you.
Thank you, Senator Sinema. We conclude the hearing. The Fed must make sure that workers and families are at the center of every decision it makes to strengthen our economy. We've heard a lot today about the role that Wall Street plays in our economy too. As you've said, Mr. Chair, we know that higher capital requirements make banks safer and stronger. It allows them to make investments in their workers and their communities and our economy. That's what they should be doing instead of spending billions on buybacks. I look forward, Chair Powell, to working with you to strengthen our economy. For senators who wish to submit questions for the hearing record, these questions are due 1 week from today, Tuesday, March 14th. To Chair Powell, please submit your responses to questions for the record 45 days from the day you receive them. I thank my colleagues for the very, very good attendance today. Only one member on each side was not here, one for health reasons, the other just because he's doing 12 different things. So I appreciate all that, and thanks for your testimony, your public service, Mr. Chairman.
Thank you, Mr. Chairman.
Mr. Chairman.
Hi, with the bounce there. What'd they say? It made the SPY rip up to VWAP. I'd wait. It's probably gonna keep selling off before it rebounds. I mean, it depends on your time frame, your outlook. Trying to scalp it, maybe a little bounce here, but it fell off a cliff. It's gonna take time to recover wounds. Or can run again. What Durka does, they drive people around in little two-wheeled huts. They carry them with poles and run around. BBBY. Yep, barcoding here. Those are my thoughts. Well, it was interesting. I mean, most of the move and most of what we're probably going to be playing is his speech, and we can go over some of his statements from it, but yeah, basically the Fed funds rate's pricing in a 50 basis point now, I think. So market will probably continue to decline, I'd imagine, from that. I don't think we've seen the end of the drop. Gap between the 2-year and a Powell says need to continue to tighten. Powell data so far suggests we'll have a higher terminal rate in our next step. So the terminal rate is definitely important too, not just what he does the next meeting. But if they're going to price in a 6% or even above that, that would cause a sell-off also. Powell says nothing about data suggests we've tightened too much. Rather suggests we have more work to do. So more tightening, higher terminal maybe. Good for puts. I look for another short at VWAP here, maybe even we get up here further. Those highs. Thanks for all your support today, guys. That was fun watching them hound Powell. Appreciate your thumbs up. I sold my puts on GME. Yeah, the rejection of 1940 yesterday was not very nice. Tesla puts. How are they back to 51%? Oh, because Tesla's almost break even. Jeez. How well this thing's held up. Bounce right on here. No, I sold my calls in GME. I bought calls yesterday, or the last few days, and I sold them out. I could have sold them out yesterday, but I want to give it more of a chance today. It just looked nice yesterday, so I bought a lot more. But then it rejected that 1940, and so not as excited for a pre-earnings rally. Maybe post-earnings, we'll see. Premium on GME is so low, it's not even worth selling puts on. Look how low this has gotten. It's crazy. There's SPY back to VWAP.
Right. You could get in the money on this thing right after, at the open tomorrow, because we'll know because the earnings come out tonight. I think it'd be safe, or it'd be a wise move to take it off. We've got so much volatility in the markets these days. Another factor that has nothing to do with the company could cause it to go up or down just because of a Fed speaker or something else. So when you have a profit built in, again, something this short term, I think it's smart often to take them off quickly if you can.
Yeah, definitely. You have to be nimble in this type of market due to the moves, whether it's a conference call after the earnings or some macro event. As
Grab another short here.
All right, great stuff. As always, thanks to Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research, helping us break down the markets and CrowdStrike. But coming up after the break, Kevin and I are going to be joined by Landon Swan from Likefolio for discussion on Teladoc, which is down about
Is tied to volatility,
from
yes.
year-ago level. Stick around. We're coming right back.
Or if there's a future event that's being priced in, like earnings coming up, you're going to pay a higher premium if it covers over that time period. But yes, it's from historical volatility. IV is implied volatility, but it is a result, not a cause. So just because we have a high IV does not mean it's going to continue. That's why BBBY has been great for the farm, because the implied volatility has been very high. SPY rejected that VWAP with the wick. Wheels up. Osmo holding up that 14%. That's pretty good. Pretty solid. Eyes coming down here. Sitting on 3 contracts of the micros. Like to get more. Be patient though. BBY ramp. There's definitely a ramp there. We filled the gap today. Gap was 131. We filled it. We're at 130. So next level down is this 127 Neon. That was the low it made back here just before earnings. They were saying it's going to go bankrupt, all this stuff. We hit 127 then. Then after that, this is pre-IPO, or not pre-IPO, but near IPO high, 1160. And then this is all-time low a few days after IPO, 0.88. So those are the next levels if we do continue to come down. And this is looking like a bear flag again on the hourly. Similar to yesterday. Bear flag, drop, bear flag, drop. The BBBY Reddit loses hope. Yeah, I wasn't buying into the M formation. Let's see, the M back here. That high was a higher low. So I guess it could still play out because we're at a higher low than we're here. I did see Turkey with the dump. Yep, profit taking. Bouncing now back to VWAP maybe. I'd imagine probably a gap fill down here before it makes new highs.
That's a bit of a betrayal of trust, in my opinion, if that is what's going on. And so the happiness has just been tanking because of that. So better health, which was a bit of a driver of growth for this company, is actually now kind of a thorn in the side. And so they, when you compare it to some of their competitors, it's just, they're just kind of the brand that they should maybe be a little bit ashamed of if this is what's actually been happening. So they've got there's some trends that are working against them as well.
A lot of support in the 130 range. Yeah.
Telehealth demand is down about 27%.
YouTubers quit GME once AMC started rallying, because then AMC got way more views.
A little bit 2% year over year.
About
That's
YouTubers,
a contrarian trend for them.
They're gonna follow what
people
gets
talking
views.
About how healthcare is expensive.
There was an exodus out of
14%.
GME YouTube content.
Most of these are going the wrong way for
like
them.
a year ago or more.
And
once AMC had
like
their
you said,
squeeze,
the
and
stock has just sort of been. It's been struggling, and it hasn't
There's just
had
not-
a rebound that a lot of these other companies have, and for good reason.
There's not viewership around
So
GME
I'm
really
definitely
as much
concerned
anymore.
about this company.
If it rallies 50% a day, there will be.
Short term, the press is bad, so not too happy about
GME is
Teladoc,
above
just
VWAP.
overall in general.
Landon, here's the question that we have
Break.
to ask: is the
Look
compound
fast.
annual growth
Oh,
of Teladoc is 24%.
broke
They've
up
got a
out of the barcode.
$455 billion
through
industry
the WAP.
by 2030. So
GME is also
telehealth
moving
is
up.
growing, and it's going to be fine in the long term. The question is, you mentioned Amwell, right? Are they a true competitor, and is
maybe some of my covered calls
competition
get filled.
just taking over Teladoc?
Probably
Are
not. These little
they
moves don't affect
not
the
good at
option
what they
prices,
do?
because
Are
the
they
options
getting
barcode
beat?
also so
Because
annoying.
overall, they seem to be, they like to focus on primary care. They focus on chronic care, which gives to some loyalty. Also
trade
mental
some
health,
AMC.
which gives to loyalty. They're doing the right things to grow. Obviously, this stock was
So yeah, some of them, if they're just
$308
YouTubers,
to
like
21.
they're gonna go for what gives
If
them
we can't give it
views.
love here, Landon,
Well,
when
if they don't
can
see
we
it on
give it
GME.
love? Or is this just a a stock that's losing in this
Start
sector?
give up on the squeeze.
Well, you know, I think it's a great sector to be in. I absolutely think that over time this is going to grow
Warrior
tremendously, that
barely
sector as
mentions
a
it.
whole. But I also think there's good competition now, but I think there's going to be swarms of competition coming in, and you have to execute.
Yeah, it got a
really
little
well.
volume bump there
You
through
have to.
VWAP.
Otherwise, people are going to find another
1.1
provider.
million.
And this is, you know,
Not
when you
bad.
get into virtual services or digital things, that is a much faster road to a product than a physical location. I mean, ask me, I know about building digital products, and it is much easier to compete with Teladoc than it is to compete with a large chain of hospitals or doctors' networks. So you can build that site and hire people much faster. And I think the competition is going to be flooding in. And one of the reasons that I'm concerned is their happiness. Happiness is absolutely critical. For us, you know, demand is like the short-term indicator. It tells us how things are going right now, what are they likely to report, and maybe what can they give some influence on guidance, like what kind of insights on guidance they could give. But happiness is the consumer saying, I'm likely to keep using this service, I'm likely to tell my friends about this service, or I'm likely to upgrade, all of that. And it has just been, I mean, it started, you can look at this chart back in late 2020, it was up over 70%. Not great, not compared to like Amwell, but it's right there kind of with HIMSS. But now over the last little bit, it has really been falling. And, you know, this latest news, I think, is just going to continue to push it even lower. So happiness is key. Trust is key. When you're talking about doctors, when you're talking about therapy and counseling sessions, you've got to have good execution and good and high levels of trust. And then on the technical
yeah, I think I got some
platform,
covered
all
call
those things
fills.
that I mentioned, you know, there's glitches, there's unprofessional therapists, poor customer service, a bad messaging system, canceled appointments. I mean, you've got, if you're building a technical platform, you've got to execute it really well. This kind of reminds me
we're
of
getting
the
some
opposite
move there.
of Zoom. Like when Zoom came in, they nailed it. They nailed execution, and COVID hit, and they were the right place, the right time, and they did fairly well. And they didn't have any huge blunders. They had a couple of like password leaks, that kind of thing, where weird things happened, but it wasn't huge blunders. Their happiness was much higher. They executed much better. And a company like Zoom, the people who executed for Zoom,
nice little move here.
someone like that can execute and come in and compete against Teladoc. So
Congrats.
I'm not going to be bullish on this company.
It's maybe not a good thing. We'll see how
much
much this
higher
rally
than
goes.
50%. It's got to get at least to 70%. Otherwise, they're not gaining or
It's
keeping
kind of a
customers.
bearish
Yeah, I
play.
think one of the key things on that chart right there that we just had up there on
Happiness is
consumer
critical.
happiness was
Genius.
negative commentary has started to explode. So maybe this isn't you know, a consumer issue. This is, as you mentioned,
Spy?
the
No, I
company
think Spy
issue
is
where,
probably
you
gonna
know,
sell
these
off.
doctors get on a call for a half an hour, charge $200, and you know they're
probably
not conducive to
back down here
what
and
the
probably back
consumer
down
wants
here
at
and
this point. But Landon,
might be on
they
a
had
long
earnings
road
about a
back
week and
to
a
new
half
lows.
ago. You know, are you guys still have a negative like score on this company? It sounds like you do.
Yeah, it's moving negative very quickly. I think it's dropped about 30 points in the last 2 or 3 weeks. So it's definitely
yours?
moving to the negative side. You know, they don't have earnings coming up for a while, but they're going to be negative. They're continuing on this trend. I'd say fairly negative.
Yeah, that is pretty solid volume.
Don't love it right now.
Yeah, negative Tuesday here out of Likefolio on Teladoc. This stock's been beaten down over the last 12 months, and according to the data, not looking up. All right, thanks as always, Landon. Appreciate it.
All right, thanks, guys. Take care.
Landon Swan, co-founder of Likefolio, breaking down Teladoc. Whew.
So here's the problem, right? We just talked about 3 real names. We talked about Teladoc, we talked about Amwell, and we talked about Zoom Video. We even threw a Zoom Video
Volume's
in
good.
here, right?
Yeah, pretty good
And
volume here.
Here's the problem. All 3 of those charts look ugly. All 3. Even Amwell, that got great scores by Likefolio, their chart looks horrible as well. So what do you do with groups like this? Well, here's the good news for, let's say we're going to focus on Teladoc. Teladoc stock is relatively cheap, right? You can buy it for $26 right now, so you can just buy the stock and make it a long-term hold.
On a dollar basis, it's cheaper than a lot of stocks.
Right, but what do we do on this show? We give you
you're
even
practicing
less
selling them.
expensive ways to do that. So $2,600 for 100 shares of stock. Tom, if you did a July diagonal, right? July gives you
cover calls. Start with cover calls.
136 days till expiration. So you're basically talking, you know, a significant amount of time. You can do a diagonal where you buy the July 22.5 call, right? $3.50 in the money, and then sell this week's 26.5 call, relatively at the money. The stock's rallied a little bit from where it was, so it's now up 47 cents. But you could obviously, if you think 26.5 is too low, you can put that strike back out. But anyway, this is trading for about $5.62. So you're thinking about $2,600, but you're thinking about $560 on this, a less expensive way to do it. Tom, in terms of deltas, if you say, maybe if you do a covered call ratio, it's about 70 deltas, right? So this would be, if you did 2 of these, it would still only be about $1,100. So you're still getting it for a fraction. You have about 60.
Back holding options is good if you're selling them.
So this is
all the back holders. That's the way to win.
There's no dividend, so there's no
You
reason
want
to
to
do
back
it. You
hold
could buy
your
a covered call, or you could
sold
do
calls
this
and
a
sold
less
puts.
expensive way to do it, and this gives you time. Now, if you're not bullish on this name, and you look at a $4 diagonal that you're paying $5.60 for, people say, well, that doesn't look right. Well, remember, there's a calendar aspect to this because you're buying something 136 days out. You're going to be able to chip away at that net debit several times if you choose to stay with this name.
Yeah, so let's break this down. Longer duration call diagonal, like
go,
a stock
Ace.
replacement type strategy, because you have that higher delta in your long-term options. Buying the July 22.5 strike call, selling the March 10th weeklies that expire in 3 days, 26.5 strike call. Paying $560 debit, that is your risk, $560, as opposed to, as you mentioned, buying 100 shares of stock, more capital intensive. Your break evens on this, you've got 2, Kev, because you're paying more than the width, the $4 width of the diagonal. 25.5, basically around that level, and then up near $30 on the upside. So you want this to grind higher. You do have that ability to roll that short option as you get closer to expiration over the next 3 days. You have some assignment risk on that if the stock does shoot up also into the end of the week. But then you can start rolling or adjusting that trade if the market's open, liquidity is provided, lowering that break even, reducing risk, increasing potential profitability on that. But this stock replacement type call diagonal, as an example here in this name, in Teladoc, which has been beaten up pretty severely, in a lower cost way to get maybe some exposure over the next 4.5 to 5 months to the upside here, Kev.
Collecting $9 a day in theta, theoretical, of course.
The volume's
theta.
vanished
And
like
this
this?
is one, if it got up to 26.5 or 27, you should probably extend duration or move that short call.
Yep, some trade management skills may be necessary there. All right, Kev, let's take a quick break. When we come back, we're going to take a look at Delta Airlines, which upgraded this morning and is up nearly 20% so far this year. Fast Market's coming right back.
Well, this is more exciting on Bed Bath than yesterday, at least. Yesterday was without any pops all day. That was pretty tough. Just straight dump from open, barcode, close. That's a 4-in-1 ace. Overseas platform. Might do some two strike cover calls. I opened up 42 1.5 strike weekly cover calls and BBY on the long term, which has 16,000 shares. So I still have quite a few shares that don't have calls on them. Short calls. And then on the TD account, let's see, opened up 20 short calls to 1.5 strike. And I'd have 400 shares that aren't covered. And the E-Trade. Yeah, I have 10 short, 1.5s. So a close over 1.5 this week would be pretty good. Covering someone's call. Covered call is it's selling a call option. Osmo's holding up well. Osmo Kramer. Oh, actually, Powell, I forgot. Powell's speaking tomorrow also. So I'm not sure if it'll have the same effect. I don't imagine it would, because he probably has the same pre-written statement. Today was the Senate. Tomorrow's the House he testifies in front of. We'll get ADP unemployment and JOLTS job openings and Beige Book. Thursday's jobless claims. Waller speaks. Yeah. I'm not imagining tomorrow has the same outcome, but market might wait, kind of pause a bit until tomorrow even. I was forgetting about that actually. Getting so bearish. Up by one call option 24, and you have cover calls 24, you might fill it. Yeah. Yeah, it's the seller of the call. I mean, a market maker does it more pretty much most of the time. They'll take it. But if there's a order on the other side, then yeah, they'll just fulfill it that way. The buyer and a seller to every transaction, but oftentimes it's a market maker.
And George Tillis, senior markets correspondent here. We're talking airlines here, George. Demand remains robust. They continue to hike fares. Consumers still spending on those fares. But it got an upgrade today out of Evercore. What's your take here on Delta?
Well, I think first off, what you mentioned, Tom, people are spending money, and if you look at business travel,
that
it's
pre-written
grown,
statement that
leisure travel has grown,
made the move.
International travel has also grown, and that's again why we were seeing
4
some
Americans
positive,
kidnapped in Mexico,
reactions
found,
in Delta
2 dead, 2
or
alive.
price action this last year or so, with the stock up about 18% on a year-to-date basis. But I think for Delta, what's interesting is if you look at a 5-year chart, we're still considerably below that $62 peak back in late 2019. When you look at also revenues back in 2022 for the full year, they generated as a company about $41 billion, but that's still lower than 2019. But at the same time, on a forward basis, profitability is expected to increase. And I think this is what Evercore ISI is looking at going forward. They actually upgraded the stock to $47 from $40, have an outperform rating from an inline rating. And if you consider a couple of the catalysts on a forward basis, we know that prices are higher, volumes are incrementally improving. The company really has a pretty solid balance sheet. Now, they have increased their debt from about $9 billion to about $16 billion, and this is
You do
compared
cover
to
calls
2019 levels
in Germany
versus 2022.
or with your brokerage?
But at the same time, its net income is down about 60%
Let's see,
considering
I'm trying to think.
2019.
European
With an
expirations.
improving outlook in terms of sales growth with 21%.
You can't close it out before it expires.
Operating income growth going forward about 33%.
But you could.
So I think this is what
Could do
everyone
them.
is looking
You'd
at.
have
They're actually
to,
seeing more visibility in operating
get the whole tail
expenses
expiration, I think, right?
and operating income, and that bodes well, especially when you see operating income forward growth expectations higher than sales growth, which is the case here for Delta.
Don't want options,
And
yeah.
at the same time, part of this has to do with that labor contractual agreement that was put through the pilots union, which again gives more visibility and costs. And at the same time,
You can do options in Europe, but the European options are different. I think you're not able to
George, they came out with
to
a
like
pretty
trade
good
them,
earnings
basically
beat on
buy them or
January
sell them.
13th, which if you do the
then
math,
you have
that
to hold
leaves
till
us about
expiration.
5 weeks away from another earnings
So,
release by Delta.
you're not,
When
like,
Jerome
trading.
Powell, in his testimony to the Senate, mentions travel and leisure as one of the sticky parts of the U.S. economy, that means none of the demand for travel and leisure has backed off. Airfares are still incredibly high. You got to think they're going to put up a good number here in 5 weeks, George.
Yeah, I mean, to be expected, Kevin, if you actually look at
That's true.
comparing Q1 of
Airlines
last
might
year,
actually do well in
Q1
earnings.
of last year, Delta actually still had an adjusted loss, but in the last 3 quarters, all the remainder, Q2 through Q4 of 2022, as well as full year 2023, are expected to be full year profitable. And again, I think that bodes well for Delta. And like I said, looking at the earnings growth estimates, they're expected to grow their earnings 60%. On what is conservative, I would say, a revenue growth around 21%, considering that top line sales year over year, 2022 versus 2021 were higher by 70%. Anytime you see earnings growth, at least 2 to 3 times the estimated revenue growth, that speaks to a strong trend. And it may be just a slow and steady one, but I don't necessarily see any surprises.
Powell said the ultimate rate peak
Delta
likely to be higher than
based on the
expected.
conservative revenue guidance the company is providing. But at the same time, the full year 23 earnings estimates are around $5.19, which really only puts the 23 forward multiple at around 7.5 times, and that's relatively cheap considering its 5-year average.
Yeah, and United Airlines double upgraded today also. That stock hitting 1.5-year highs. So the airline industry remains in demand, and ticket prices aren't coming down, unfortunately. All right.
And by the way, this is a volatile sector in normal times, and these are not normal times.
Nope, not at all. Demand is still there. Capacity is still muted at this point. All right, thanks to George Tillis, Senior Markets Contributor here on the network. Thanks, George. Kev.
Tom, you point and click for an airfare right now. The first thing you say is, ouch.
I say, oh, where can we drive? That's what I say now. And I was just on a plane for 40 hours last month. And, it's not the greatest experience in the world.
40
but people
hours?
are still, the demand's out there for travel here, Kev. When you look at this stock, it seems like they've got better margins due to the fact that they bought that refinery a few years ago. That helps them. They're through this labor situation. Your thoughts here on Delta real quick.
This has always been one of the leaders in airlines because even in years past, they used to buy
tied to Fed
used
policy
planes
rate,
and then
pricing a bigger chance of a
refurbish
half
them,
point
which
rate
saved
hike in
them
March.
a ton of money. Now you see them. They're right up there negotiating with Boeing for a big contract that because Boeing's planes,
2-year and 10-year yield curve hits record inversion
efficient, and they think that'll
negative
save them money.
103.50 basis
Delta,
points.
they've always been high in customer
Our
service.
yield curve
and
is
customer
inverted
happiness.
to a record amount.
This is a company navigating
And
these
they say we're not
tough
in a
waters
recession.
of the post-pandemic world, but boy, demand is there, Tom.
Yep, and stock's up 20% so far this year. So I looked at a strategy that takes advantage of maybe that continued grind higher.
Bullish,
here, but giving myself some
a little pop
duration
here.
as an example. So instead of buying the stock, maybe you look at a strategy like this. This could be one way to play it to the upside. Going out to the June cycle here, Kevin, buying a slightly in the money call, 39 strike. It's got that higher delta. And then against it, selling the 44 strike call. It's $5 wide bullish call vertical. You're paying roughly, we've got 210 up there.
A's.
Might be closer
you're,
to 220
You're looking to take profits at
point,
250 on
the stock has
BBBY?
moved higher
Were we just
today.
there like
But if you pay 210,
couple
you
weeks
break
ago?
even 41.10. That's not much above the
They
current
were
share
like
price.
2 weeks ago.
Yeah, exactly right.
Why don't you just sell then?
This has gone up. I've got it right now live about 218 is the middle, but this is one of those you're betting on an upward move between 39 and 44. The current stock is trading right around 39.63 is what I have it live. So this is one that you're very close. You don't need much of an up move in a vertical call for this to go profitable, Tom. And then, as you know, if you play this right, if you get a move to 44, you've got a $4. You've got about a double here, relatively easily.
Yeah, and what you pay for is this vertical
Yeah,
is
break
your
even
risk
there.
on that $210 per spread. It can expand to $5.
$5, right.
So it's got a decent risk reward profile on this, Kevin. But you only need a $1.50 move over the next 101 days to get
Sell at
above
20.
that break even. So there, in where maybe you expect the stock to go up, but you're only
Russian
giving
pride.
yourself about 3.5 months.
20 would be
but
pretty
44
large.
on a percentage basis. That's a pretty big move.
Percent-wise, that'd be the
Duration
biggest
is
run maybe it's ever
important in
had.
vertical spreads because you usually need some movement. Even in one where we're slightly in the money already, you still need movement, Tom, for it to be profitable. So remember, duration is important in a vertical.
Yeah, and implied volatility at or near 52-week lows. So that means that those verticals are going to cost you less
It's a 1,300%
at this point
move.
because option premium
We're talking
is contracted
HKD now.
from levels that we saw over the last 52 weeks. So good look at a directional vertical here in Delta. If you
Back to
believe
7.
this analyst upgrade and you think the stock's going to grind higher over the next 3.5 months.
Maybe. Seller over 5. We were just there, Ace. I guess that was pretty high. I feel like those are all numbers without any positive catalyst. But what if you've already lost a house, Ace? Lionel Richie. Okay, see ya, Jan. Oh, bowling tournament. Have fun, man. Eyes coming down here a little bit. Should get another contract. Oh, there's a little flush on BBBY. Back below VWAP. Powell says housing services inflation coming down is in the pipeline for the next 6 to 12 months. Says we are not seeing goods inflation coming down for some time now. We're trying to create disinflation. We're not trying to raise the unemployment rate. Or inflation has not come down as fast as we had hoped. There's a long way to go. Those are pretty bearish. Oh, nat gas broke the little broke the high. I haven't gotten back into it. I'm sour from my stop loss. I don't know what to do now. Wonder if it's so illiquid that it really does move for my stop loss. Cost average. I didn't buy as much yesterday, so I don't think it affected it much. Let's see. I'm not even sure because it gives me the wash sale price. So I have to turn that off somehow. My last purchase was at 143. Have to manually do it. So on the long term here, I hold the most shares. My first, what I hold now is I have 258 for purchase, 267, 275, 225, and then 143. Yeah, I haven't bought shares on this account for a while. Oh no, never mind. Wait, what? How is that possible? Yeah, that's giving me a wash sale price. So that's not true. I bought on the 6th, which was yesterday. I bought on the 3rd. I bought on the 2nd. I bought on the 1st twice. So those prices aren't right. That's wash sales. So somewhere in this range. For these shares at least. The one on my TD account, I think I'm at 250, which I don't know if that might be right. I'm not sure. That was with cash secured puts, which I kept rolling, and then I just let it get assigned. So it's somewhere around 250 maybe. But then do you add in your losses? Because I had big losses. I bought in here and sold out here with a large amount, like 70 grand worth. That was fat loss. If the market crashes, people lose money. They don't want to lose money. So. Why do I care about it? Well, affects my taxes. I mean, whatever chunks you want, just scale in. I've literally bought, like, since we've had that Gulf in Canada, I've bought every day. So, bought here. Today I didn't buy, mostly because yesterday we broke that Head and Shoulders, which I was hoping we held. The fact that we didn't hold that, I assumed it'd come lower. And here we are today, we're lower. And now, this could be a bottom, but I'm not so sure yet. Still looks like kind of a bear flag, even though we have that wick up there. So, I'm waiting. But that's to say, I don't even know if I want to buy more. Yeah. I'm selling covered calls. Much as I can. Yeah, I wasn't really playing the run up. I was, but it's I had a small position on the run up with Ryan Cohen. And for whatever reason I didn't sell it. It was small, I don't know. It was like a couple leaps. shares. So I made some, but then I entered cash secured puts, and those I was riding for months and months. Too low on the SPY there. Could have opened another short. What price do you guys target thinking for upside? I don't know. I mean, without a catalyst, without some news, merger acquisition of someone that'll be bullish, it'll probably just, I mean, it depends on how low it goes first. If it gets down to, you know, whatever, 20 cents, then maybe it moved to $1.50. If our floor is pretty much here, 127, 130, then you could see another move without any catalyst up to 3.5. Maybe up to these levels, these 5 levels, pretty easily. With a catalyst, I think we could see double digits. Buys flushing down now. Fair market value, I mean, depends on who you ask, right? It's they've got a lot of debt. They're on positive cash flow, and yeah, they just offered a bunch of shares with a sketchy convertible type offering, which may or may not be pointing to an activist investor type buyer. Seems like it might be, just because of the way they've only exercised warrants enough to pay the interest on the bonds, and there's been no other dilution that we know of other than that. So it seems like a friendly buyer of those warrants.
So the fact that you're now seeing another round of cuts still is a company that was at one point operating in a more bloated environment.
They're pulling good revenue for their market cap.
The fact that he
market cap's 155 million right now.
Hiring over the past several years.
They're burning cash.
We have no reason to doubt this reporting.
But if they're not going bankrupt, I mean, it definitely is undervalued.
Still, to my knowledge, not confirmed by Meta in terms of these plans. I'm going to say downvote, but certainly something to monitor here. But I think that you hit the nail on the head. When we talk about kind of the bloated nature of
could have
this
gone with
space
2
in
at
particular.
VWAP.
Good times lead to bloated companies.
Chase, I know if you're
really
doing
good
that,
times, like what Facebook,
if you just catch yourself, just cut your losses real quick.
has had over the last decade, lead to pretty
No
bloated
problem.
companies. Twitter has had nowhere near the successes of Meta platforms, and we know the very
Moonpire has some shares for sure.
downsizing of the staff that company has had. Still works. So
He's good at scaling. He just buys a couple hundred every day.
Necessarily necessities for these companies. So if they want to focus on efficiency, as Zuckerberg and team have emphasized, they probably got plenty of fat to trim in terms of staffing. That's a really quick way to really ramp up those margins, bring down cost. But again, gonna say downvote for Meta just solely because this is a report not confirmed by the company, maybe having an impact on why it's doing a little bit better though today than the overall market. We'll go ahead and say upvote in DKS because really impressive post-earnings move. One of the leaders of today's price action, but the next one actually slightly ahead of it, and that's Squarespace. So a company that I don't know if it gets talked about all that frequently, but it's certainly getting talked about today.
It is. I mean, with a over 12% move higher in reaction to its quarterly earnings, it's a really strong mover. I actually don't know how this happened.
Australian dollar down 2% versus US dollar.
All of these outperformers on a day when the rest of the market is in some turbulence to the downside.
Yep.
So now up 13%.
A level here, a little gap fill there.
That exceeded forecasts from a top line
we might have a gap down tomorrow.
Also
although he is still talking tomorrow.
They said their fourth quarter revenue.
I don't think we'll see as much reaction because I think it's the same written statement. I don't think he's going to change what he's going to say. It's like, oh, they didn't respond very good. Let me change this for the House. I don't know. Maybe it is. I can't remember last time if he had a different written statement.
Which was down from losses it reported last year of just 12 cents per share. The CFO highlighted they ended this fourth quarter with accelerated growth and exceeded their revenue and unlevered free cash flow guidance, which shows the continuing momentum in their growing of the business. They now expect their first quarter revenue to fall between 232 and 234 million, also well ahead of street expectations. So pretty much blew it past what the Wall Street have been bracing for on every metric, which is why we were seeing that nice spike up today. Now up about 23% this year and up 90% from its low.
Yeah, I think that's another really, really well put point when it comes to this particular report. It's not only that they beat top and bottom line, that bookings were impressive, 15% year over year, but on the outlook front, on the guidance front, they're looking for a lot more aggressive performance than the street had really sniffed out. And I think that's why you're seeing this stock being rewarded pretty nicely here today. We've talked about it tons of times. If you're going to be in this non-growth or growth, non-profitable tech space, particularly in a rising interest rate environment, well, you better be growing, and you better be growing faster than expected. There's not a lot of room for blemishes on these reports, and at least today, Squarespace appears to have delivered just that. Going to say downvote, though. Really impressive move, one we'll keep our eyes on. Maybe we'll come back to at some point later on this week and look at that one a little bit closer. But let's talk some Stitch Fix, because while this is a relatively low price stock, it's still a pre-earnings look in the, I guess, subscription-based box fashion company. I don't even know how to describe it.
You know, okay, Alex, one of the first times I was ever on Fast Market, we did Stitch Fix, and I couldn't say it. So I spent like the whole segment just butchering it. So I've practiced. So now I can confidently, semi-confidently say Stitch Fix. It is so hard for me to say, but we do have earnings expected today after the closing bell. Street is expecting losses to steepen on a year-over-year basis at around 32 cents per share. On revenue, that's estimated around $413 million, which would signal about 20% of a decline on a year-over-year basis. Now, over the last year, they have actually beaten their revenue estimates 100% of the time, but earnings only about 50% of the time. So a bit of a mixed picture there from a top and bottom line perspective. Their quarterly performance, though, per the street, is expected to be hurt by this tough macro environment, including headwinds like their global inflationary pressures and potential shifts in customer demand. Stitch Fix notoriously operates in this clothing rental, I'd say, world where they send you the subscription box. It's not cheap. I think the benefit is that you work with like a stylist, and if you're, say, not someone that's interested in fashion, you will have then your clothing items picked for you. So there is a benefit of paying a premium for that service, Alex. I have done this in the past. I think it's expensive, and for that reason, it's not necessary for me, but I can understand the ease if you're not interested in like the shopping fashion world, which honestly, I'm not really either. But shares are up about 5.5% ahead of this report, and actually a quiet outperformer on the year, another one that's up 95% off their lows and up over 64% so far this year. These are like the outperformers today.
Yeah, well, I guess the point you make, though, I think is a good one in terms of why someone would sign up for this service. But the thing is how do they keep you signed up? If it is operating at more of a premium price point, and you sort of learn along the way the things you like, things you don't like, at some point it's a lot like the Blue Aprons or the Hello Freshes of the world. They teach you how to cook. They teach you all the ingredients you need. You no longer need them to send that to you. You can just go to the store and recreate those recipes yourselves. A lot, to me, is happening in this realm as well. So the subscription box, it sends you the fashion items, it sends you things that you like, some you don't like. You send it back, you keep some stuff, but ultimately you figure out potentially your style and the things that you're interested in. Then you can just go to the department store and buy it yourself and kind of kick out that middleman. But going to say upvote here. It's obviously a pre-earnings look, Jenny. It's $5 stock, so quite accessible. But one thing that's really going to be a big portion of this one is that 20% decline year over year in revenue. They're not profitable. So what do we just say in this rising interest rate environment? To make capital find your way to your company, you got to be showing something positive, and oftentimes that's revenue growth. So this company losing revenue at the same time, not able to actually do this at a profitable way. It's not necessarily the recipe for long-term success, particularly in the macro environment we find ourselves in. But going to say upvote, maybe the charts will have some more clarity for us.
Yeah, and maybe the charts will show us some optimism, because I completely agree. I think that Stitch Fix, it seems like, needs to rethink some things. But we'll be looking at the technicals in both Dick's Sporting Goods as well as Stitch Fix coming up next. We'll also be looking at some example trades, so stick around. Next Gen Investing will be right back.
Oh. Neighbors. Loud and proud right there. Yeah, if you guys are BBY shareholders, go put your shares in the post. They're doing a share count on our BBBY. It's kind of crazy, the results already. Don't cheat it. Put it in legitimate. Everybody. So loud. So far there's 1,300. Oh, that gave you a link to Discord. Whoops. Yeah, I put it in. I might need to update it. It's changed a little bit. Copy this link. So far, so far 1,380 people. So imagine that, 1,380 people. 1,380 people own 10% of the float. That's actually not even the float, it's the shares outstanding. Yeah. The float's 114 million. We'll just say outstanding shares though. So 1,380 people, random people that happen to find Reddit and the subreddit r BBBY. 1,380 of the 50,000 I think are in this subreddit, or 20,000. They own 11.7 million shares, which is 10% of 117 million. You're in and verified? Well done. I didn't verify, I guess. Good. It's a link I just put in there. It's not a poll. It's kind of like a poll. It's just it's a census, I guess, on how many shares are owned. So it seems like the float is probably owned at least one time over, just by individual investors. I might blush here. Or bounce. Double doji shows uncertainty, so either we're gonna get buying pressure and bounce back up here, or we're gonna make some fleshy flush. Don't tell me they were Bed Bath and Reddit. Yeah, there are people who are DRSing. I'm kind of neutral against it. I don't think it has an effect necessarily. An effect that it could have is once it's known, I guess, by the company or whoever the DRS company is or holder. I don't know who the agent is for BBY, but once it's known that the whole flow is locked, then maybe that you might have some effect. And I would assume it'd be good. He's now coming down. Need Tesla to actually make a pretty big move in a short amount of time now. Things held up way too long. I probably should just be looking for an exit on it. Dang it. No, market makers will provide infinite liquidity. And if we're getting liquidity because it's not DRS, it means they're trading. And these people aren't trading, they're just holding them in brokerages, so... But I'm not too sure. I'm not too sure of the effects. I don't think it affects it a whole lot. New low there on SPY. So remember I was saying yesterday about Bed Bath and Barcode? See if I can find it again. Someone basically posted a picture of it. Maybe it was one of you guys. I don't know if I can find it, but yeah, they basically made a t-shirt that said Bed Bath and Barcode.
Break even below the market, risk defined, collecting $1 credit, looking to make $100 not accounted for the fees on $400 in risk over the next 45 days.
And now to switch gears, although Stitch Fix's chart is similar, at least on a year-to-date basis, you could not find two more opposite charts on a longer-term basis. This name traded once as high as $113, $114
I'm not playing
per
it.
share. Now it's just over $5. So Rick, well, it's had a strong year, and I'll give Stitch Fix that.
I knew
And
low.
you have to consider the fact that this name has been pummeled and it's been stuck really for some longer term years.
Stitch
You've
still.
seen shares just in the single-digit range in terms of its dollar value.
Luckily, you don't have to be fashionable to talk about the charts for this one here, so I'm in the clear with this one here. But one similarity between our past chart and this one is that our past chart has more than doubled off those yearly lows, and this one has just about doubled as well.
If we're in a fair market where
So,
supply and demand
a strong move up since we started back
dictated
here around the 263 level,
the price,
trending upward. Rising
then I
above
think it
our
would.
two shorter-term
But
exponential
I don't
moving
believe we
averages,
have that
yellow
kind of
21-day, orange
so
63-day. So we
I don't think it necessarily affects
are
liquidity.
riding along that trend line today. We bounced off of our yellow 21-day EMA, but the candle action has been pretty interesting lately. So yesterday we had a bearish engulfing candle, and imagine this is our candle here from our previous day. The bearish engulfing candle,
it probably
the real
rallies.
body, the difference between the open and the close, completely encompassed the previous day's candle, which was green, and then we had a red candle that totally swallowed it up. Today then, we're having a harami candle, which is the opposite, where the real body is completely contained within the previous day's candle. When you put those two things together, that's a pretty bad sign for bulls here, because the bearish engulfing candle is obviously, as its name sounds, bearish, and then a harami after that suggests that we're seeing some kind of stall in potential uptrend here. It suggests perhaps indecision on the part of traders here. So that's not really at all what you'd want to see if you're bullish in this name. Now, earnings could change everything here. It could be just suggesting that there's some congestion or consolidation heading into this earnings announcement. But looking at the chart here to the upside, the 570 level stood out to me because that was the site of a couple times where we bottomed out here topped out here.
Yeah, I mean, like I said, I
and
think the
also we
only
topped
benefit
out
would be
around that
if the whole
point
float
here.
was
So
locked
we've
up
had some trouble
and that was
breaking
somehow
above
provable
that
at some
point
point.
during the recent months that we've been seeing.
And then it
trading
maybe
in
would
this
have a
name here.
benefit.
So RSI momentum.
I think it would only
is
have a
slowing
benefit at
down
that
a bit
point and
here, not really making much
not be a bad
progress in
thing.
either direction
But
or
that
showing
benefit
much
would
of a
maybe just be
directional lean, although we are
lawsuits and
slightly tilted
litigation,
toward the
which
bullish side. Once again, not too uncommon
I don't
heading
know if
into
that'd
an
be
earnings
great or not.
announcement for the momentum to slow down a little bit here. So support near about 475 based on our 21-day EMA and the confluence of it and our trend line. Just below that, we've got our 63-day EMA, which is
Rivian
right
offering,
around
oh
the
boy.
447 level. So a couple different
That's why it
sources
sold
of
off.
support that we
Variable
could
senior
factor
notes.
into our analysis here of this chart. You
That's
know,
not a
really,
sell-off. That's nothing.
you wanna be
That's
looking
just
for
normal
some places
volatility.
where,
Still
an
get puts
earnings
on this
move might
thing.
stop or find
Market cap
some,
is absurd
stall
still.
and trend there. So
14 billion on
to
this,
the downside,
piece of junk.
570 to the upside.
And momentum
630
remained a
million
little
in
bit here,
rev.
You said still directionally leaning bullish, and also
Negative
getting a nice lift up
1.8
over
billion in
5%
operating
on
income.
The day. And thankfully, Rick, I think you're in good company.
I saw
I'm
actually a
not
meme on Wall Street
fashionable
Bets.
either, and this is
Rivian
a facade.
beat,
This is not how I usually dress.
was
So
it Hood? I don't know who it
completely
was.
agree with you, but we will leave it there.
For
Our chart
worst-
master, Rick Ducatis,
worst,
always appreciate all of your
negative
technical
cash
insight
flow.
trading this name, Alex. We have that earnings event still on the horizon, and say using some of Rick's technicals here, leaning more bullish for our example trade.
Yeah, I think
That's
Rick
why it's utter
highlighted
genius.
some of the risks, but we're now talking about a stock, and I know you guys both gave the big percentage. It's up like 100% year to date, but we're talking about a name that has gone
Owners are rich, yeah. The
97.5%
company is
off its highs
just
to now rally 100%
riddled
to
in
be a
debt.
whopping, let's call it 95% off of its highs. So those percentages
burning
are
cash
so
almost as
skewed
fast
by
as our
just how
country.
decimated this name has been. Of course, if
Or
you bought
burning
the lows,
debt.
you realize that 100%
Burning negative cash.
return. So can still be relevant,
Burning
can still
margin.
be important. But for investors who've been in this one for a long time, it's a drop in the bucket. I wanted to highlight a bullish version of this, but someone who's more bearish could probably find a way to structure
Get
this
more rich.
using puts and creating the opposite or inverse style trade to be a little bit more bearish. But again, we're talking about a $5 stock. Clearly has issues. I mean, a stock doesn't lose 95% of its value from its highs without very, very notable issues in both business model, maybe just execution on a business plan or whatever it may be, those just being a couple things that could contribute to it. But it's a pre-earnings look. Even if the message is just lukewarm, that could be enough to send this one higher. You don't need a massive, massive dollar figure rally for this one to get to max profit. I looked at buying a call vertical, one strike in the money, one strike out of the money, dollar wide. $1, though, I think notably for a $5 stock represents 20% of the value of that stock. So still big swings being priced in for this one, as 50 cents would be 10% in terms of a move. So looking at this, March, the 450
You didn't miss anything, no.
call vertical.
Had a little
for
liquidity
50
pump
cents.
here.
That would be $50
At
in risk
12:30.
to make $50 in
Couple million in
profit,
volume came
not
in.
accounting
Pumped above
for
VWAP.
those
Nothing trading
transaction
VWAP, barcode,
fees.
style.
Break even right
and
at
now
5.
we're
Well, this stock's
popping a little bit
trading,
more.
give or take a few pennies, oscillating around 5. In the real time, it's about 4.97 right now. When we started the show, it was like 5.03. So it's kind of, right around that $5 mark, which we've talked about with these debit spreads before, Jenny. If you can have the break even near the current share price.
Oh, yeah, you're talking about all
equal
day.
risk to reward. You're
Yeah,
sort
we
of
sold
setting
off. We
yourself
filled the
up
gap
for
to
a
the downside, so that's
situation where,
nice.
hey, we don't know that you're going to be
I
profitable
don't
or
know
not,
if the bottom's
but
in
it
yet,
might
though.
be a risk-reward ratio and
I was breaking that
situation
inverted
you're
head
gonna
and
be
shoulders yesterday
comfortable
was
with,
pretty sad.
taking that directional
And it's reflected today, I
bet
think,
or
with us now
directional
breaking that
exposure,
low.
directional outlook on
But we got a
something.
gap fill.
This one only makes money if the stock goes higher and is above
But
$5.
this is still kind of a bear flag on
at
the
that
hourly.
expiration with a max profitability being above 550.
Sometimes in golfing,
It
like you'll
loses if
get.
the stock goes below 5.
It doesn't mean that's
or
necessarily the low.
stays
You'll
below
get something like
5. In
this.
this
So
case, it's slightly below that
we
now,
could still rally
and
from
its
here,
max
but
loss is below 450. So don't have the full risk of buying
couple
100 shares
couple
of
levels
stock.
down
Don't have
here.
the full
Well,
max
127
profit
at
potential
least.
of 100 shares of stock, but
Could
in
still
that
get hit.
dollar-wide range, it's going to perform a
Momentum's
lot like
not to the
you'd
upside yet,
expect
but
100
this
shares
in
of
golfing
stock.
was showing that we're
And I
starting to
think
build a
utilizing
support,
the fact that
basically.
it does have a $5
That's
price
still
tag,
the
which
case,
is, of
even though
course,
we're lower
relatively
now than we were
lower
there.
than a lot of the names we do look at. But also important to keep in mind for both of our example trades today, multiple legs can lead to higher transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk. like unanticipated exercise or assignment. Now, coming up next, it's time for our FOMO segment. We are looking at Rivian not having the best day. Shares are down over 11% on the fact that it is diluting some of its shares. We'll dive more into that story coming up next.
Yeah, you'd think with the lack of liquidity, you'd get more volatility when it did run. And that still might be the case with GME, but we just haven't seen it run. But that being said, liquidity's probably been drying up for a long time on it, and it's not like the runs have only been getting bigger, so that theory doesn't really play out. But yeah, if you look at volume, like, volume has just been decreasing since kind of here. Get a bigger volume chart, but kind of here. This was the split. So it was like, what, right here? Right around here. Look at the volume, just been decreasing since then. It was kind of ebbing and flowing before then. Now it's just been on the decrease. On the decline. Buy looks like it's maybe find a little temporary support, maybe move back to view out for another test to conclude this nice bear flag. Don, do you know if Powell's gonna have a different written statement for tomorrow's testimony or interview or whatever? Yeah, testimony. Because today was to the Senate, tomorrow's to the House. I'm assuming it's just the same written statement. And then they're just gonna talk and ask questions or whatever. So it shouldn't have as much move on the market unless if he, you know, depending on what they ask him, I guess. Yeah, that's kind of what I figured. New panel asking the same questions.
Really don't actually want the deal to go through, and they were actually kind of wanted to have this deal with Frontier Airlines. That was actually the battle between the two airliners last year in the summer. So yeah, very interesting development here. We are probably going to see a delayed timeline, but it is a part of JetBlue's analysis when it came to completing this deal.
You know, I think the analysis is sound, but in terms of the price reaction, I think that it gets a little bit murky because obviously if this were to go through at the proposed deal price, you're talking like $30 a share up, or maybe even like $32 a share if my memory serves correctly for Spirit. Well, if it's going up from 16 because the deal might not go through, and then JetBlue's going down, to me, this is sort of a, just like I said, possibly a situation, as you mentioned,
SPY's
where
flushing
the
now.
companies were both prepared for this potentially to happen. But this story is not necessarily over yet. It's just dragging this timeline out further, adding more cost to it. There's going to be obviously attorney and legal fees on the JetBlue side to get this done if it's going to get done. And now it's just the opportunity cost in terms of this. So, of course, there's deal risk.
All-time lows.
That's going to be that premium. We know interest rates are higher now. But if this is going to be a multi-year process instead of a few months, you know, that explains that discrepancy between the deal price and where we're currently at least in Spirit's case.
Yeah, this could actually drag out for another year and a half, Alex. I mean, that's not out of the realm of
leap
possibility
puts
here.
on
So yes,
Rivian at one point.
Being discounted in the marketplace, but there
don't
also
know
could be a scenario where the
they
Justice
expired,
Department
though.
asks JetBlue to have some concessions. So maybe they don't
Maybe it was
complete
this
the
year.
whole deal in its entirety.
They just
Maybe
traded
they
flat
spin
the whole
off,
year.
you know, a couple of hubs and things of that nature in order for
I guess
the deal
they
to
sold
go
off
through.
quite a bit.
It does not sound like they're open to that at this point in time, but that is also a possibility, and something that a lot of companies actually do in order to complete mergers or acquisitions is to try to come up with some form of concession or a written agreement that states that they will keep prices low or maybe spin off to another airline, maybe a couple of hubs, basically. So that is also a possibility that could impact not only the deal itself, but also the stock price for both of these companies.
A meeting in the middle of the two sides negotiating.
Price is low for M&A.
Solution. We'll see what happens. Certainly an interesting update here, but as you said, maybe not a completely surprising one in this saga as these two attempt to become one. But Kevin, we'll leave it there. Thanks as always for the update. Let's bring back in Jenny. Time for FOMO. Looking at the EV space, and no, it's not Tesla today. We're looking at Rivian.
We talk about Rivian almost as much, but I would say the difference between Rivian and Tesla's, Rivian isn't usually the most positive news, and we saw shares touch
more exciting.
a 52-week low
But
earlier
not for
in
the
today's
stock.
session. Now it's up
Not for
about
the
10 cents
markets.
off of that, but
I don't
relatively
know,
speaking,
maybe.
this name has been a more longer-term story of pain. Now, the news we got today is they are raising cash. The street clearly isn't too pleased. They did announce plans to raise about $1.3 billion in green convertible senior notes that will mature in 2029. Now, these convertible notes will offer investors the security and interest payments of bonds, while also giving them some upside in the performance of the company's overall stock price. The green portion, which I thought was actually the more interesting portion, does offer the debt, or it relates to the debt issues that will eventually fund these environmentally responsible projects. However, overall, convertible notes are typically seen as less expensive than bonds for a company. So while the companies like them, investors do not. They can also really be seen as dilution. And I think dilution is the main reason we are seeing shares sell off today in reaction, Alex, is that right now, and we don't want to see these diluted investors' stakes in the company, so investors not too
Stuck
pleased.
at 152.
Now, the timing of it's a
Cost
little bit
basis?
confusing because the company did just report at end of the year 2022 with about $12 billion on its balance sheet, but in this whole space collectively, the concern lately has been their cash. Are they running out of cash? I believe it was Lee Auto that they even flagged the fact that they're running out of cash. And of course, they're not all created equal, but I think the cash at hand, if you're able to raise any, is still a positive for an EV maker. It's one that's relatively new to the sphere, like a Rivian. So two ways to look at this. Street's not liking the reaction, but I think a lot of these companies just need to get their balance sheets up.
Yeah, this is a little bit more complex, but it can be made somewhat simple. I mean, I think you hit the main piece here, which is these can be converted into stock shares. Therefore, there's going to be more stock shares, all clamoring to the same value of the company. Makes sense. Dilute your position potentially over time. However, if this company needs money to operate and survive, well, you want it to raise money, because if it can't raise the money, even if it dilutes your position, letting it still exist is better than it going to zero. Not to say that Rivian was on its way to zero or that it was in a dire state to get cash. In fact, I think possibly the opposite is the takeaway here. They're taking a fairly prudent approach, of which is raise money when you can, not when you have to. It costs a little bit less when you're not in that dire situation. Look no further than Carvana and some of the pricing woes that they had trying to raise some capital in the debt markets when things were a little bit more dire. The interest rates are, let's just be honest, not favorable in those marketplaces when you're not in a good position. Bed Bath & Beyond, very similar as well. And so in the case of Rivian, maybe it's somewhere in between. They probably need this money down the line. They know they're going to need this money down the line. Why not raise it now, especially if they feel maybe interest rates will go higher from here. Maybe they feel that the stock right now, being as suppressed as it has been over the last year, offers an interesting discount to potential investors who are looking
Spies
at this
getting
from
no
a
relief,
convertible
man.
share offering standpoint. And so I think there's a lot to take away here, but just because the stock is down in response to this doesn't, in my mind, necessarily mean that it's negative. It's just sort of the math behind it. There's more shares potentially down the road. It's only natural, all else equal, that share price would go down.
Yeah, and I like that. Don't raise cash like when you have to. Just do it on a sort of need-be basis. So I think that's a good takeaway. And like you said, this negative reaction doesn't mean this is bad news. It's just the way the street is interpreting it. And I feel like there's a fine line to walk between the two. But trading this name's difficult because, like I said, we are down about 91% from its high back in November of 2021 now.
Yeah, well, and say you're looking at this
Buy
one through the
flush.
lens of a belief in this company,
Yep,
and
we've
you
got
think this stock
397. I'm gonna
ultimately
put a
is going
line
to
for
go
that gap
higher
fill.
because of the projects they're working on, because of the vehicles they're creating, whatever the
Might be
reason
some
may
levels
be.
before there, but
And looking at this as an opportunity because the stock's gone down as a result, getting in at effectively the all-time low prices here for this one. I looked at a very similar strategy to what we just looked at in Stitch Fix, looking at buying a call vertical, going out to April in this case, however.
getting bullish on it.
Buying
What the heck?
one strike in the money, selling one
I don't think
strike
this is
out
done.
of the money on this one. The 12.5, 17.5, $5 wide.
It just broke
We're able to
all-time
do
lows.
this
He's
for a
doing calls.
250 debit.
It's like Jason.
Well, that would make a break even around
Jason, is
50.
that you?
Look at that. Stock's trading at 15.10.
Are you on
so
the
that
TV?
checks that one box of sort of our loose guidelines. Trade near the break-even
yeah,
point
I
on
think
these
this thing's
directional
gonna
trades. And
keep
again,
selling off,
250 is
especially with the
1/2 of
market the way it's
5.
gonna go.
So we have that equal risk to reward. So a lot of the same things that we just talked about in Stitch Fix apply here in terms of
Better than
the structure of the
ChatGPT.
trade. But again,
Yeah,
can't stress
Don
it
was
enough.
at a
Need to be
genius.
right for this one to make money. Max profit above 17.5. Max loss below 12.5. Break even close to where we're trading here at 15. All of
I
this
was even thinking
applies
about
at
going
the
short on this,
expiration
which
date.
market is
And
flushed.
again, elongated Z-risk profile. So all
Which I
three
think
of our
I
trades
will.
have been vertical spreads. Just the last two have been
Tesla's
debit
not going to
spreads.
take
That
me
break
down
even
to
is right in the middle,
Chinatown.
as
I'll take it with
opposed to,
Rivian.
in that max profitability zone. But one that is taking a little bit more of an optimistic look at Rivian, maybe seeing the down move today as an opportunity to get in.
Yeah, and one I'd
Quite
say is moving
optimistic.
complete inverse to a Dick's Sporting Goods because now instead of Dick's being up about 11%, we're seeing Rivian shares down almost 12% on the day and continuing to extend those losses into the back half of this trading session. But that does it for our FOMO segment today. Now coming up next, we will look at Sea Limited. The Singapore-based company will dive more into its price action. Shares are up over 22% on the day. We'll tell you why coming up next.
Market's flushing there. A lot of liquidity on this Rivian chain. I like it. All right, I just got some bearishness on Riv. Did Rivian March 15.5, 13 put debit spread. Market's really selling off here. Also in Pfizer? So this line's a gap fill down here, 397.86. Market's down 1.5%. Ooh, I needed more shorts. Yeah, BBY filled the gap today. If we stay flat, price action's looking still more bearish. Breaking that inverted head and shoulders yesterday wasn't great, and now breaking this low. Not setting up an RSI divergence yet. If we kind of melt our way back up today, showing some support, maybe this was the low, but this looks like a bear flag. And we still have another support level down here that we could reach to, that 127. But yeah, any prices down here I've been picking up at anyways. The downward momentum has definitely slowed. Okay. One of those financial jokes, those smart financial jokes. Pfizer makes Viagra. Yeah, I guess I just don't think about that when I hear PFE. Oh, BBBY breaking out of the barcode. I dare you to test my covered calls. I dare you. It's getting this little inverse to the SPY action. GME dumping on that with the market. Now I can start watching Rivian. Tesla's just way too strong. Maybe the other EVs dumping would be bullish for Tesla. They're usually correlated, but I wonder if at some point it'll just, people move their money from Rivian and Lucid and move them over to Tesla. Not every day you get a financial genitalia joke. It's true, I'm not well versed. Link, it's right here. There you go.
Shopify, or a block formerly known as Square, partially it was through its C-Money and Shopee e-commerce platforms, but then it also is, for those who are familiar with Twitch, which of course falls under the Amazon umbrella, its Garena platform for that kind of reminds me of that live streaming kind of video game centric content. But it's going to do it for C. Obviously a really impressive move here, surprise on the bottom line, really sending this one higher, about 22%. But we're going to take a short break. When we get back, it's time for Under 30. WW International, a lot of news to get through here. George is going to give us the latest post-earnings move on the company formerly known as Weight Watchers. We'll get behind the news right after this.
What? Yes, 1911. 39.17. It's not a divergence though. This isn't lower. There's a lower RSI with lower price. This would have to come lower. You could say there's one on like the 4 hour. Or no, what is it, the hourly? Here, but you're kind of gapping over this one then. Like these lows where this RSI was here. Now this low and the RSI is higher. Like you kind of say that's starting to diverge. I don't know why I'd be so high. But I keep selling calls and puts, so. Ah, that was a hip pop. Did you hear that? Alright, we're at the high of the little spike from earlier. 137 on BBBY. It's inverting the market. Get a little inversion. I'm not seeing that divergence yet. Beachbody is up. I know, we're waiting for that divergence, but we'll have to get a lower low on BBBY. That was too condensed. So a lower low, lower than 127. So maybe find a bounce at 116 if we break that. This is the IPO high from 1993 or something. I don't know if those levels from that long ago really matter anymore. If we grind up, if Bed Bath grinds up though, and tomorrow's even flat, we'll get a MACD crossover. One step closer to our 9, green over our 9 moving average.
Senior markets correspondent for the network. So, George, tell me if I'm getting this correctly, because I'd say there was a pretty lackluster fourth quarter, but this telehealth service is more in focus.
Yeah, this is an interesting situation. I mean, if you look at the price action today, it's let's call it a remarkable move, to say the least, up 50% or close to that right now. For I'm going to call it Weight Watchers. I know it's WW International, but it is the former Weight Watchers, which, you know, for those who don't know, I'm sure you do know, that's effectively a weight management provider of foods and nutritional products, but also services like coaching, consulting services for those who have who are watching their weight or wish to lose weight. I think if you look at the report in terms of adjusted earnings, this is a quarter where they took a one-time charge for various reasons, and they missed the estimates quite considerably. The estimate was expected on an adjusted basis, 11 cents of a loss. They came in at 46-cent loss. But
Yeah,
also,
I mean, it doesn't seem like the IV's going to come down, so
the gap estimate, which
only
was
up from here, I guess.
gain, has to be expected. But sales in the quarter year over year were down about 19%, missing the estimates. Well, at the same time, even things like subscription revenue were down about 16%. So
Wrath coming in hot.
The nature of what's
All that
happening
link
there
I shared
for
and update your
WW.
share
One,
count.
You know, people are, I think, watching their pocketbooks right now versus more their weights because of inflation, and those are concerns. So maybe, you know, some of the services that are more discretionary natures, perhaps the coaching and nutritional advice services that Weight Watchers provides, is something that people are starting to cancel because of what's going on with inflation. But there's also something interesting here, because when I went and looked at the stock, if you actually look at a 5-year chart, the stock is down remarkably a lot. It was trading around $100 a share back in 2018, and now it's trading at around, you know, a little less than $6 a share. So we're seeing essentially a more than 90% decline in the last 5 years.
This thing has just been melting down
And I think
slowly.
what's happening here for WW is not necessarily a quarterly issue or even an inflation issue or a pandemic issue. I think it's a secular issue, because if you look at sales, at least in the last 4 quarters, they were about a little over $1 billion versus 2018.
And from Reddit as a whole, all of Reddit.
There's some structural challenges with the company, not necessarily as a business operating. I think it's demand for their products and services. They do generate licensing revenue. They do have a lot of marketing expenses, but you have to think about sort of the culture now, the Instagram culture,
Maybe I
the
think a better
influencer
one.
culture, and the competition for nutritional advice and coaching.
I know,
It's
yeah.
one of
The,
the challenges that WW
you're saying like the shorter term is the same.
Possibly why we're seeing a secular decline of the stock. Nonetheless,
Yeah, it's the same.
Very
It's
nice
crazy.
move today, but we have to consider that secular decline may continue.
I think that's a really, really important
A reason
point.
to go to
We're looking
Leaps.
at a stock that's declined like
Doesn't get
95%
any
since its
cheaper.
all-time highs. Doesn't take a genius to figure out that probably means the company's struggling in some capacity. And you mentioned maybe the key reason why, which is this information can be got so many places, of which so much of it is highly credible and free. If I have to pay for it here, and I can just go on YouTube and get it from some influencer or somebody who just simply pays for promoted videos and they pop up before, why wouldn't I just do that? And that's sort of been the new culture, especially amongst younger demographics. Everything I need to do, if I don't know how to do something, I YouTube it, or I Google it, I do something, and I'll get somewhere to free information that shows me step by step how to do what I'm trying to do for the most part. And I think that's been a huge story. We talked about this yesterday on Market on Close when these earnings came out. But I think that explains,
I know the Leafs, the IP is insane still.
You just have a heavily shorted stock.
People are like, the Leafs are so cheap.
But two,
I'm like, the stock is so cheap.
Different. They understand the landscape. Hey, look, we can't compete on a paid subscription model versus free content that's offering basically
You're
the
not
same
used to
thing.
looking at penny stock options. It's like, yeah, it's gonna be
a
cheap.
telehealth company so that we can now do all the steps as opposed to just being a content company. I don't know if it's going to work, George, but they're trying something, and investors have to be at least happy that they're trying.
That's the thing. And the point is, and I think you're spot on. If you think about subscription services, you know, the freemium content that's out there versus the paid subscriptions that WW provides their clients.
Yeah, here's the leap. Look, it's basically stayed
I mean,
just barely melted down.
That's where the growth really is in terms of EBITDA growth, and I think that's again where the
Hasn't lost
challenge lies for
value.
the company. But at the same time, trying to bolt on a telehealth company that focuses on, you know, things like chronic obesity and health concerns.
Impressive was a
associated with
month ago
chronic
almost.
obesity. It's a step in the right direction, but you have to consider again: is that something that's going to be accretive in the near term or intermediate term? Now, the stock reaction today speaks to, hey, this is a transitional acquisition, this $106 million acquisition of
Sequence.
Sequence.
We'll see. Didn't
Is
quite
it,
fill
is
that
it
gap
going to
yet.
be accretive in the intermediate term or in the longer term? I think the reaction today, honestly, you know, you have to stick with the earnings trends, the revenue trends.
Might close my shorts
You know,
at
you
some
also
point.
have
I
to
might end
consider
up just
balance sheet
flipping them.
trends. The debt of the company is around
Flipping
$1.5
back in on a
billion,
bounce.
considering the equity is around $280 million. Has a lot of debt.
I think
and
it's
got
bearish coming
contraction
tomorrow,
EBITDA, growth and net income margin that is negative. So I think these, again,
just hold
are
and
issues
add.
that are going to plague the company, at least in the intermediate term. But nonetheless, you see in the short term a huge move. And if you look at the share short as a percent of the free float, it's about 13%. I've seen higher, I've seen lower. But I think it's catching wind today because, you know, with the market down, you know, traders and speculators will latch on to anything that's moving. And I think that's the case here for Weight Watchers and why the stock is moving considerably higher. But again, you have to be cautious because the financial fundamentals and the secular trends that we talked about are still plaguing the company, are going to put pressure on the stock price.
Yeah, George, a really good point. I think I saw a headline that mentioned that key buzzword Ozempic, and I think the street went nuts, but important to look at more of the long-term story here. So appreciate that really good point. George Tillis, senior markets correspondent for the network. That does it for Alex and myself today for Next Gen Investing. Coming up next, we have the watch list with Renita Young hosting today.
Yeah, thankfully BBY is still pro options, even though they're pro DRS. I don't know who are playing the BBY options though. I mean, I know some retail is, but the open interest on this stuff, these got to be big players. I mean, these are huge amounts, and it stayed this way. Like every week, there's a gamma ramp. That week there's not. $2 is it. There you go, mid to end of April. So big expectations for March. Now end of April. Once this thing starts going, like it starts lightening up a bit. Even June, like August, not as much. Guess who's back? Back again. Now that everyone's into BBY now. At 174? How do you have a 174 cost basis? That's pretty bad. No, I'm just playing. 174. That's awesome. You must have had a lot of cash on hand because you were telling us to buy. Under $3, you were just saying all these shares you were buying. So I don't know how you got it down to 1.7. I think you have infinite liquidity as well. Four and one away, we should be bullish. But oh, on BBY 411? No, that soon? They just had earnings. Oh, I guess yeah, it could be. I actually thought about calling 411 the other day, and I'm like, I don't think they're around anymore. My what the? Our power was out, and then go to use my phone, and my service is out. Like, wait a minute. I can make a phone call, but I don't have any numbers. I don't have mobile data. Like, this has been a long time. I have to go, like, find a phone book. Like, wait, 411. Were their earnings actually delayed? Why are you glad it hasn't gone to 124? You can still get phone books, yeah. They still deliver them. I remember getting delivered phone books. Well, that was like 5 years ago I was getting delivered phone books. You're just high society, Don. You don't live in the hood. We use phone books to look up numbers and make fires. Remember, I made the money on the run to 7 3 weeks ago. I remember you talking about it. Alright, might close these shorts. That gas made a new little high there.
The fact that it does expect its fiscal year earnings to come in well above consensus. So it's been pretty rare to see a retailer give guidance that came in so much ahead of what the street had been bracing for. Their CEO highlighted the company will grow its sales and earnings in 2023 through the return to this square footage growth and higher merchandise margin, and highlighted their sales did grow a whopping 41% from even pre-pandemic levels. The CFO, on the other hand, did note that 80% of the company's history compared to 2019 was driven by growth.
There's a connection with GME and BBY.
Team sports and golf.
I mean, if there is, we won't necessarily know at earnings.
They
don't really mention much at earnings.
Dollar the consumer has is
anyways,
still being prioritized to their athletic apparel.
Oh, new high there on BBY as far as this uptrend goes.
I think that's interesting, the way that we are prioritizing our final dollars. I can speak to that. I think I admitted earlier on Fast Market that I view my purchases of running shoes as a staple. It is not discretionary to me because it's that important to me. So I can see why there is a degree of resiliency or outperformance even in Dick's Sporting Goods.
Oh, the kids' minds.
Even holding on in spite of the market.
Thanks, good.
Absolutely, I could totally see that. And
good
we
kindling.
know you're training for another marathon, so that's super awesome. But
or you can go to the street corner and use it to clean windows.
American Airlines.
The ink in the pages helps absorb the water you spray on people's windshields.
Shares are up just shy of 4% after seeing a good deal of selling yesterday, but all in all, the analyst community still feels very positive on this name. I actually talked about Delta earlier.
Pretty bullish here on Bed Bath.
The outperformance
pretty good
of a
melt
name
up,
like
really.
United. They're up up 45% this year and up 79% from their
Broken
low, and now
resistance,
just slightly off of
the
their
support from the other day.
XA and BNP analysts did double
That's a
upgrade
good sign.
United shares to outperform from underperform.
Bouncing back
with
up
a
above that.
$70 price target, implying just shy of
Close
$15
up
of upside
over
from
1.5 this
early
week would be
trading. This
pretty
name
solid
does
for
have a
next week.
consistent outperform rating among analysts, with price targets ranging from about $40 a share all the way to 81. So then this puts Exane's price target just at the higher
150
end
calls,
of
get
that
yourself rich.
range. We also have gotten recent price
I'm selling
raises
150
from other
calls.
analysts
I'm
like
getting rich.
Barclays, Goldman Sachs. So while we have seen some volatility in this space, we have seen also consistent.
You do keep it, yeah,
stronger
plastic
feelings from
tote.
that analyst community.
Yeah,
I also
newspapers
wanted to
are
point out
good
a
for
fun
cleaning
fact I saw
windows.
this morning, Renita, and that was listing all of the airports with the highest
I worked at
delays.
a
And
valet, like
number
a
one
really
on that
high-end
list,
hotel
how
in a
lucky are
mountain
we,
resort
was
town.
Chicago O'Hare International
We would always,
Airport,
we would like
ranking
clean
the
windows in the cars
highest
and
in
stuff.
delays from 2019 through the end of 2022.
I'm not surprised.
Yeah, we'd pull out newspaper to do it. It's
I was
funny.
surprised. I feel like I've been delayed more in New York or LAX. I was surprised, but I guess maybe we're immune to it at this point.
Maybe so,
I'm
right?
fine with the
I
shares at
stopped
these
flying
prices.
out there
The
as
share
much
price
as
gets
I
lower, but
could
the options
years ago,
don't
but
really get lower.
Jenny, thank you so
Your
much
IB is still
for giving us
pumped.
a breakdown of those couple of stocks. So now let's take a look
so
at
yeah, I mean,
the
it's,
bigger picture.
it could go up from
with
here, but
Russell Stone, he's the CEO and owner of Scranton
you know,
Financial. Russell,
I'm fine
thank
with
you
the
so much for
return on
joining
shares,
us.
I guess.
Let's start first
It's all
with
the
Powell's
options once
speech
it
today.
starts rallying
What were
some
your
more.
thoughts on his more hawkish tone?
It was
Oh,
predictable
net
that
gas
he was going to have to get more
broke it.
hawkish for a number of reasons, Renita.
The upside.
The Fed
Dang.
has this illusion that they can control the interest rates under any environment, and that's not true. When fear starts to enter into the narrative, then the fear of default takes over, and the interest rates become
our
much more
so-blessed hurricane.
unpredictable.
I agree.
And my prediction is that interest rates are going to trend up
Spray away,
fairly
glass cleaner.
aggressively in the
Is that the
coming weeks
is that the
and months,
foamy
and
one
maybe even for the
that comes
balance of
out in
this year,
foams?
only because of fear of default. The credit bubble is large; it's contracted.
150 for
the
next
Fed is
week. Easy
pulling
money.
money back into the out of the M2 money supply. So it doesn't surprise me at all that he's getting more hawkish, because I think he's being forced to become more hawkish.
Exactly. And so at some point, the data is going to have to meet up with that. Maybe, maybe not. We've definitely seen a mix lately. But what kind of impact could we expect from interest rates continuing to go up? Let's talk first about the consumer. And then
Yeah,
we'll talk
foam.
about
All right, yeah,
what
I've
may
used that stuff.
happen with stocks.
Okay. Well, the consumer, it's, depends on what side of the equation you're on. If you're a saver and you don't have any debt, then your interest rates on your CDs are going up, and money market accounts and savings accounts, traditional fixed annuity, stuff like that, those interest rates are going up. The dividends
You're a
on
player,
your
you're a
stocks might
player.
be going down.
You're a player.
All depends on the profit margins. But the consumer is going to be impacted negatively when it comes to the cost of the things. So if you're maxing out your credit cards, or if you have
Cosm's
high consumer
15%.
debt, the rise in
That's
interest rates
that's holding
is
up real nice.
devastating. And on top of that,
This will probably have a
with
continuation.
inflation, that is a 1-2 punch
Some
that
options like,
is
nope.
going to impact the economy. It already is.
So how are you advising people to prepare for something like this?
That gas moving up more.
Well, it's.
I'm not even
Let me put this out
doing
here
anything
first.
with that gas.
There is good news coming. The problem is
I don't know
it's
what to
coming.
do.
It's not here yet. We have to go through some hard times before we get to the rebalancing of the equity markets and the stock market and the economy as a whole. But right now, the overwhelming economies throughout the world actually are running on debt. They're not running on value. They're not running on gold, silver. The currency system is based on a petrodollar right now.
Okay, I bought some
That is backed
Cosm
by
shares.
OPEC oil and $32 trillion
Got a
of debt. So
bullish news
there's
catalyst.
lots of problems
Yeah, the
surrounding
chart looks
that arena.
very
But
nice.
at the end of the day, we are going to have to just attack the problem, which is the monetary policy, the massive amount
Yeah,
of
engulfing
debt.
candle back
The
here.
rise in interest rates are going to have a big
Good
impact on
volume.
the
Got Queen
economy.
of the
There we
9.
are,
Bullish
like I
MACD.
said, housing market.
But just this intraday
car
bull
market,
flag is.
Big tech has already started their layoffs. So.
No, I was
I'm
agreeing
sorry.
with you. You're absolutely right. And we're seeing even more layoffs
BBBY.
happening with big tech. Doing a second round, we got a report about Meta possibly doing the same thing again.
Yeah, absolutely. And think about it. These are the jobs that pay benefits. These are the jobs that provide excess money above and beyond the inflation. So a lot of people that are struggling, they're barely making ends meet, and then they have this big inflation.
They're more
bill
fun
to pay on
AZG
top of it.
combined.
So
It's
that's
true.
struggling. We haven't seen the full impact of that yet. It's not showing up in the numbers as we would like, because a lot of people are working 2 jobs, not 1. So the jobs numbers are skewed because so many people are out there not making their ends meet on 1 job, so they have to go out there and supplement it with a 2nd job, part-time or full-time. So those aren't the type of dynamics that you would be.
Last reports I saw on the
stock
short interest
market.
were like
And when you say, what are you doing with
99%,
your clients, Russ?
98%
Well, I'm telling
on
them pay
BBBY.
off short-term debt. I'm telling them to buy precious metals, invest in money market accounts that only use treasury bills as the underlying asset, and just get ready, be patient, get ready for the opportunity at the bottom of all this. People should get excited. There's going to be some great opportunities at the bottom, but we're not nowhere near it yet. We have at least a year to go before we see the bottom of this market. The bottom of deflation is a word that's going to pop up a lot.
You're absolutely right. Briefly, can you tell us a couple of industries that could be affected the most by this time?
I saw it from different stuff, not just Ortex.
Obviously, retail.
But yeah, maybe it was an exchange report. I'm not sure, Don.
Is going to be more resilient than something. Well, let me rephrase that. Anything that is a want is going to be negatively impacted more so than a need.
I think I'm going to close my shorts here.
If I'm going to invest money, I'm going to focus on the need side of the economy, not on
just
the
like
want
scale
side.
out.
You know, luxury
Close
cars,
one.
I don't think are going to be doing that well. RVs are struggling right now. The sales of RVs are way down. High-end cars are way down. Luxury items are way down. But if you look on the side of the needs, you know, food's always going to be around. Alcohol, cigarettes, all the sin stuff is going to be there and still doing fairly well against the tide. Defensive stocks are always there. Utilities, anything military oftentimes is resilient against deflation.
Yes.
But the overriding theme is deflation, right? The demand is going to go down. There is a scenario where prices go down, interest rates go up, and the stock market comes down.
Right.
And that's called the 1930s.
Ha! Do we want to live there again? I don't think so. Russell Stone, thank you so
bullish
much
as I wish
for
now
joining
with
us
BY,
as
they
the
never
owner
let
of
close it
Scranton
green.
Financial. I appreciate you spending the time here.
What, Trace?
Now later this hour, we'll take a
Don't
look
let
at
it close
that
green on a red
potential
market.
ban of TikTok and what kind of impact it could have for stocks.
Yeah, maybe not. But relative strength of it,
world of actively
regardless,
managed
is very good. You might even have negative beta. I haven't even looked up the beta on it. Beta is kind of annoying because it depends on your time frame and a lot of factors, so you get different numbers. But see if we can get some number. This says it's positive 1.33. What is that? That's Barron's. Hurricane, did you put your share count in the poll, in the census on the subreddit? They're doing a share count. Go put your shares in there if you own BBBY. Beta, yeah, 5-year monthly is 1.55. I don't know. I feel like we've seen negative. Yeah, Yahoo shows 99. 57 on Fidelity. That'd be a pretty big turnaround if BBY was green today by end of day. Pretty solid sign of a floor. That would maybe even get us a bullish MACD also. I'm going to close another one of these shorts. I might just hold one, and that'll help me mentally to average in up here when I'm already green on it. All right. Thanks for your thumbs up today, guys. It's a fun day watching the Senate, pound Powell. Tomorrow we're gonna get the House. Powell testifies to the House, and unemployment numbers, U.S. trade balance, JOLTS job openings. And at 2 is Beige Book. Beige Book, where you can chat with your friends on social media. Now if it keeps flushing, do I add? No, I gotta wait. Gotta wait. Add on a bounce. Get this rally on this reverse merger or reverse split day. To me, it looks like it's probably going to come back down to that 16-ish level. Since it's not doing its pre-earnings rally, and the market's not going to be pumping, I don't think.
At 20% or higher over the next several years. We're also looking at Delta Airlines after Evercore ISI upgraded the stock to outperform. The analyst believes its planned June Investor Day in Atlanta will give Delta a good opportunity to refine financial targets.
That'd be so sketchy driving that thing, bouncing around up there.
We can see it's down about 0.6%. They're looking, not the best it's been, but we'll see if it drops.
If you own BBY shares and haven't posted your share amount on there, go do it.
At Technical Tuesday.
They're taking a share count.
Kevin Horner, Senior Manager
so
of
far,
Trading Services Education.
1,300 people or so own 10% of the float.
You have a couple of stocks to highlight.
Thanks for your thumbs up, guys.
But let's start with the big picture and tell us what you're seeing with the S&P 500.
Eyes bouncing up here a little bit.
Sure.
Yeah, see where we can get inverse to downside.
Happy to. So, I thought today's action was pretty darn interesting. Obviously, the market reacting to the idea of rates higher for longer, maybe even higher than expected. I thought yesterday's candle in particular, if we were to look at it on a candlestick basis, was a little bit informative because there was a clear level of resistance for us at about 4,080 on the SPX. And we got into that level and it brought some selling. And then unfortunately this morning, things just started off rather weak. And it's been a real continuation of that move, a range full day today. I don't expect to get a bounce here given the nature of the move. And so now what I think a lot of traders are positioned on are the lows from last week, keeping a real close eye on about 39.30 to 39.40 on the SPX. That'll be coincident with the 200-day moving average. I think it's a very important short-term ledge. It would basically allow the bulls to say that they're continuing the uptrend that's been in place since mid-October here, if that were to occur. Now, obviously, a break of that could bring some more risk-off feelings for a lot of the marketplace. So that makes 3,030, 3,025 a very important, 39.25, pardon me, a very important level here in the near term should we visit it over the coming couple of days.
Let's get stock specific. I'm interested in what you're watching
with
Boston Beer. This stock had a crazy, amazing run during the pandemic. It went up to close to about $1,300 a share. Is there a possibility that it could ever have that much success ever again?
Well, I think that's a fantastic question to ask. I really feel like the proper takeaway is to not grow in love with prior prices. A market technician, a trader of technical analysis tries hard not to pay attention to necessarily what had happened, meaning you can't anchor to the belief that this was once a $1,000 to $1,100, $1,300 stock and believe it can get back there. And I think this is a prime example because this stock was in a pretty good range heading into COVID. When COVID came, it took the stock down pretty aggressively like everything, and then it rallied enormously. And that move was off of 290 up to nearly 1,300, as you clearly pointed out. It was substantial. Now, when the numbers didn't support it and it didn't materialize, things came back to earth. So what you've had now is a 12, 13-month trading range between 290 and 420 or so, and that is very clearly established. Now, it doesn't mean we can't break higher or take out that 420 level, of course. When you get into a sideways consolidation like this, it's a very comfortable way for longer-term traders to start to position themselves. But I would caution traders from looking at it and saying, well, I can buy it at 300 and feel comfortable near term. I would caution against the idea that you're due to get a move similar to what we got COVID, moving from 300 to 1350. But that said, the range is substantial. It's 100 plus points. And so a trader who's willing to be a buyer at support and a seller at resistance can look to do just that, which has worked very well. Now, unfortunately, under 290, that changes. So you, as always, regardless of time frame, you have to know where it is you want to move on from
might
your
be at support
position.
now.
So bear that and keep that in mind. Last note on this, though, Renita, is that this was a textbook scenario with a stock that moved aggressively to the upside and then just found itself all the way back where it began. It's a fantastic case study in why traders need to look to take profits when given the opportunities to do so.
Well said, and you're right. You have a huge case to go on that.
Yeah, BBY intraday is
lastly,
holding up pretty well now.
Let's take a look at Netflix.
After that gap fill
almost
this
in the
morning.
opposite direction. It was a leader to the downside in 2022. What are you seeing with Netflix?
Well, it's been a fantastic stock off of its lows, which really began in July. One of the reasons this is interesting, I think, is that it, as you said, a leader to the downside, led the market lower early in 2022. In fact, it began its breakdown in late 2021. So you had a stock that was a leader amongst the high growth.
See if the market gets any kind of balancing power.
Had done very well for itself, and then things collapsed in advance of our broad market downturn. So what's interesting to me about this one is this has turned the corner, so to speak, earlier than the broad market. It began its upward move in July, and you've really been working quite nicely against a 100-day moving average. That's that gentle sloping line within the channel. So you've got two pieces of important data at the ledge we reside on here, right around 310. So a lot of traders are going to try and see if this trend line that's been working since July holds.
Nice, kind of coming back down here.
So because it has been working for 7 months or so. So now it's a very important spot if this trend is to continue. If we fail here at the 100-day, we could find ourselves somewhere.
I literally
in no
bought the
man's
thing that's the
land
highest
down
on the
around,
watch
say,
list.
270
Not
to
usually a good
280,
strategy.
coincident with the 200-day
But it looks
moving
bullish.
average, which wouldn't be horrible. It wouldn't really break the uptrend per se that's been working, but it would break the channel, and that might mean a longer period to get back into said
Plus
channel.
it's just rejecting at
this is an
50.
interesting spot given the nature of the trend for anyone willing to step in for what could be a good risk versus reward opportunity, because if you're wrong, you're going to know it rather quickly from here.
Good point as well. Kevin Horner of Charles Schwab, thanks for joining us. Now, coming
My
up
pleasure.
next,
Thank you.
of course,
BlackBerry's down
coming up
12%.
next, we'll dive into the potential ban of TikTok and how it'll impact social media stocks like Snap and Meta. We're breaking it all down next on Trading 360.
Just a little bounce, now it's giving it all back. Goodbye. Bed Bath. Bye-bye kidney to infinity and beyond. Talking about teed up? Oh, thread up. Yeah, I actually had an idea to do something like this before, like, basically buy clothes from thrift stores, resell them. I think that's what they do more or less. They're just doing women's and kids. I didn't like just the idea of not being able to get a lot of inventory. Like, if you're going for certain stuff, like, I don't know, stylish stuff or stuff that you like, it's like, it takes a lot of time to really find good stuff in thrift stores. I don't know how they do it. Probably should have to branch out to stuff that's more valuable. Get deals with thrift stores. See the merchandise first. Me coming down. About to make a new low. Online consignment, yeah. They have earnings or something? Yeah. 71 million in revenue, that's crazy.
They're more kind of warming up to the idea of banning TikTok here. You are going to get a
We'll send them stuff.
bipartisan bill today at 3
They'd
p.m.
have to.
Coming out with some details
Yeah, that would be a better way to do it.
on that side of things. So it is starting to gain some
Have to filter out. You don't just want
steam within
everything sent.
Congress in terms of a potential ban out there. We're still placing a less than 50% probability of that taking place.
AI in their name. So there is that.
We were 6 months ago. I would have told you they'd probably be about a less than 10% probability.
They have consignment and they have just their own, so
the fact that the
probably
probability
some of
is
both.
actually going up, I think is definitely a good thing here for a lot of these existing, social media companies out there.
Briefly, can you refresh our memory of what the sticking point is with Democrats who may not want this ban?
Yeah, well, listen, I think as far as when you start thinking about what Democrats are kind of mindful of is you've got an actual election taking place in 2024, right? You've got an app that's actually extremely popular and actually helped the Democrats win the election a couple of years ago. So I think Democrats out there are extremely careful. Or trying to be careful about the entire situation here. I think clearly we are seeing kind of intensifying pressures out there on the geopolitical side of things between the U.S. and China. And
The gas looks bullish again on the hourly.
Helping kind of push the probability of a potential ban out there. But I think at the end of the day, a lot of Democrats out there are very mindful of what we saw here from
Start
the
dip buying.
Biden-Trump
Wait for at least to be what move.
and how Biden won there. And I think, at the end of the day, you
Good morning from
want
Jamaica.
to be mindful going into a very important election year next year.
Makes sense. So let's talk about companies, stocks. Who stands to benefit the most in the United States?
Yeah, I think, listen, at the end of the day, the company that probably stands to benefit the most is Snap. And, You kind of see it in the stock move yesterday and some, additional kind of movement here today. But, most
needs to
people
wipe
out
his
there will
lens.
say Meta as well as Alphabet's YouTube business will take the lion's share of the money out there should we potentially see a TikTok ban. And that's absolutely true. But we think Snap will be the biggest beneficiary for two reasons. One, Snap caters to the environment much better or
Professional
much
cloud
more
Twitter.
Closely in terms of demographics relative to TikTok out there in terms of kind
Elb
of the Gen
is
Z
up.
population. If you kind of look at the percentage
Oh,
of
snap.
revenue exposure, Snap is exposed to, or the user base relative to that of TikTok. It almost kind of mirrors each other in
Where's
many
Ace?
respects in terms of the Gen Z exposure, 11 and 26 category. Now, when you think also,
Maybe it'll double
secondly,
bottom here on
Snap's
SPY.
smaller scale also will
Maybe
be a
close my last
benefit to
short
that
and go long on a
because
few.
when you look at TikTok here, generated about 10 billion in revenue globally last year. You kind of look in 2023 and 2024, we're looking at about 13 billion and 18 billion. Subsequently,
I'm
and you
here,
kind
eating.
of look at about half of that
Your
coming
baby's
from
moving
the
up.
US alone. You look at Snap's revenue less than $5 billion relative to Meta's at
Wait, I
about
think I still have it too.
100
Yeah, I do.
120 billion or so. Alphabet's closer to 300 billion. Clearly, there's going to be a bigger
probably
impact
average
if
into this
Snap
thing.
can just take about 10% of TikTok's kind of potential revenue in the U.S. So we think that's probably
Christopher.
going to be the biggest winner out there if we were to see a ban. Now, also on the Meta
With
Alphabet
ice.
side of thing, the bigger positive from them is the fact that you don't have that potential juggernaut out there in TikTok.
Yeah, I might
for the
close my
next
short and go
3 to 5
long here,
years that
actually.
could potentially
I don't know.
steal more revenue from them. So they should also
Seems
be a
cheeky,
benefit as
but
well.
It's
I think
really
that's a little
interesting
double
when you think
bottom for
about it
me.
because it's like YouTube was the first video sharing app, right? And then we have Snapchat, which was probably the most popular at some point. It definitely was the most popular short-term,
Elvis is
short-form
moving up.
video app. What's the likelihood that all these remaining apps, all these remaining social media video sharing sites could duke it out?
A lot of
with
dilution on Elvis.
more products, more services, possibly. Might we see some of that heating up the competition?
141 million.
Yeah, I mean, listen, I think at the end of the day, I mean, clearly these companies are all starting to kind of step on each other's toes
Cosm's
in
better buy.
many respects.
I already bought Cosm.
What TikTok is
I
really
just bought that
done here
today.
the
I already
last
have
couple
Pelpis though
years
too.
with their shorter form video format really has disrupted the
Oh,
entire
bear flag now.
industry.
I think
It's
this
really
this
forced
will
the
be
likes
double
of Meta
bottom,
and
but
Alphabet, right? Meta with
I also
Reels
can like it
and
doesn't want to
Alphabet
bottom.
even kind of trying to go more shorter form in nature. And
Nice.
it's really kind of had a negative impact on their revenue base, of course, because shorter form videos aren't going to generate as much ad revenue just because you'll be spending less time on there. So these companies are all going to kind of go on top of each other. But I think, also when you kind of think about the likes of a Snap, going more into subscription.
Natty Gas,
We've
kind of
actually
at that
seen some great success here in the
resistance
initial,
from that range it was
couple of
in.
quarters.
So
I
see if
think
it
you'll start
rejects
seeing
here.
more emphasis on diversifying kind of away from the ad side of things, and I think that should also kind of help kind of offset some of the challenges we're seeing from just a more competitive landscape out there, not only between each other but also from kind of alternatives out there, whether it be kind of the Amazons, the Netflix, and what have you of the world.
All right,
Should be
Angelo
2K
Zeno,
for
thank you so
healthcare.
much for being here. He's senior
BBBY is
analyst
definitely mooning.
at
Yep.
CFRA Research. Now, still ahead on the second half of the show, we'll take a look at actively managed ETFs and find out why more investors and advisors are increasing exposure. And as we head to break, let's take a look at some of today's.
Ooh, there's a flush. Gonna finish filling that gap, maybe. Yeah, new low on the SPY there. We'll see. Might end up being a double bottom still. Showing some support. Whenever there are significant FTDs, there's a run up on the next recap settlement date. The next one's coming up next Tuesday. FTD closeout due dates. SEC rules, but did not delve deeper into the FTD clearing mechanism that is actually used to force closeout FTDs. Calling for a Tuesday. On for a run on Tuesday from FTDs being forced closed. January 11th, settlement date of recaps. BBBY coming down here. 12th, August 16th. January 12th was the peak of it. It was August 16th. So rally into it. Hey, Taryn. Pretty bonanza. Yeah, we had a lot of people in here watching Powell. It was quite entertaining. We're gonna do it again tomorrow. Same time, same place, 10 a.m. Killian inversion with the cross? That's some deep technical analysis. I know, Don, you don't like the forced close. But if there is some correlation with settlement dates and FTDs and rallies, I don't care what you call it. That's a big red candle, man. Bed Bath back to VWAP, sort of. Hey, Jason. Yeah, back to VWAP for it with some volume. Volume today is, I think it'll be close to what yesterday was, maybe a little bit more. We have a couple volume spikes midday. This one, and now this one. talk. Yeah, I think more chat helps. Stop it, Ace. You make me blush. SPY will have some bounces, but what Powell's statement said today was pretty hawkish. So he's talking in front of the House tomorrow. So there'll be some volatility in that time, so maybe some ups and some downs. But what he's said in a written statement's been said, and that's not going to change. You may have some dovish responses to certain questions, which might cause little pumps, but I think the trend to the downside is probably here. We also have job openings tomorrow, jobless claims on Thursday. So I was saying yesterday how we look like we're in this spot right here. So looks like we didn't get a full 4-day rally, but that's funny actually. Today now looks like that day. So there you go. We got a 2-day rally from Bostic, and then this. So I think we're still in kind of this trend. You look. This is Bostic. Got that inverted hammer at a resistance, which is bearish, but we couldn't know. Now we know what Powell said, and that's big red candle. So maybe chill, but I think we'll probably be making this 392 very soon. Are you gonna take responsibility for 2 million jobs lost? Like respectful spam. Exactly. Thanks, Ace. Graceful spam. I'll send it. Halftime speed. That was great. Critter Thunderbird. Sure, Edu B. Burnett. It was entertaining, yep. Yeah, he's good. He doesn't usually get emotionally involved. He's pretty emotionally mature, I would say. Because they try and push his buttons, and they try and say things to him to get a reaction at times, and to get him involved, and they bait him in for sure, but he stays pretty out of it. He got roasted. Stayed straight. Dang, look at that SPY flushing. Woo. And it close and go long there. Whenever too long to have emotions. New low there on SPY, so gap's almost filled. 39.786, I think, is to the dollar, to the cent. 85. So there's 39.7. Should have held all 4 of those, I guess, or 3. Soul left him ages ago. Sunbathing on a yacht. Oh, there's a bounce at the gap fill. Would you look at that? And RSI divergence. Okay, I'm gonna go close my last short and then I guess I'll go long. I just went long with 2. Closed my short, went long with 2. We'll see if it settles down here. Might get some more. I made it for a second, yeah. Show us a picture. I showed you one the other day. I was just minding my own business, taking the tube in London, carrying my laptop. Oh, the engulfing candle I kind of wanted. Oh man, that 5-minute candle just flipped to ugly. Yeah, I'm just for a scalp short trade. I'm gonna be back short on whatever kind of bounce we get into end of day, which might not be anything. This is a pretty muted recovery. I was looking for that gap fill, which it did. And then it was setting up an RSI divergence here, but if this candle flushes it, it won't be. We'll see. Got 2 minutes on it. Jason, I showed you for your eyes only. Oh, that candle's looking ugly. So yeah, now our divergence is gone. Engulfing is gone. Eyes only. Yep. Hot Asian chick. Cute Asian chick in the tube. And it's gone. Got 1 minute left on this candle.
Decelerating sales trends.
Yeah, I feel like we'll probably get a bounce here. VWAP is so high.
Really significant declines on the top line, both for Q1 and the full year. So all in all, things are pretty challenged. The one thing that has changed since the last
day spot night
is they made a change in the CEO seat. They let go of CEO Elizabeth Spaulding, and they brought back the founder Katrina Lake on an interim basis.
Looks like a businessman.
It will be interesting to hear what Katrina has to say about the business and the path forward for the company.
Catch up later.
A permanent CEO in place right now.
You're absolutely
right.
Yeah,
might not make a move up there. That's
changes.
very bearish.
Kevin,
Inverted hammer.
Tell me what metrics you'll be watching when
The candle itself, but sometimes that's
all of them.
I've seen that
but
perceived
the
as
biggest
bullish.
one that I'm really focusing on is going to be the active customers.
Not
We
sure
continue
why.
to see that decelerating as well, and that
Yeah, I might close these
unfortunately has
out.
a direct impact on the top
I think
line
we'll
when
probably
it
come back
comes
up
to
here before
revenue.
close, but
Also, the
I don't want to ride
SG&A
it.
expense, or really the selling, administrative, and general expenses,
Lost our
continues to be,
divergence.
increased
Lost our
compared to the
engulfing.
revenue that they're bringing in. So you want to be able to see that flatten out, or either go to the downside here.
Close
That's
it
going
out
to
and
provide
wait.
them a little bit more
Wait to
wiggle
get
room
a
when it comes to trying
short.
to be profitable, either on an adjusted
For the bounce to
basis
get a
or not
short.
on an adjusted
Yeah, Yeah, there's new low on
This
SPY.
will be a very difficult call, but Tom
Gap is
actually
filled.
correct.
Let's
They
see how
have
much further we're
guided
gonna go
pretty
down here.
conservatively for this number that they were going to be reporting. So if they are able to at least meet those expectations or beat those expectations, it might provide a small catalyst to the upside here. But the overall downward trend on the chart is still intact here.
Yeah, maybe that level. That's quite a
Some
ways down
significant
further still.
volatility. We are expecting around a 17% move to the upside or downside. Yes, it's only a $5 stock, but at the end of the day, percentages matter. So we might see some pretty significant movement here once they report earnings.
Tom, you've got a $3
Hey,
price target on
Gazem.
this stock, and it's a neutral rating.
Gazem.
What could this company possibly do?
Saw something green in the sea of red on my chart. I was surprised. Gazem.
Well, I mean, first off, like, you know, the part of the reason
Yeah,
why
it's getting a
I'm
little
not,
poppy. Yeah,
bullish on the stock
3%.
is just
Nice.
all the
Yeah, this chart looks
volatility
nice.
that we've seen on the
Nice
top
bull flag
line,
here
and,
also.
you know, to Kevin's point,
Sort of.
you know,
Maybe it's a head and shoulders. I don't know.
customer count numbers.
Looks bullish.
And, all in all, there's just been a lot of volatility in this.
Today's setting up
in
an
this
engulfing
business,
too on
and
an inverted
it's
hammer.
hard to just get a gauge
Just
as
fine.
to what the true earnings potential of this company is. Who is
Move
the
up.
customer?
Yeah,
Even,
it has a lot of upside that could happen here in a short amount of time. That's why I like the long. But
subscription, like who wants you know, a box of
it might not move all the way to VWAP, honestly. Like $3.99 might be it.
choose what you want and
Or
send a
even
bunch of stuff back.
$3.98.
You know, is this just a niche product offering?
What am I looking
or is
for?
there actual,
Big money.
you know,
I don't
a
know.
bigger
Ride it
market
until it
opportunity? It's really hard to
dies.
say. So, given the
maybe
given the
move back to
lack of
670 or
visibility, given the
620 or
cloudiness in the
723.
fundamentals, given the questions around
See what happens
business
up there.
model,
Take the
you
momentum
know,
and keep
I'm
going until it
pretty
slows
content,
down.
Staying sidelined on this name.
That's fair. So, Kevin, taking that into account, do you see any way that this company could pivot to something outside
Yeah,
of
there's the moon.
subscription-based model, especially with all the competition, all the other subscription-based models for clothing rentals?
That would be actually a pretty difficult task here, Renita, but it could be something that is possible. I mean, they would have to be able to lay out that vision here for the future. I mean, Tom is absolutely right. I mean, it is a very niche type of product or service offering, and definitely was something that might have been very attractive during the COVID-19 pandemic, as individuals were not able to go out to the stores to be able
Fairly
to buy
optimistic
their own
with your
clothing.
moon
But at
projections,
the end of the
yes.
day, right now, it might be just a little bit too much of a hassle to, once again, send those clothes back if they do not fit, those issues that you're going to be having with that. But if they did have a new market to be able to cater to, Renita, it might be something that might be profitable. I'm just not sure what that type of business model would be, but we can.
As I'm about to break out.
Say that the current
See, it's at the
model is really difficult
at the
for
high of the
them to
day.
monetize, and so
Moving
they're
up.
going to have to develop some form of a strategy here in the near future to get investor confidence in the marketplace. And what's actually very interesting as well, as we see this decline in stock value, you would also imply that maybe the stock has a significant amount of
If it
short
breaks
interest,
here.
but it doesn't. I mean, it's at 17%, but that's relatively low compared to some of the other stocks that we have seen that are in the single digits that have significant amount of short interest. So at the end of the day, there's a lot of headroom that it
That was
could make,
BBBY.
but definitely the downside trend from
Power hour
a fundamental
flush.
standpoint and a technical standpoint.
We're not in power hour yet,
those
and
fundamentals,
we've
you
been
talk about
selling
this
off
business
heavily,
model.
down
Last
1.6%.
question for you, or almost last question, Tom. Is there even a future?
It's looking
for
weak
this
though. Yep,
subscription-based
broke that
model
level there I had drawn. Like we'll probably get
Yeah, I
some
mean,
flushing going on
there
here.
could be a place for it. I mean, the question is it just kind of a niche offering that a small percentage of the population is interested in, or is there a bigger market opportunity? I think at this point, you know,
But you're at the lows.
It's a pretty
Any
niche
short here,
offering, and the
yeah,
addressable market,
you know,
for their core
real
business model,
real quick little
it's
scalp.
pretty small.
Upside
It's
is
pretty narrow.
much more potential to the
They're
upside on
testing
SPY,
a new business
just for
model
today
called
at least.
Freestyle, which is more
I
of a
think.
traditional e-commerce model where you kind of pick one item at a time. But again, like, how does that differentiate you from,
Like I was doing, I'd go long, but
dozens of
then it
other
turned more
e-commerce sites
bearish.
out
So,
there? Then it becomes hard to differentiate.
but not to say it
yourself.
won't come
So,
back here before
all in
close.
all,
I think
you know,
I
does
think it will
seem,
probably pass here.
like they're in a bit of a quandary.
Tom, any stocks, apparel stocks that you do like right now?
Generally speaking, I'm more positively inclined towards the footwear sector, actually, and you know, a couple of names we like.
There it is. Cosm broke out.
Would be Deckers, the parent company of
Nice.
UGG and Hoka. I also like Skechers and Crocs.
All right, briefly, Kevin, any apparel stocks that you're watching?
I would say Nike, Lulu, those are pretty much the main ones that I really focus on here. But the ones that Tom mentioned are very interesting. They all do fit a certain
There's a
niche
new
in the
low on
marketplace that they've been able
SPY.
to expand as far as market share.
Makes sense, and they have a huge following. Thank you, Tom Nikic from Wedbush and senior markets correspondent Kevin Green here at the TD Ameritrade Network. Now that'll do it for the watch list. I'm Renita Young, and thanks for watching. See you on Market on Close next up.
More lows on the SPY. Health my SPY puts, that'll hold overnight. Yeah. Yeah, we could get a gap down. Depends on how low we close, I imagine. I'm not sure how much exuberance will hold into Powell tomorrow for his testimony. With a move, depending on where you got your puts, I mean, a move this big is pretty nice. You know, to try and hold for something bigger on 1 day or 0 day options is aggressive. There you go, Cosm. I just like the ticker Cosmo Kramer. Oh, GNS made a move too. There it goes. Yep, nice. Gas was looking good. Got your bull flag and bouncing off the support again. Got some resistance up here, 4170. Yeah, SPY low of the day. GNS making a move here, getting kind of squeezy. Tesla's coming down finally. Elvis is holding up nice. Nice little bull flag there on the 5-minute. Alright, there's our bounce coming. Maybe. Oh yeah, power hour. Osmo, Kramer, rejecting. Still looks nice though. I like it. See where I went long here? Back to it. So figure that happens, but don't know how much blush we get. You know, today could have turned into capitulation out of nowhere, down 3%. Rivian flush, new all-time lows. Look at that volume today. Only got 2 of these contracts, kept it quite safe. My long put is in the money. My short put only brings it down to 13, so. But I guess I only gave it 10 days to do it, so not super safe. Going along. Yeah, you could get bounce could be you've got a lot of upside potential. Yeah, GNS was looking pretty nice. Kind of rejecting there. Might be a good entry on it though. Pretty big bounce here. I'm kind of rejecting. Okay. You have 15% to go after hours, you just chill out for now.
Between 10-year yields and the dollar, such that if the dollar were trading where bonds were right now, then the greenback would be closer to 107, 108 at least. So at this point, now that we're hearing from Powell in his hawkish tone, you can start to see the dollar play catch up.
Yeah, that was,
so that difference between
that was
the
pretty
data
funny.
And the actual
You
words
guys had
from
me
the
cracking
Fed
up for
chief are
sure.
important, and they're showing up here because the words now from Powell, which are causing bonds to reprice Fed funds futures closer to a 50 basis point hike instead of 25, are now putting Powell more on par with some of his peers across the pond. That's a lot of P's. We heard from Christine Lagarde at the ECB. They've been getting more hawkish because their inflation is insane. We've heard generally across the board about tightening central bank policies, but because Powell was so dovish last month, the dollar over the last quarter continued to slide.
Might grab a short here.
You got the dollar up pretty big while rates
Maybe another one
are
up
little
here
changed.
if we get it.
So then,
I don't know.
why are rates
This
a little
rally so
changed?
far is
It's only
quite
a day.
subdued.
Bonds have already had a pretty big move the past month, but I think we need to be very attuned here to the potential of the market reacting to a hawkish Fed in a slightly different way than the past. In the past, a hawkish Fed sends
moving
rates
back up.
zooming
There you
higher,
go.
tech stocks down,
I want to get some
valuations
GNS.
crumbling in growth names. You do get a little bit of that. It's not a good day for tech, but the yield curve getting crunched
That's a
here
lot of P's.
is really the answer, I think. The 10-year minus the 2s making new lows today. We've got the curve getting straight up demolished. I do not think this is a laughing matter. I do not think we should be taking this lightly.
Lunet
The yield
pirata.
curve is more inverted than any major economic downturn in the past century, and that's probably a bad thing. And so at this point, we might be nearing towards a straw breaking the camel's back situation when it comes to incremental
you've got time
hawkish
still.
expectations.
Even that
being
last
too
10
much for
minute,
the economy
5
to
minute move
handle.
where the market just gets crazy.
So,
I have a big move
if you
up.
look at some of the other movers today, you've got banks down even more than tech. Banks are getting hit. Regional banks, slaughterhouse.
Grove is up 7%.
Down about 3%. The regional bank chart is looking pretty bad right now. That's another group I'm watching very, very closely. Because when it comes to signs about the economy, regional banks become very important. Regional banks are where you go to get a home loan, to get a car loan, to conduct small business. Regional banks and financials down signals that right now our response to hawkish tone from the Fed is not limited just to valuations repricing in tech. It's now being considered as a major economic threat. I think that's why you've also got crude oil down sizably today, 4%. That being said, crude just kind of bounces in between a range now, and it basically is still doing that. So keep your eyes on that. Potentially a wild card in the whole inflation conversation. Just keep it on the back burner for now until it picks a direction. For the most part, range bound. It could be worse today for sure. Fed funds futures are repricing in a big way, in a much more hawkish way than we had been thinking over the last several months about the Fed's direction. So 1.5% decline is not too bad right now, but with the S&P down through 4,000 and a little bit more of an economic style sell-off here than just a tech valuation crunch is a pretty big deal. Let's bring in Kevin Hanks, host of Fast Market, joining me here at the top of the show, as we love when he does. Kev, what's up here today? You know, it's not the worst sell-off, but it's very unique, and it's kind of a concerning style of a sell-off, I think.
Right, what a difference a day makes, Oliver. There's a complete tone change set by Jerome Powell today, and he did it relatively quickly. You saw the market swing from relatively unchanged to down about 0.5% right after he started talking. And so he kept that up all day. He acknowledged, I mean, think of, Oliver, you and I have been
statement
talking about
before he
this
started
now since
talking.
the end of last week.
This all happened before he
Jerome
started
Powell's
talking.
Comments, we're going to set the tone at least into the payroll data on Friday, and I think that
was from his speech
that's
that
the
came
case.
out.
But you mentioned
His prepared statement
the
or
real
whatever,
outlier here.
whatever that was.
We've been
That
talking about
written
yields
statement.
all week. No, it's the dollar that turned because the hawkish rhetoric brought Jerome Powell back up to with his
dollar's
peers,
ripping,
where now
oil's
the whole
dumping,
world
everything you need for a
appears
market to go
be
down.
being more hawkish. That brings the U.S. dollar up. Yields have actually hung in there pretty well, but this is a broad sell-off, Oliver. I've got staples and consumer discretionary down about 1%, a little more. Everything else is down significantly more than that, Oliver. It's a broad sell-off where really no one is safe. And you mentioned the yield curve. That's really hitting the banks and financials today, Oliver.
Yeah, yield curve vanishing before our very eyes. Continues to make new lows no matter how you slice it. Tends to the 3-month, tends to the 2-year. As far as the language goes, it did seem like there were some specifics that he chose to go with today that we hadn't heard before, right? Where he specifically said, hey, the data the last month basically was just too hot and we're data dependent. So, I would think the data before it showed it too, but I guess, hey, patience.
Oliver, we've been pounding the table on the data for the last, really since the last payroll number, right? It was the payrolls, then it was CPI, then it was PPI, then it was PCE, then it was unit labor costs. All those were flashing red, Oliver. Jerome Powell had no alternative but to interpret the data the same way we saw it. And he said it today. He basically said, the new dot plots that come out 4 times a year, we'll get them in March. They should show significantly higher ranges for rates going forward. And he didn't rule out, or 50 basis points ticked up significantly when as he was talking, Oliver. We talked about that today on Fast Market. So this is you're right. It's not down 3%. The market's not crashing. It's a good, solid down day. But I think the most significant, it's a tone change, Oliver. It wasn't Jackson Hole, but it certainly was a deviation from his other deliverances of economic data. So, yeah, a little more harsh, Jerome Powell. Not Jackson Hole harsh, but pretty harsh, Oliver.
Regional banks down 3.5% today, bearing a big brunt of that sell-off. To your point about what's going on in the yield curve, there are a few exceptions today, but not many. Even the stocks that are up are pretty few, far between, and by a small amount. Thinking about the rest of this week, I mean, day 2 tomorrow, but it seems like you fired most of the bullets here this morning. You pretty much came out swinging. Right. So do you think now the narrative goes back to the data with employment on Friday?
Yeah, most of the headlines he made today. Tomorrow will just be really reiterating a lot of the same talking points to a different crowd. But right, tomorrow we'll get a JOLTS number that they're looking for that number to come down from 11 million to 10.6. That'll be interesting to see what makes that happen. Right? I mean, you haven't seen it in any jobless claims data. So I think that's the most interesting one of the day. I mean, ADP is an important number, but boy, the correlation between ADP and the payrolls is still wide and not consistent.
Moving up here a bit.
I think it's JOLTS and then jobless claims on
out
Thursday, and then the big one on Friday when we get payrolls. We'll get inflation data in there too, in the wages data, as you know. So yeah,
I think I'm gonna grab some GNS shares at VWAP here.
More to go till we're done with the week, Oliver.
Just real fast, Kev, curious about your thoughts on oil down 4%
Maybe right getting a golfing candle today too.
Energy companies getting hit. Seems like it could go into that explanation of a weakening economy by way of tighter policy.
Yeah.
But crude just kind of goes back and forth in these levels, so I'm not sure what to make of it.
Yeah, crude really hasn't broken out of this range, even though today's certainly a big day. It's really back down. If you look at a chart of crude right now, Oliver, it's really back down. All it did was lose. Heck, it's back down to last Friday's trade. It's only slightly lower than last Friday.
Nice.
So
yeah, I'm
back into the
maybe do like 2 orders today. I try and scale in a little bit more.
Really, the
I just did one buy on POSM.
So, yeah, you're right. I mean, if you think
GNS, I think will maybe come down a little bit more to VWAP, so I'm gonna see if I get some here, and then if it comes down to VWAP, get some more.
All we've done is give up some of the headway that we've made the last couple trading days, Oliver. So this is certainly not a crisis. The VIX tells
moving up
you
here
that at 19.5 that we're not in a crisis or any crash or risk-off mode. Just a good old-fashioned heavy day, Oliver.
All right, nice. So well said. Thanks, Kevin Hanks. Good stuff. Host of Fast Market.
Yep.
Let's bring in Ed Butowski joining us from Chapel.
If he gets higher the further you out.
Partner. Ed, welcome back to the show. It looks like not the worst day, but clearly there's some stuff really getting slammed here, especially in the world of financials. What does that tell you?
Could have held those longs there.
Well, it tells you that everybody is very, very highly sensitive to anything Jerome Powell has to say or do. And so we really...
What's the pattern you're seeing?
I've been at this business for about 34 years.
Are you joking?
I never remembered a time where so much was riding on what the Fed chairman had to say. And that has everything to do with with how interest rates have moved up so quickly and how sensitive we are to where interest rates are. It's just mind-boggling to me that it's not so much earnings, it's really about interest rates now.
When you look at
it has been for like a year or more.
A little change today. Does that make sense to you while the dollar really ramps up? What do you make of the potential here for especially the 10-year as our benchmark to move over the next year?
Yeah, and a lot of people don't realize how important the 10-year is. I mean, the 10-year has everything to do with how stocks are valued. And you look at, if the 10-year goes up above 4%, that changes the valuation.
Oh, you've seen a pattern like with BBBY.
Acceptable on stocks. People have to really understand the 10-year note is the most important interest rate when it comes to
keep the IV high at further dates
and
out.
It's not surprising to me that the 10-year hasn't moved up.
Yeah, I mean, this IV should have come down some.
Been up so high, but I think.
I mean, it's not keeping me out. I like to sell premium, so I'm getting shares.
The Fed funds rate 50 basis
or
points.
Spreads. It's not like you can't get around high IV. Sell it.
The 10-year Treasury, but I think the 10-year Treasury right now is going to stay right around where it's at.
Okay. Ed, where is the place to hide right now? Is there any obvious safe haven, either within equities or any other asset class?
I'll tell you, the asset class that I absolutely love is the business development companies. These are floating rate securities, and they're selling at discounts to their net asset value. and on average, they're paying anywhere between 7 and 10% income, and they float. They go.
Did you just
what they
vape?
pay goes higher as interest rates
Did
rise.
you hear that?
So if you look at FSK or FDUS or Whitehorse,
That guy totally does
you look at any
vape.
BDC, you'll see that they're almost all, with the exception of Eris and
Not this
Hercules
guy,
and
of
Main
course, the other
Street,
guy.
they're almost all selling
Did
at
you hear it? Totally sound
discounts
like he
to
hit a
what they're
vape.
worth, but they're paying tremendous amounts of income, and that's a place to really hide right now. That's a place I love and have been, enjoying for quite some time now.
Okay, interesting. And what is that? The pool of options
Yeah,
look like?
I
Is
think
that
he
a
just
pretty,
vaped.
Big market to
Dude,
play
didn't
in.
realize it wasn't
How-
muted.
And how much does that count for an overall portfolio?
Well, I'll tell you, I have been kind of hiding there while interest rates have risen. I've started moving out into some short-term corporates that are rated BB and single B.
I've got DVR on. You guys
Taking on
can
that
go back
additional
like 2
risk,
minutes and
going out
hear
about
it.
2 or 3 years and picking up about 5 to 6% yield to maturity on those. But so I kind of play around in the BDC area for quite some time, but I've started to move out into the higher or lower quality short-term corporates. We would call them junk bonds, but as long as you're going out a very short period of time, I'm fine with that, and my clients are
Yeah,
fine
I got
with
filled
it.
on some shares.
And the BDC
from
market
GNS.
has grown quite a bit. I mean, if you look at FSK, which is managed by KKR, that's selling at about a 20% discount to what it's worth, and it's paying about 12%, and they just increased their dividend 37%.
Wow.
This is a great spot to be looking at.
And this is mostly going for yield. Is there any underlying fundamental risk to these assets? Are they cyclical in nature at all if the economy does slow down?
Well, that's the thing, that if the economy slows down, the idea is that they're not going to, the companies that are borrowing money won't be able to pay those notes. But right now, the non-accruals is how they call it, are literally below 3%, and those are factored in. I don't want to sound like it's nirvana, but it kind of is. It's a great place to be putting money right now, is the BDCs, business development companies, and you can look at BDC.com and find a whole long list of them. I'm not promoting one versus the other. I'm just talking about the general category. If you ask me where I'm hiding and where I'm putting money, that's where I'm going right now.
I love it. Nice letting us in on the
Totally
intel.
fake,
Appreciate
dude.
the details, Ed. Thanks a lot.
Absolutely. Thank you.
Right, well, we're trying to find nuggets in this market and some diamonds in the rough. Ed Butowski.
Jason,
All right, very
you lose
interesting
credibility
stuff.
when you always say
Investments.
stupid stuff.
All right, Tony Zhang's on
Like
deck.
BY's
We got a
bumpy.
trade in a stock that is
He hit his
been
vape, didn't
tied
he? Yeah.
to the casino and the reopen theme. And he's fading it after a pretty strong couple months for the reopen trade. MGM broke out. We'll figure out if it's going to go down.
BBC? What you're talking about? SPY pumping here a little more. Gotta help my longs for Powell hour. Is VWAP on here? 37.84. Probably somewhere there. The heck, I just lost all my day trading buying power. Great. I had like, oh, what is the deal? Just happened. Only able to get 100 shares. Thanks, Jason. Appreciate it, man. Poop. Yeah, all the crap you talk. That's right. Sometimes it is a blessing. That's true.
Let's get nuts!
Let's get nuts. That was so late. That all the spies got for no, they didn't. Shut up. Oh, you're just playing at Jason? Let's get nuts. Speaking of Cosmo Kramer, how's George? He's pulling a Jason on him. Pulling a Jason. Very clever. Jason bought this. No, it's okay. You might have a little pump sometime. MC? Beachbody. Hanging high at 10%. Not a bad looking chart, actually. Broke out of this range.
Pullback, and that's my expectation here.
That's bankrupt.
But if you look at the fundamental story here of MGM,
Love my SI.
This is really driven by reopening, especially off of what has been strong bookings on in Vegas, and as well as optimism around the reopening around China.
All right, guys, I need to do my recap
the stock
video.
is trading at what is fairly rich premiums, trading at 36
Bankrupt. Market doesn't
times
pump.
fiscal year 24 earnings, so next year's earnings. And from my perspective, that's pretty much rich by about every single possible standard you could look at for a business.
Good night, big
like
hugs.
this.
Big hugs to you too.
In fiscal year
We'll see you guys back here
2023,
tomorrow
they're expected
or
to
on
earn
Discord
roughly
tonight.
about 70 cents in earnings,
Powell's
about
speaking again at
$15
10 a.m.
billion
tomorrow,
worth
so
of
be
revenue.
watching that.
Compare that to 2019.
But thanks for
That's the
your
last time
subs,
the
your
stock earned
notification
about
bells,
70
your
cents
likes.
in earnings,
Thanks,
when
Jason, for your
profit
dono.
margins
Appreciate it,
were
man.
higher and the stock price was
Sub
about
up, like up,
50%
comment down.
lower.
Happy money
So
sticks
something is
around.
not adding up where you have
Thanks, Ace.
lower
Thanks, Big
earnings,
Hugs.
lower
Thanks,
margins,
Ask
and a
Why.
stock price that's
Thanks,
50%
Taryn.
higher. So from a valuation perspective, it's rich.
Thanks, Ace.
From a
Thanks,
technical
Jim.
perspective, I think the time works fairly well for a potential short
Yeah,
exposure. And then you have
see
a
what's going on in the
larger
recap video. I'll be out in
that's,
like 35
being a
minutes or
bit of an
so.
overhang on
This
the
isn't looking too
overall
bad
market,
though.
both
Today
equities,
looks
bonds,
at least better
as
than
well as the
yesterday.
economy. And I just think that they all align
Yeah, we'll go over
for
that
having some short
shortly.
exposure
Thanks,
here at
guys.
MGM.
Peace out.